systems, which are 1,000 times more powerful than traditional computers. That's what's happening here in the U.S. Back over to you in Mumbai.
And as we just mentioned, the U.S. Treasury Secretary Scott Bessent says that India could be the first country to ink a trade deal with the U.S. He spoke to CNBC last evening and he said that many countries have come forward with some very good proposals. Let's listen in to his comments on the trade deal and what he had to say on China as well.
There are 15 to 18 important trading relationships. As you said earlier, we'll put China to the side. That's a more complex negotiation. And with the other 17, especially with the other Asian countries, we've had many countries come forward and present some very good proposals, and we're evaluating those. But I tell you, Joe, when I look at these proposals, and some of them are really willing to lower their tariffs, lower their non-tariff barriers. But I look at what they're proposing and I just think, how did we get here? How did we get here?
Right.
And I agree with President Trump. I don't blame it on these countries. I blame it on the past administrations. And it's going to be a big victory when we make progress in getting these tariffs, non-tariff trade barriers, currency manipulation, state subsidies of labor and industry off. The negotiations with our Asian trading partners are going very well. Vice President Vance was in India last week, talked about substantial progress. I would guess that India would be one of the first trade deals we would sign, so watch this space. In terms of trade negotiations, we'll see where this goes. But as I've repeatedly said, that I believe that it's up to China to de-escalate because they sell 5 times more to us than we sell to them. And so these 125, 145% tariffs are unsustainable.
Scott Bessent there speaking to CNBC. Let us also now listen in to what veteran emerging market investor Mark Mobius had to say on his views about how India could benefit as tensions between the US and China continue to persist.
Well, India is still the story. India is doing very well, and I believe India is going to be benefiting from what's happening with China and the U.S. A lot of other things, a lot of manufacturing requiring high labor input would go to India, obviously, because India's got over 1.2 billion people. So that's one point. The other point is that India is gradually coming to an agreement with the U.S. on tariffs. I believe they will reach some agreement. And when that happens, that, of course, will be very positive for India.
So positive for India there, Mark Mobius speaking to CNBC. That's all the global market action that we have. But how will all of these overnight cues impact our own markets? Our research team joins in with the trade setup, the stocks that are likely to be in the news, and of course the setup on the F&O side of things as well. Well, make no mistake, it was a very good session that we had on the Nifty yesterday and recovering everything that we lost during Friday's trading session. But the one pain point that the index has, it is still stuck in that range and it is failing to cross that 24,350 mark decisively on the upside. And if you could take a look at the intraday highs that the index has made over the last 4 trading sessions, you will get an idea that it is stuck between this 24,350 to 24,360 range, and it is finding resistance at that level and it is failing to cross that. And even yesterday's high of 24,355 is testimony to that. Almost 40% of Nifty's moves yesterday, the index was up almost 200 points, 280 points actually, and 40% of that came from Reliance Industries, and it was the best single day gain that the index heavyweight saw in the last 10 months, and that added almost 93,000 crore rupees to the market cap of Reliance. And you can see that 109 points coming from Reliance Industries. Of course, it was ably aided by the banking heavyweights as well, and it was also evident because of the Nifty Bank too, that was up almost 700 points in yesterday's trading session, as the heavyweight banks too contributed to the index up move in yesterday's trading session. But even for the Nifty Bank, it has recovered half of what it fell from the record highs, but that 55,550, 55,600 bid remains that resistance barrier for the index to cross and go back to that 56,000 mark that it had scaled early last week. Now, institutional activities, well, both foreign and domestic investors were net buyers in yesterday's trading session, and April might just turn out to be only the second month since September last year where foreign institutional flows have been on the positive side. Well, of course, in today's session, earnings reactions continue. There are a lot of earnings lined up today as well. Keep an eye out on the border tensions between India and Pakistan and any developments that take place there. And of course, we see if there is any additional buying in defense companies, because a lot of these defense stocks were up 7, 8, 10% in yesterday's trading session. But for now, the GIFT Nifty is indicating a marginally positive start for our own markets. The implied open suggesting a 36-point uptick as of now. But over to Sudarshan now, who will list out the stocks that you need to keep an eye out for this morning. Sudarshan, good morning. What's on your list?
Good morning, Hamas. So we'll start with companies which have reported a good set of earnings. In that one, first one is Firstsource. Its revenue was up 2.1% sequentially and was up 25% if you compare year on year. Also, FY26 constant currency revenue growth guidance is of 12 to 15%, and exit deal pipeline in Q4 was 30% higher if you compare with Q4 of FY24. For Adani Green, revenue has risen 21%. Margin was at 78% against almost 73% in the same quarter last year. For PNB Housing Finance, profit has increased 28%. NI was up 20% year on year. Now, companies which have reported are kind of disappointed in Q4. First one was Nippon Life AMC. Revenue was in line with estimates, but quarterly average asset under management was down 2.2%. SIP AUM was down 7%, and AAUM market share was down 5 bips, and equity market share was down 13 bips sequentially. Adani Total revenue was up 4%, margin has slipped 60 basis points. Oberoi Realty revenue has fallen 13%, even margin has fallen more than 630 basis points. Now on the news flows, IndusInd Bank CNBC-TV18 News break has got confirmed. Arun Khurana has resigned as whole-time director and deputy CEO, and that is effective April 28. Tata Tech, as per sources, TPG Rise Climate, which held almost 6% stake as of March 2025. We understand that it's going to sell 3.9% stake today via block deals, and price range is 670 to 698 per share. Last one is IOL Chemicals. Its product ibuprofen has got approval from Chinese regulator. Now it can export to Chinese markets.
Keep an eye out on IOL Chemicals. Sudarshan, thanks a lot for that. And lastly, Mangalam joins in with cues from the F&O space. Mangalam, good morning. What's the F&O data indicating today?
Well, a couple of things that the F&O data is indicating. The first part is that tomorrow is, the weekly options expiry because of Thursday being a holiday. T-Street yesterday did extremely well. So the Nifty had about 300 points in gains led by the Nifty Bank. The Midcap index did a step better. The key contributor on the way up was Reliance. Over 100 points on the Nifty suggested by Reliance itself or supported by Reliance itself. What we need to watch out for is how the IT stocks perform today, how the auto stocks perform today, and how the pharma stocks perform today. Yesterday's high was 24,355. April 23rd high was 24,359. So that's something we need to cross. And the GIFT Nifty is suggesting a positive start up to about 38 points, which implies that we will open above yesterday's high and closer to April 23rd high itself. What's good is both the FIs and the DIIs, they are buying in cash markets, so that's supporting. Secondly, one day before, on Friday, we saw the market did underperform a bit. The FI shorts came back into the system, and we made this point that, shorts will cover their positions if the market moves higher, and that's exactly what happened yesterday. They bought about 2,200 crores in index futures, added 9,200 longs, and covered 3,100 shorts as well. What does this do to their long exposure? If you look at the FIIs, the start of the series, they were net contract of close to 25,000 contracts on the short side, increased all the way up to 35,000, and now it's down to 22,276, with longs increasing from 41%, falling to 38%, now at 42% itself. All the options that are expiring tomorrow, what are the option writers betting on? 24,350 call at a premium of 99 rupees, telling you levels above 24,400 could see some supply. But if were we to cross and stay above that, then there is a lot of positioning at 24,500 call as well for a positive pop up itself. On the lower level, support has moved higher from 23,850 to closer to 24,200. That's the action at the 24,300 put and the 24,200 put as well. At the afternoon yesterday, we had pointed out the possibility of RBL Bank entering F&O ban, and that's exactly what has happened. After a 10% up move, the stock is in F&O ban.
First one to enter the ban this series is RBL Bank. Mangalam, thanks a lot for that. Take a short break. Up next, a CNBC-TV18 news break getting confirmed as IndusInd Bank's deputy CEO has quit. More details when we return. Welcome back. Now, IndusInd Bank has announced that its deputy CEO Arun Khurana has resigned with immediate effect just weeks after the private lender disclosed accounting lapses in its derivatives portfolio. Ritu is here to give us more details on this. Ritu, good morning. A confirmation of your news break. What are the more details that are emerging here?
Good morning, Hormaz, and thank you for that. You know, in what is clearly a fallout of the accounting discrepancies in IndusInd Bank's derivatives portfolio, now you have the Deputy CEO, Arun Khurana, resigning with immediate effect as of yesterday. Now, we reported this a couple of weeks ago, where Khurana was overseeing the Treasury Front Office, which is the division responsible for the portfolio, where incorrect accounting had led to a near 2,000 crore hit on the bank's P&L, and therefore he was among the people who were held directly responsible for the issue and were expected to submit their resignation. Now, in his own letter, Arun Khurana has cited these recent developments as the key reason for his decision. He wrote, and I quote him, "Considering the recent unfortunate developments wherein the bank determined an adverse accounting impact on the P&L on account of incorrect accounting for internal derivatives trade, I, having oversight of the Treasury Front Office as a whole-time director and deputy CEO, hereby resign effective immediately," end of quote. Now, this resignation comes just a day after the bank had disclosed that an independent investigation had identified the key individuals who were responsible for this. The bank had also stated that the board will then determine changes and realign the senior management responsibilities based on the findings of the report. The report, of course, we understand, was conducted by Grant Thornton, which also pegged the financial impact at about 1960 crore rupees, which is very close to the 1979 crore hit that was earlier determined by the external auditor, PwC. Now, the bank has confirmed that it will account for this loss in the January to March quarter. Now, this is the second major exit from the bank in recent months after the CFO had resigned in January, even before the discrepancies were disclosed, while, of course, we know the current CEO's tenure has been cut short until March next year.
Indeed, Ritu, thanks a lot for that update. Has been on top of this news, has Ritu, and getting all the latest developments. So keep an eye out on IndusInd Bank. Mind you, the stock has risen almost 21% in the last 1 month, recovering almost 40% now from its 52-week lows of 606 that it had hit on the 12th of March. Now, the tariff war between the US and China could pose a significant challenge for electric vehicle makers across the world, including India. Now, China is planning to ban the export of rare earth magnets, which are crucial to make electric vehicles. Now, speaking to Lata Venkatesh, Bajaj Auto's Managing Director Rajiv Bajaj warned that the industry will come to a grinding halt if China bans the exports of these magnets. Listen in.
As of yesterday, I still have to verify this, but I was given to believe that suddenly China has decided not to permit the export of heavy rare earth magnets, which are used in motors of electric vehicles. And as you know, that for some of these EV components, the whole supply chain of the world resides in China.
Exactly.
So if this is true, we are still trying to come to terms with the facts, all the facts. But if this is true, it would mean that, and if it doesn't change, then in a matter of weeks, the entire Indian EV industry will grind to a halt.
The industry will come to a grinding halt. The warning there from Rajiv Bajaj. We take a short break, get you cues from the commodities market on the other side. Stay tuned.
We will be building 4th Mumbai around.
Welcome back. And before we move on, let's also take a look at how the Asian markets are faring. The Hang Seng has extended its early gains now, almost 0.8% higher. Now the Shanghai Composite, which had opened lower, has also recovered and is now trading in the green as we speak. So positive cues emerging from Asia. Even the Kospi, that was up 0.4%, is now up 0.6%. Now power has begun to return to Spain and Portugal after the unprecedented blackout that is being blamed on extreme temperature variations. Now the two countries were without trains, metros, traffic lights, ATMs, phone connections and internet access for a prolonged period of time. Take a look at this report.
Power started returning to parts of Spain and Portugal on Monday after a huge outage grounded planes, halted public transport, and forced some hospitals to suspend routine operations. In Madrid, these international students were relieved when the lights started coming back on.
It shows how dependent we are on it. But
we were actually most afraid of walking back home
when it's dark,
without the street lights when it was dark.
Spanish Prime Minister Pedro Sanchez said Spain's grid operator had restored electricity supplies to about half of the country, and the rest should be restored by Tuesday. He added that authorities were yet to establish what had caused the blackout and were not ruling anything out. Various municipalities in Portugal, including the capital Lisbon, also saw power come back on Monday night. Portuguese electricity distributor REN said it had restored production at a hydroelectric and thermoelectric plant and was prioritizing supply resumptions to hospitals and transport. Such widespread outages are unusual in Europe.
An unprecedented blackout across Spain and Portugal. But Manisha Gupta now joins in with all the updates from the commodity space. Manisha, good morning. Well, the crude prices are stuck in a range and some buying coming in for gold as well.
Oh, well, yes. The gold seems to be reversing some losses. It's gained to almost $33.50 an ounce. The cautious sentiment ahead of various strong U.S. economic data that we are anticipating. Remember, today's U.S. consumer confidence numbers, and tomorrow you will be dealing with the first quarter GDP numbers, home sales, and tomorrow also is about the Bank of Japan monetary policy meeting. This is a data-heavy week, and ahead of that, there is some bit of a gold buying that we've seen into the markets. Well, when it comes to the crude oil prices, it was a 2% decline in the overnight markets. Remember, OPEC is going to add 411,000 barrels from the month of May, and OPEC and allies are meeting on 5th of May to announce June output going forward. In the meanwhile, the U.S. shale output is also at a near record highs, and then the markets are also anticipating more barrels coming in from Iran, from after the Russia-Ukraine conversations continue, and then the markets also are looking at the dollar index strengthening from its 3-year low. So all of those factors weighing onto the crude oil prices right now.
Multiple factors weighing on crude oil prices. Manisha, thanks a lot for that. And lastly, getting you the latest on the Trump-related developments, we have Dia joining in our special segment, Trump Watch.
Starting off with a bold comeback aimed straight at U.S. President Donald Trump, this time from a Canadian conservative leader, Pierre Poilievre, who hit back at Trump after the U.S. president once again floated the idea of Canada becoming part of the United States. The Canadian leader said, and I quote, "President Trump, stay out of our election. Canada will always be proud, sovereign and independent, and we will never be the 51st state." Back in Washington, Trump is standing by his pick for defense secretary despite mounting backlash. Pete Hegseth, the former Fox News host and military veteran, is under fire after reportedly leaking sensitive details on the Signal app about a planned U.S. strike on Houthi militants in Yemen. Critics say it is a serious breach, but Trump says he believes Hegseth will get it together, signaling that no shakeup is coming for now. Meanwhile, the U.S. is ramping up pressure on Iran when it comes to fuel supply. Treasury Department has announced sanctions on 3 shipping vessels accusing of delivering refined petroleum products to Houthi-controlled ports in Yemen. The cargo included liquefied petroleum gas and gas oil. The move comes as nuclear talks with Tehran continue, highlighting Washington's push to hold Iran and its proxies accountable while diplomacy plays out. Turning to energy, drivers in the U.S. can expect cheaper gas this summer following a new policy change. The EPA has issued an emergency waiver allowing the sale of E15 gasoline, that's gas blended with 15% ethanol, through the summer months. The fuel is normally restricted in warmer weather due to air pollution concerns, but officials say the change will help lower prices and support U.S. farmers. Lastly, President Donald Trump signed executive orders on immigration enforcement, sanctuary cities, and English proficiency for truck drivers. The White House has been focusing on broader issues to mark Trump's first 100 days of his second term. That's all for today. Back to you.
Yeah, thanks a lot for that. And we wrap up with some news from the world of cricket. The 14-year-old Vaibhav Suryavanshi became the youngest ever to score a century in the history of the IPL as the Rajasthan Royals player notched up a ton against the Gujarat Titans at the Savai Mansingh Stadium in Jaipur last evening. The Royals rounded off a 211-run chase with more than 4 overs to spare, with Suryavanshi scoring 100 off just 35 balls. And while we all sit and wonder what we were doing when we were 14 years old, we call time on this edition of Power Breakfast. From me and the team that put this show together, thank you so much for watching. Bazaar Morning Call sets you up for the day's trade.
Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. Tuesday morning, we are coming to you live from the CNBC-TV18 Motilal Oswal studios. I'm Prashant, with me my colleagues Surabhi and Nigel. Guys, good morning.
Hi, morning folks. So Tuesday all set for trade, and you know, it's in general, I don't want to jinx it, but the world is looking like a slightly better place. At least the headlines, whether it's geopolitical or whether it's, you know, tariffs, they're not as sharp as what we saw in the earlier part of this month. In April, is just about winding down.
Well, that's right. You know, and from all those debates, it's now turned to memes, right? There's a bill that was passed overnight banning the Congress from trading. And you know what it's called? What act? Pelosi Act. That was
Pelosi, Nancy Pelosi.
That was passed last night. So from all those debates, suddenly you have memes taking center stage. Interesting times.
And guys, that knock, I only caught it this morning. I didn't watch it last night. The Vaibhav Suryavanshi
I saw a glimpse
100
of
knock.
it.
I mean, just incredible.
I saw every ball of it. It was absolutely spectacular. I didn't get a chance to see Sachin when he was that young.
Yeah.
But this was something else. You know, when you bring up your century at all of 14 years old, and you bring it up with a 6. I mean, what was he thinking?
He was
Brilliant.
knocking all these bowlers as if, it's like normal gully cricket or something. He's playing with his friends, just, hitting it out.
I have a 14-year-old, so I told her this morning, I said, well, look at look at what other 14-year-olds are doing. So
That's not fair.
she turned right around and said, well, what were you doing?
I woke up my 6-year-old telling him that, you know what happened last night? And he popped up. Brilliant. Just look at him.
Absolutely. I mean, incredible pictures. And Sachin Tendulkar, by the way, congratulating him on X and, Vaibhav replying. And that's the great thing about him. Of course, IPL, fantastic. But of course, also these interactions on Twitter, X, whatever you want to call it.
Rahul Dravid's reaction as well. He was in...
To get Rahul Dravid up on his feet.
Absolutely.
And, the stoic Dravid coming up and really cheering. Quite something.
And just one more point. Both these two gentlemen, Jaiswal as well as Suryavanshi, they were batting out there. They brought up, 150 runs or thereabouts. Yeah. And the combined age between the two of them was what? 37 years. 37 years, that was the future of it.
22 or something?
23 is Jaiswal and 14. So put it together, you have 37 years. Future of India in cricket, I hope. Amazing.
No, absolutely. And I think that's a great thing about the IPL format as well, right? It kind of shines a spotlight in a really intense way on performers like Vaibhav. Well, let's just sort of, get back to the market quick bit and take a look at take it from the top, really. So it was nothing kind of a day, right? US equities spared intraday losses to close absolutely flat. Nothing really on it, on market prices at least. S&P flat, NASDAQ down. I mean, nothing. The 10-year was down about 3 basis points, $4.2 index back to about 99. It gave up some of what it had accumulated last 2 days. Oil prices 2% lower, 65.60 or so is where Brent left off at. Now, Treasury Secretary Bessent gave an interview to CNBC, the CNBC network, and he basically spoke about two countries, one India, one China, starkly very different sort of comments which he made. We'll just quickly play out those sound bites and we'll discuss this.
The negotiations with our Asian trading partners are going very well. Vice President Vance was in India last week, talked about substantial progress. I would guess that India would be one of the first trade deals we would sign, so watch this space. In terms of trade negotiations, we'll see where this goes. But as I've repeatedly said, that I believe that it's up to China to de-escalate because they sell 5 times more to us than we sell to them. And so these 125, 145% tariffs are unsustainable.
The fact about India being first in the line to get a trade deal is not new. I mean, it's been it's widely acknowledged that Japan, India, perhaps first in line to get a trade deal. But coming from the Treasury Secretary, important to note. And remember, when we say a trade deal, what we're essentially talking about is just a framework kind of a deal. As someone put it, a MOU. And because trade deals, I mean, the actual bulk of it takes a long time, months, years, etc. So, but anyway, for what it's... this is important nevertheless. And of course, the more important thing in that sense was with regards to China. Bessent saying that it's up to Chinese to come up and make that first call and initiate conversations, etc., etc. And of course, as we said yesterday as well, markets globally are still waiting and watching whether those talks are happening, not happening, and so on and so forth. Well, other stuff, Nvidia was down 2%. The Wall Street Journal essentially saying that China's Huawei is developing a new AI chip that it hopes could replace some of Nvidia's higher-end products. Remember, there are now restrictions on Nvidia being able to sell these chips to China. With regards to India, Pakistan, tension still high, lots of debate, fire, fury. But, and of course, I mean, at the LOC, there is some firing, some updates we get from our forces early in the morning in terms of what happened the previous night. So Pakistan's defense minister told Reuters yesterday that they've reinforced their forces anticipating an attack. The big focus in the US this week is the Magnificent Seven earnings. On tomorrow you have Microsoft and Meta. Thursday you have Apple and Amazon, which will report numbers. So that's a big one. Yesterday, of course, was really a flourish of a day. The market wiping out all of Friday's losses, and we basically ended almost at the day's highest point. So we are essentially back to that same framework we were working with, at least on the upside. The upside level is 24,546. It's a 61.8% retracement of the entire fall from the highs late last year to the lows that we saw in April. Supports come in at 23,847, which is nothing but the recent low. Bank Nifty upside is the same range, 56,098 to 56,631. And the downside level is Friday's low, which was 54,176, should act as a bit of a support in case the market starts to turn a little bit. GIFT Nifty will come up on your screen. We'll give you a quick sense of where we are likely to start this morning. 40 points in the green. Surabhi.
Absolutely. I mean, Scott Bessent making all the headlines yesterday because the markets were not doing too much. In fact, he spoke about India, China. He also did indicate that there are other deals coming with 15 to 17 other trading partners. And I mean, that's giving a lot of people hope. The South Korean delegation was in Washington in the, over last week. So there is an anticipation that eventually these deals will get signed. Let's listen in to Mr. Bessent and then we'll move on.
There are 15 to 18 important trading relationships. As you said earlier, we'll put China to the side. That's a more complex negotiation. And with the other 17, especially with the other Asian countries, we've had many countries come forward and present some very good proposals, and we're evaluating those.
Okay, so I mean, the world is filled with hope that eventually this gets sorted out, and at least it's not going to be as onerous as what was announced on the 2nd of April. Asia this morning is actually looking rather good, and markets are building up on that momentum. It was a flat start for markets like Japan, but now Japan itself is up about 0.4%. The Hong Kong market has really taken off. As you can see, they're almost 1% higher. Taiwan's looking better. At the start, the Shanghai Composite was slightly lower. Even that's turned positive. The Kospi is up about 0.6, 0.7% as well. So Asia has actually got a good thing going for itself. Of course, these earnings that we're talking about, the Magnificent 7 earnings, they will set the tone between today and tomorrow. Today, it's Meta and Microsoft. On Wednesday, it's Meta and Microsoft. And on Thursday, it's Apple and Amazon. So there's a bit of a wait and watch ahead of that as well. By the way, on all of this talk between US and China, the Chinese Foreign Ministry again issued a denial yesterday. And this is a statement from the spokesperson saying that, let me make it very clear that China and US are not engaged in any consultation or negotiation on tariffs. So it seems the US side is trying to woo the Chinese a bit into the conversations. China is saying lower tariffs, then we'll talk. So that's a bit of a stalemate. But anyhow, now let's talk about our market, because yesterday was once again a very good day. And in the last 6 or 7 sessions, about 6 sessions actually, this is the trading range for the market. The lower end of this band is 23,850. And last 4 days in a row, we're testing the upper end of the range, 24,360. 4 days. And typically when you test a level again and again and again, chances are that it breaks. That's what technical experts would tell you. So let's see if we get that upside break or not, given the tailwinds. The Asian tailwinds are very, very positive. Institutional flows, no problem at all. DIIs, FIIs, both on the buy side. Almost 2,500 crores from the FIIs and 2,800 odd crores from the DIIs coming through yesterday. So flows are very strong in the market. The macros are also kind of supporting. Quickly on the IIP, the March IIP number is looking better than the Feb IIP number, 3%. Manufacturing still kind of ambling along. That's the bit of a problem in the puzzle, 3%. Still better than the February number. Consumer durable output, all the AC sales, that's really surged about 6.6%. Mining is at a 6-month low. Capital goods at 2.4% at a 7-month low. So the industrial part of it is the problem. Consumer durables have done quite a bit of the heavy lifting this time around. Very quickly coming into some stocks and specific news flow here. Bajaj Finance today, we don't only get the earnings. Today, the board will also decide on the stock split, which got the stock quite excited when it was originally announced. So watch out for this. And IndusInd Bank, we told you earlier, and it's now happening. Ritu had kind of given a hint that more heads will roll, more exits will happen, and that's exactly what got announced. Arun Khurana has resigned as the whole-time director and deputy CEO, and this is effective immediately. So he's no longer with the bank. Very quickly, earnings, and it's a big list today. Trent, Bajaj Finance, like I said, Finserv as well, Ambuja, BPCL, a couple of very interesting non-Nifty names like CEAT, Star Health, Vishal Megamart, among others. So plenty to keep us busy. Nigel.
Well, that's right. Besides the flows being quite positive, the overnight cues as well, we look at the Troika, they as well behave. Your Brent crude price is more or less stable. The dollar index has come in lower, and the 10-year yield as well has cooled off to around 4.21% or thereabouts. So all those three well behaved. What did the FIs do in the F&O market? Well, in yesterday's trading session, they added some longs, they covered some shorts. They continue to remain net short with 58% of their positions on the short side. And if you look at it in absolute terms, you have both the FIs as well as the clients. They are marginally net short, and the client net short positions at around this 27,000 odd. It's the highest we've seen all the way since early October. So this net short position is at a more than a 6-month high is what we're seeing from the clients. The FIs as well, actually their short positions are relatively lower in comparison to what we have seen in the last few months. Moving to the Nifty Bank. Now yesterday I had mentioned that if the Nifty needs to end higher, the Nifty Bank holds the key. And what was encouraging about yesterday's trading session from the Nifty Bank was it made a higher high in yesterday's trading session. Otherwise, you were seeing that, we were having a bit of a slippy slide. But yesterday, it made a higher high. And even on the low side, well, it made a higher low as well. So a higher low coming in from the Nifty Bank, that's normally a good sign. But now it's got its work cut out because the crucial resistance level comes in at around the 56,000 odd mark. Last week, twice we visited that mark, we couldn't conquer it. So in today's trading session or even tomorrow, you'll want the Nifty Bank to go ahead and conquer this crucial 56,000 odd mark. Remember, valuations are relatively okay in the banking space. And also you have the flows that are coming in. And normally the banks, they take a larger chunk of that. So that 56,000 mark, that's the line in the sand. Moving to the options data that we're looking at on the Nifty, the 24,500 call, fairly active, 24,000 put. And we're in this broad range. On the downside, 23,800. On the upside, 24,500. So that's the important marker that you're looking at. The crucial resistance comes in at around this 24,550 because as we mentioned earlier, it's a 61% retracement of the entire fall that we've seen. So that's the crucial resistance mark for the Nifty itself. The stock that I'm tracking for today's trading session is Coforge, and there are a few reasons out there because overnight we had Sabri Corp. They have gone ahead and they've sold their hospitality solutions business. Why is it important for Coforge? Because they had signed a collaboration, last month or so for more than $1 billion deal over the next few years, and the street was cautious that Sabri maybe their debt is too high. But now they appear to be, working on that so that it gets a bit of a clearance with regard to visibility of that deal. So that's a positive. The company has announced a small sale with regard to one of their subsidiaries. And early next week, we'll be getting the results as well. So Coforge is a stock that I'll be keeping an eye out on.
Okay, all right, got it. Nigel, thank you very much for that. So that's, of course, all the cues that we have to track. We have Mark Matthew of Bank Julius Baer & Co. joining in for some perspective now. Mark, great to have you on as always. Good morning. Thanks for joining in. So let's start right there. This whole hope that we're seeing across Asian markets because of what Mr. Scott Bessent is saying. He's saying a deal with India is probably first off the block and there could be others. But China is puzzling. The US says we're talking. China reiterates again and again through its official channels that there's no conversation. What do you make of it?
I make that both of those are really for domestic politics. I mean, Scott Bessent was saying yesterday that China has to make the first move, and China says that there are no talks and the U.S. has to make the first move. It's for domestic politics. But behind the scenes, there's no doubt that they are talking. And at a certain point, though, we're going to have to see some evidence of that because it's the reason why the market has been going up primarily is the narrative has changed from escalation to de-escalation. At a certain point, we're going to need to see some evidence of that. But I think we will because it just makes no sense for either economy to basically drive themselves off a cliff, which is what they would do if they keep these tariffs in place.
Hi, Mark. Good morning and good to see you. What about the Indian markets? We have outperformed from Liberation Day, because our markets are high in comparison to the rest of the globe. And the flows have come back as well. But we have our challenges, right? There is a bit of a slowdown in various parts of the economy. We also have earnings that haven't been, blockbuster. And maybe there is a downgrade risk as well to the estimates that we're working with. Your view on the Indian markets post this recent rally?
I think it's fine. I think the market is always looking forward. So it's true that there has been some economic weakness, but if we look forward, I think we will see acceleration because the things that caused that weakness last year are behind us and inflation is back down to very reasonable levels. So we can look forward to at least 2 more rate cuts. And the main thing is that the dollar is still overvalued, and our view is it will weaken over the next 12 months. It's probably about 10 to 15% overvalued, believe it or not, based on our real effective exchange rate model. Now, I don't know if it's going to go down another 10% because it already is down 10%, but if it continues to weaken, of course, that is good news for the Indian market as well because it would attract foreign flows.
Although 15%, and I've seen some estimates, Mark, morning, 15, 20, 25% downside on the dollar, but that would only come if there's this sharp weakness in US, right? US growth, maybe a recession. Wouldn't it take a recession to trigger another 15% downside on the dollar? What would that mean then for flows, etc., to EMs?
It could be positive. I mean, there are 2 kinds of recessions. There's a very deep structural recession like the global financial crisis, and then it's just risk off everywhere. But then there's a good old-fashioned cyclical recession, and generally what you see in that kind of environment is people trying to find other places to invest in the rest of the world. And India's economy among the major emerging markets is about as decoupled from the US as you can get. I mean, there is the technology sector, but that is not the main driver of the economy. It's domestic consumption. So I think in a cyclical recession scenario, by the way, it's not our forecast, but if it did happen, that would probably be a net positive in terms of flows to India.
All right, Mark, we'll leave it there. We'll, of course, you don't need a serious kind, as you said, right? I mean, because then that is just bad. But some slowdown typically, good for EM flows. So just the right kind of slowdown is what is required to trigger that sort of higher flows into EMs, etc. Mark, thank you for joining us. As I said, appreciate it. Well, I think let me just quickly run you through the interactions which are lined up here over the next 2 hours or so. So we have Pralay Mondal of CSB Bank, who will be with us to talk about their 4th quarter numbers. 9 o'clock, we'll have the management of Indian Railway Finance Corporation, IRFC, to decode their 4th quarter numbers. 9:20, Ajay Argal of Franklin Templeton will be a market master. 9:30, you'll have the management of AWL Agri Business joining us to talk about their numbers. Hexaware will be joining us at 9:40. Then there's KPIT Tech at 9:50. And towards the end of the program, it's the economy with Lata, and she'll be speaking with the MPC member, Saugata Bhattacharya, on the state of the economy. Stay tuned.
Well, time to slip into a short break. You've got a lot of stock-specific action track for you. We get to that in just a bit in our special Top 10 segment. For the time being, we give you a sneak peek. Ultratech Cement, TVS Motors, Hexaware. We have Adani Green, PNB Housing Finance, and Firstsource Solutions. All of them will be reacting to positive news flow. On the flip side, Adani Total Gas, KFin Tech, Nippon AMC, and Tata Technologies will be reacting to negative news flow. Take that break, come back, we'll get into further detail on all of these names.
Welcome back. As we've been telling you, the cues across Asia are actually quite positive. Big shade of green across most markets, and Hong Kong is leading that charge. About 0.7%. I was actually up 1%, so it's cooled off just a little bit, but looking good. And the implied open is suggesting that we'll probably start northwards. It's an important day. Will we break out of our 5-day, 6-day trading range or not? With this kind of a gap up, in all likelihood, yes, 24,500 on the GIFT Nifty. So let's see. Lots of stocks to talk as well, to track and talk as well. Let's straight away get to our team then with the CNBC-TV18 list of top stocks to watch. Guys, morning to all of you. Nigel, let's start off with Ultratech. How did it look?
Well, Ultratech's numbers came late in trade yesterday. And in fact, from the lows of the day, actually, the stock did end a little bit higher because at one point of time, it was down close to around 2%. They had their con call post-market that was delayed by close to an hour or so. But the con call details ain't very, very worrying. Near term, they've indicated there could be some pain. Let's run you through all the top, highlights that we got out there. They're expecting the industry to grow by around 7 to around 8% in the coming year. For Ultratech specifically, they're talking about double-digit organic volume growth. So X of the acquisition, still they'll grow in double digits, which indicates that they'll gain market share yet again. On the cost-saving front, they've done plenty, right? They've been focusing on the WHRS system, on renewable energy as well, and they've achieved close to around 86 rupees per ton of cost savings. But they're saying in the next couple of years, it moves to around 300 rupees per ton on the cost savings aspect. That's by FY27. So that's a positive. Pricing, it's better today in comparison to the average of the last quarter, so you like that. And they are targeting a capex spend of around 9,000 crores in FY26, but they're saying FY27 will be relatively low because in 26 they want to turn around some of these assets. The net debt to EBITDA is at around 1.5, but they're saying gradually they'll bring it down to around 0.5, which is the level they are comfortable on. And, they're the magicians with regard to turning around assets. On India Cement as well as Castrol, the commentary was positive out there. On India Cements, they're talking about, EBITDA of around 500 to 800 rupees per ton. That compares with 40 rupees in the past quarter. And also for Castrol, they're talking about 1,000 rupees or thereabouts, which in the past quarter was around 400 rupees. So they're turning around those assets going with green on Ultratech Cement. But the other number that came in very close to end of trade was TVS Motors. And first look, actually, the numbers look quite good. However, it had a PLI one-off in there. Sudarshan joins us to run us through the con call takeaways and how he expects the stock to react. Morning, Sudarshan.
Morning, Nigel. So as you have said, by the first look, numbers look much better than estimates. Margin had come in at 14% against our estimate of 13%, but there was one-off, and because it was due to PLI benefits that company has factored in for entire year. Now, if you exclude that, margin was at 12.5%. That was largely in line with estimates. I'm going with green mainly because of 3 reasons. First, earnings were largely in line. Second, about the global market, company is saying that Africa has hit the bottom, and from here, it's only likely to grow. And third is that they are saying that domestic growth in FY26 is likely to be the same as the industry saw in FY25. Why it's positive for TVS? Because it's one of the companies which has outperformed all the other companies. 2 companies that have outperformed were Eicher Motors and TVS. So if FY26 remains the same, so it can be one of the outperformers. One thing which can be seen as a negative is companies say that Q1 can see some moderation. Why? Because last April there was a base effect, but companies say that May and June can be good because of marriage season. So overall, it's a mixed quarter, but I'm going with green because of the commentary related to global market as well as FY26 outlook.
All right, thank you very much for that. Well, Hexaware Technologies is the next one we're going to focus on. Reema is here with details. Reema, morning.
Hi, morning. So Q1 calendar year 25 for Hexaware was steady. The company reported a dollar revenue decline of 0.2%. Margins, according to the company's calculation, came in at 16.7%, an improvement of about 40 basis points quarter on quarter. Adjusted margins, because they adjusted for ESOPs, etc., is at 17.1%. No annual guidance, but they have given a color of how they expect the quarters to pan out. So first on Q2, they expect to deliver reasonable but not sharp growth. So this is positive because in Q1 there was a revenue decline. So they are expecting growth, reasonable growth in Q2. For Q3, they expect accelerated growth, and then Q4 they expect to buck back to the usual pattern and grow in Q4. So Q3, Q4 will be growth quarters, and these are not contingent on the macros. EBITDA margin guidance stands at 17.1 to 17.4%. And this again is the company's adjusted margin guidance. And to put it in context, in Q1, margins were at 17.1%. So 17.1 to 17.4% for the full year. Back to you.
Okay. All right, Rima, got it. Thank you very much for that. In fact, the management of Hexaware will be joining in to talk about their quarterly earnings and the outlook at around 9:40 a.m. So stay tuned for that. Okay, more stocks. Adani Green and Adani Total Gas. Let's see how the numbers were over here. Back to Sudarshan for it. Sud?
I'm going with green for Adani Green and red for Adani Total. For Adani Green, it was a healthy set of earnings led by power supply segment, and total revenue has increased by 8%. EBITDA was up 11%, and even margin has increased almost 300 basis points if you compare with the same quarter last year. And from power supply, revenue has seen an increase of 37%. Also, company has seen an increase in profit despite the despite an increase that company has reported in one-time loss. For this quarter, one-time loss was of rupees 166 crore against the 80 crore that company had reported same quarter last year. Also, power purchase agreement-based electricity generation was at 107% of company's target that it had given for FY25. Coming to Adani Total, it was a subdued set of earnings. Revenue was flat. EBITDA has seen a just increase of 1%. Margin has slipped more than 50 basis points. Even volumes were up just 2%, and it has come at 263 MMSCM. And the reason of subdued set of earnings because of the APM gas allocation cut that the entire industry had seen. For Q4, APM allocation for company was at 49%.
Okay, all right, sir. Thanks a lot for that. Well, let's hop across to Upasana. She's here to tell us about KFin Tech as well as Nippon AMC. Morning, Upasana.
Good morning. First up, let me start with KFin Tech. It was a miss across the board. The good performance in the international business of the company failed to offset the weak domestic mutual fund and issuer solution business. Now, other expenses also saw a sharp uptick of 6% sequentially, putting up pressure on companies' EBITDA margins, which were down nearly about 180 basis points sequentially. Now, coming to the numbers now, revenue stood at 282 crore with a downtick of 3% sequentially, and EBITDA stood at 122 crore, down about 6%. EBITDA margin stood at 43.2%. with a downtick of nearly about 180 basis points as mentioned earlier, and net profit also saw a downtick of 6% sequentially. So all in all, across the board, the weakness continues. Now coming to Nippon Life AMC, the revenue was in line with analyst estimates. Net profit was also higher than analyst estimates. This was mainly due to 50% rise in company's other income and lower tax rate. But when we talk about the key metrics of the company, that is the quarterly average AUM, that was down, and company lost its market share as well. Coming to the numbers, revenue saw a downtick of 4%. Revenue yields were also pressured, down about 60 basis points at 40.7. Operating margin of the company also under pressure, 115 basis points down at 64.5%, and net profit was nearly flat at 1% at 298 crores. So now talking about the quarterly average AUM, it was down about 2.2%. SIP AUM of the company was also down as high 7% sequentially, and company's average AUM market share was down 5 basis points overall. And if we talk about specifically equity market share, it was down 13 basis points sequentially. So all in all, going with red for both these stocks.
All right, Upasana, thank you very much for that. PNB Housing Finance is the next one we want to focus on. Abhishek has got details on this one. Abhishek, morning.
Well, this result was a fabulous one. Take a look. Net interest margin is at 6-quarter high of 3.75% versus 3.7% in the previous quarter. The spreads were at 2.19% when compared to 2.29% in the previous quarter. Asset quality, one of the best gross NPA ratio that you are seeing in last 22 quarters, coming in at 1.08% versus 1.19% in the previous quarter. Disbursements were robust over here, 23.7% growth YOY and about 27.5% on a sequential basis. So disbursal to AUM ratio, that's also improved to about close to 52% versus 39% in the previous quarter, and that helped the AUM growth. AUM growth was at 12.85% YOY and about 4.6% sequentially. YOY is the highest growth that you are seeing in last 21 quarters. So expect the stock to be in green today. Back to you.
Okay. All right, Abhishek, got it. Thank you so much for that. On to Rima again. Rima, first source. How are the numbers?
It's actually a pretty good quarter for First Source. I'm going to go with green. For starters, in Q4, there was growth, 2.1%. Margins maintained at 11.2%. And not just that, the company is given a guidance for FY26, which in itself is positive, and the guidance, according to analysts, is very healthy, 12 to 15% in constant currency terms, though it does include about a 3% benefit of the acquisition. Margins stood at 12.25 to 12%. Also, the company said that in Q4, their dollar revenue run rate quarterly hit $250 million, 4 quarters ahead of guidance. So Q4 was strong. FY26 guidance at 12 to 15% is healthy. So it's a good quarter by First Source.
All right, Rima, thanks a lot for that. A good quarter coming in from there, but some pressure on Tata Tech is what you're expecting today?
Yes, so expect a block deal today. TPG is planning to sell about 15 million or 3.9% of its equity in Tata Tech. This will happen at a price of 670 to 695, which is a maximum discount of 5% on where the stock closed. TPG had sold even last year. They're again doing a block deal as of March. Their stake was 6%, and they want to sell another 3.9% today. Back to you.
Okay.
All right, Rima, thanks a lot for that. Let's do a quick recap of all the top stocks we laid down for you, the ones with positive news flow. Ultratech, TVS Motor, Hexaware, you have Adani Green, PNB Housing Finance, and First Source. While the stocks reacting to negative news flow include Adani Total Gas, KFintech, you have Nippon AMC, and Tata Technologies.
All right, well, that's a list of stocks that are going to be on our focus. Now, IndusInd Bank has announced that its deputy CEO, Arun Khurana, has resigned with immediate effect weeks after the lender disclosed accounting lapses in its derivatives portfolio. Ritu's she gave us a heads up, and now we have the news. Ritu, give us the details here.
Well, thanks for that, Prashant. In what is clearly a fallout of the accounting discrepancies in IndusInd Bank's derivative portfolio, you now have the Deputy CEO, Arun Khurana, resigning with immediate effect as of yesterday. We had reported this a couple of weeks ago, where Khurana was overseeing the Treasury Front Office, which is the division responsible for the derivatives portfolio, where this incorrect accounting led to a near 2,000 crore hit on the bank's P&L. And in his resignation letter as well, Arun Khurana has cited these recent unfortunate developments that he calls linked to the discrepancies and P&L hit as the reason for the decision. Now, the resignation comes just a day after the bank disclosed that an independent investigation had identified key individuals who were held responsible for the discrepancies, and the bank had then said that the board will determine changes and realign the senior management responsibilities based on the report's findings. Now, we understand, of course, this independent investigation was conducted by Grant Thornton, which has pegged the adverse financial impact at about 1960 crore rupees, very close to the 1979 crore rupee hit that was determined by the external auditor, PwC, which the bank will now account in its fourth quarter earnings, which is due in a couple of weeks. Arun Khurana's exit is only the second major departure from the bank in recent months, after the CFO had resigned in January, even before the discrepancies were disclosed. And meanwhile, as we've been reporting, RBI has cut short the current CEO's tenure to March next year and asked the board to submit potential candidates by October.
All right, Ritu, thank you very much for that. So that's IndusInd in focus. I mean, lots of news flow over the last many months now, culminating into this. 830 is where IndusInd now finally left off yesterday. Let's talk about commodities and what's the action there. Manisha is here with what's top of mind. Manisha, good morning.
Morning, and thank you for that, Prashant. I'll start with the gold prices, which seems to be reversing some losses. Yesterday, we saw prices fall below $3,300 an ounce. We're trading around $3,320 or 30 thereabouts. The cautious sentiment is on ahead of the U.S. economic data. Remember, today you have the U.S. consumer confidence numbers coming in, and tomorrow, employment data, first quarter GDP numbers, home sales, and also Bank of Japan monetary policy meeting. So ahead of that, you have seen gold prices gain up slightly. What hasn't done well has been the crude oil price. Is down 2% overnight. Remember, OPEC is going to increase production for the month of May and June as well. And the U.S. output is near records as well. Discounted barrels from Iran and Russia have continued to add to Asia inventories, and that has taken crude oil prices in the negative on a month-on-month basis and for this year as well.
Okay, all right, got it, Manisha. Thank you very much for that. So that's a roundup of all the key stocks plus the commodity headlines. Take a break, come back on the other side. We'll have Avnish Agrawal of PL Capital joining in for some fundamental stock talk.
investing.
Welcome back. You're tuned into Bazaar Morning Call and hope you're having a good morning. Well, we've listed down all the top stocks that you need to track, but let's get a little bit more fundamental analysis going. We have Amnish Agarwal, the Director Institutional at Prabhudas Lilladher, who joins us, PL Capital, who joins us. Hi, Amnish. Thanks a lot for joining in. Amnish, I wanted to ask you about a couple of companies that came in with their results towards the end of trade. One is UltraTech Cement, the other one is TVS Motors. Your reading of those numbers, for UltraTech, everything was pretty much okay. Barring in the near term, they're talking about some pain, and that's because of the intense heat. Otherwise, things were okay. And on TVS Motors, the stock saw a sharp spike. But, post-market hours, we got to understand that, in fact, there is a one-off in terms of the PLI that was accounted for. Your take on both these two?
Yeah. Hi, Nigel.
Hi.
You see, if you look at, say, UltraTech, you see, these are weather-related conditions. They are, I think, all temporary, and we had very intense heat waves even last year. And the main thing here is that they are looking at expanding their margins over the next couple of years in some of the recent acquisitions, and they are banking a lot on the operational efficiencies which might come from renewable and other sectors. So UltraTech, I think the numbers look reasonably good. Is there a very big upside in the near term? The answer is no. But UltraTech remains one of the best stock, or rather the best stock it's like a portfolio stock in the cement space. If you want to, you can say, play the India, you can say the entire infra story, the entire, you can say the housing story and all. UltraTech is more like a portfolio stock, maximum capacity, most efficient player. So from that angle, the company continues to look reasonably good. Now, when it comes to your TVS Motors, you see TVS Motors, I think in the entire two-wheeler space, one of the larger companies, it is growing best in terms of volume. This quarter, there was a PLI gain due to which there was a prop-up in terms of margins. But now if you look at the numbers, the stock currently is also trading at something like 27, 28 times on FY27 earnings. So that has been an issue with TVS Motors, that despite it being, you can say, the company growing at the fastest pace, and in terms of EV penetration also, or the share gain also, it is doing well. It is on, I think the issue is only with regards to valuation. Otherwise, in terms of pure volumes, product launches, and other factors, I think TVS continues to be a very decent player.
Okay. Got that. Amnish, hi, morning. Just want to discuss some of these mid-cap tech earnings that have come. First source, there's some growth there. I think 2% constant currency top line growth, but Hexaware seems to have faltered. What are you liking in mid-cap tech? Of course, Persistent was, I think till now, Persistent has been best in class in terms of tier 2 technology, growth intact. But what do you like, if anything?
You see, tech as a space is not doing well. Although you can say the TCVs of many companies, they are not showing any big issue. But the conversion is not happening at the current juncture. Whether it is, you can say, larger companies, or whether you look at the smaller companies, I don't see a probability of any acceleration in the growth rates happening over the next 3 to 6 months at least, till the time this entire uncertainty around the tariffs goes first. And secondly, even in terms of, say, you look at Europe and all this, so they have been reeling under some sort of a recession for quite some time. So I think Persistent is a stock actually which has been doing well. And this is I would say, in the mid-cap space, this seems to be the best placed company. But having said that, if you look at the valuations of Persistent, they are, I would say, they are cut above the rest. So even the larger stocks where they are trading at, say, something like today, anywhere between 18 to 20, 21 times, Persistent is trading at a significant premium. But as such, I think at this point of time, it is more, you can say, the short covering and all. But otherwise, I think tech is a space which will show pressure on numbers even for the coming 1 or 2 quarters.
One more word since you're talking about tech. What about Coforge? That's Sabre. That is the global listed company. It was up 15% overnight because they're looking at, deleveraging their balance sheet. And the fear was that, their balance sheet wasn't in good order. That's why when they did a collaboration with Coforge for around $1.5 billion, the street was a little bit skeptical. Now, if their balance sheet is in better shape, this could be a bit of a fillip for Coforge, though it's not, in fact, very, very cheap. Your view on the stock, because you have that news flow, then you have them selling some stake in one of their subsidiaries, and you have their results early next week. Your take?
The Q4, I would say it's an exception, and the stock was actually languishing at a low level. But now, if you can say if there is some deleveraging happening in one of the companies, which is you can say related to them, and I think the news flow around Q4 is likely to be on the positive side, and it all will depend upon what they actually you can say declare in their numbers in terms of say your orders or in terms of the outlook. But the news flow around Coforge has been, I would say, reasonably positive, and that is one reason the stock has also shown a significant uptick in line with some of the other stocks.
Okay. All right. Amnish, got it. Thank you for some of those inputs. We do have to now touch base with our first management on the show this morning. CSB Bank is on our radar. The bank reported a mixed set of numbers for the fourth quarter. Profit after tax came in healthy, but net interest margin has slipped. To talk about this and the outlook ahead, we have Mr. Pralay Mondal, MD and CEO at CSB Bank, joining in. Mr. Mondal, good morning. Thank you very much for being with us. I think I'm just going to cut to the chase and get to the heart of it, because these days the market does get jittery whenever there is any increase in credit cost or, anything where there is a miss. It's the market mood. Let's actually start with this decline in the net interest margin. You are at, I think, 3.75% versus 5% last year, and even quarter on quarter, I mean, you were above 4%. Why this dip? Is it temporary? Do you hope to reverse it this quarter?
Good morning, Shurvi, and good morning to all your viewers. Yes, you're right that we had a slight dip this quarter in our NIM. It went to 3.75. The guidance had been we will be between 4 to 4.3. That had been where we have been talking about. But this quarter, we had three specific issues. One is obviously because of the huge liquidity issue which was there for almost half the quarter or more than that. We as a bank who is still building the liability franchise, so we took a lot of funding structures because we wanted to grow fast. And I have always said that we will prefer growth over margins. And from that perspective, we had a huge growth which we had in play, and we grew by 30% year on year on our asset book. So there we were sitting on some excess liquidity for 2 months because most of the growth came in the end of the period, which ended up in ensuring that we trade on the treasury side on that and make some good profits on the trading income, but it really depleted the NIM. So that's number one. Number two is, of course, our business mix also are undergoing some change. The wholesale banking started picking up. The SME has started doing well. So that also plays a little bit. Then the third very technical point which happened last quarter was because our overall funding book has FCY borrowing, which is almost 9% of our funding book, which was almost next to zero last year at the same time. And that went through a blip because of the global challenges which we faced. And the hedging cost went up for a temporarily. I mean, that has also come down now. So it is a blip for a quarter, and that significantly impacted the margin last quarter. So fundamentally, these are the three reasons which we got in. Going ahead, I think we are very...
Mr. Mondal, good morning, Prashant here.
Hi, Prashant.
The last point, sir, this is foreign borrowing.
Foreign borrowing, FCI borrowing, foreign currency.
What is the foreign borrowing and what's the cost now?
So foreign borrowing is, for us, is around 9% of the book, which is around 3,300 crores. And that cost is generally supposed to come down. The reason we took it was because so far it's SOFR linked. And from that perspective, it was supposed to come down this quarter, but because of the hedging cost, it went up. But it's a temporary blip because it has come down again. So it is a one-off kind of a scenario. The cost of that is generally below 8%. It is between 7.5 to 7.75. But in that quarter, because of the hedging cost, it went higher than 8% and significantly higher than 8%. But again, that was a one-off kind of a scenario which nobody can predict. It will come down, and with the SOFR coming down, it will of course come down significantly.
You were continuing. You were talking about the road ahead.
So road ahead from Prashant, I will say
on NIMs,
that our NIM guidance remains intact somewhere around 4%, and hopefully a little higher than that. And last whole year NIM was around 4.13, 4.14 in that range. So we'll be somewhere between what we ended this quarter and what the whole year NIM guidance was. So from that perspective, I think we should be hovering somewhere around 4%. But growth has been very, very good for us, and that has helped us in overall increasing our profits by 25% year on year, and quarter on quarter also it grew by 25%.
Okay, all right. Hi, Mr. Mondal. Good morning. Good to see you, Ben. Give us a couple of more details then. The outlook in terms of growth, both in deposits as well as credit growth, if you could help us out with a broad range out there. And also your asset quality, on a relatively low base, there was some increase. If I look at your gross NPAs, there was a little of a spike. Slippages were a little bit higher. So what's the numbers we should be working with for FY26?
So, Nigel, good morning. Yes, I think from a growth perspective, we almost grew by 30% on the asset and 25% on the deposit, which is significantly higher than the system. And we'll continue to grow anything between 20 to 25%, and that we are pretty confident now. Of course, it depends on how the funding structure looks out. On the NPA and slippages and credit cost, let me put it this way, that in spite of all this, we have ended the year with 29 basis points credit cost, which is not bad by any means. We generally guide around 20 to 30 basis points. So we are in that range. Having said that, last year was very different. And this year we had, again, 2 or 3 specific issues. One is the unsecured and the MFI slippages. And when you take that slippage, because we take upfront provisioning a lot more there on the unsecured and MFI side, that created some issues. But good part is that book is now actually less than 3% for us, including credit card is 3.3%. So that book is running down significantly. The second part is we had a migration provision this quarter for the one account we slipped last year. From that perspective, the migration provision has come again in this quarter. And third is, of course, we have taken some against security, because generally regulatorily you don't need to take any prudent provisioning against security deterioration unless it's below 50-60%. But for some of the accounts, because we could afford this quarter, we have.
Mr. Mondal.
Yeah.
Sorry, sir. I mean, just to make it a little simpler for our viewers, many of them would be your shareholders as well. So on credit costs, the spike that we've seen in the fourth quarter, will it reverse in Q1? What is your guidance on credit cost for this year, FY26?
So FY26 credit cost should be below 30 basis points. Last quarter was a little higher than 50 basis points. It will go below 30. And hopefully we should be able to contain between 20 to 30 pretty comfortably next year.
Okay, Mr. Mondal, always a pleasure talking to you. Thanks a lot for joining in. Wish you all the best for the coming fiscal. And we'll keep chatting up with you as the year progresses. For the time being, though, we'll slip into a short break. You come back, we'll have Sudarshan Sukhani as well as Mitesh Thakkar who will be joining in to give us their technical trades. Don't go anywhere.
Okay, welcome back. There's 10 minutes to go for the pre-open session. There's some more help on the liquidity front from the Reserve Bank of India, and unexpected. So RBI said that they'll buy an eye-popping 1.25 lakh crore of bonds over the next 4 weeks. Lata is here with the motivations, at least what we can gauge. Lata, over to you.
Well, it's a massive number, 1.25 lakh crore. Even in the past few weeks, when there was liquidity crunch, they didn't do such a huge purchase of bonds. And now actually the market has over 1 lakh crore of surplus liquidity. And therefore, this is very surprising. Market is coming with two sets of guesses from the people I spoke with. One guess is the Reserve Bank had a lot of forward sell dollar positions. I mean, no, that, you know, they did buy-sell swaps in the past 4 months in the run-up to March, run-up to April, and therefore that buy-sell part of it is maturing. 80 billion we knew as of February were in their books, and maybe 30-40 billion is maturing now. And that is why, you know, when you sell the dollar, you're pulling back rupees. So they're trying to replenish it. But it is surprising because anyway there will be a May dividend. So why are they doing this? The other set of reasons is that over the year, the Reserve Bank expects that there will be a shortfall of 4 lakh crore. Why will that happen? Because you and I will withdraw cash. During the festival season, every year 2 lakh crore gets withdrawn by customers. Another 1 lakh crore gets set aside by the banks as cash reserve ratio. Every time you take a deposit, you put 4 rupees away as cash reserve. That is another 1 lakh crore through the year. And a final reason is that Reserve Bank owns about 1 lakh crore of bonds which will mature this year. When it matures, the money is paid by the government to them. That again takes away liquidity from the system. So this 4 lakh crore, maybe they are front loading some of it, is what one set of guesses are. They believe the forex is not a good explanation because enough forex flows are coming from equities and bonds, and that will neutralize what Reserve Bank sells. So probably this is the reason. Be that as it may, we are more interested in the impact. Impact will be bond yields will definitely fall back towards the 6.3% mark for the 10-year. And for banks, it is manna from heaven. Expect them to go boom, boom, boom because, you know, deposits can be cut more easily. Liquidity is available. And of course, their mark-to-market on the bonds also will be higher.
I like that explanation, Lata. Boom, boom, boom. All right, well, yields lower and financials as a space perhaps gets some more help at the margin. Lata, thank you very much for that. Well, let's just quickly run you through the trades that you need to be putting on. Sudarshan and Mitesh are with us to tell you what you need to do and how you need to position yourselves. Gentlemen, morning. Great to have both of you here. Mitesh, you go first. How are things looking? I mean, yesterday was a complete reversal. And by the way, Sudarshan, to you, congratulations. I think you were saying that the correction is over. So it lasted exactly 1 day after almost 2.5 weeks of up move. That is yesterday. And I'm going to come to you on that. But Mitesh, you go first. How are things looking this morning?
So, Prashant, maintain this view that, basically the market is likely to consolidate with 23,850, 900 as the lower end of the range and 23,500, 550 as the upper end of the range. So I think we will be in this base building activity for the next few days. Yesterday we were on the buying side. Today I would advise, in case you get closer to about 23,450 plus levels, I think that will be a time to take some profits off the table and then trail your stop loss and see if there is strength to get past the upper end of the range.
Okay, got that. Sudarshan, what would your trades be? I mean, the GIFT Nifty is indicating a 50-point up move.
Good morning. See, the market was a buying opportunity yesterday. That continues. Now, the Nifty is also in a trading range, and we have support resistance somewhere around 24,400, which is almost where the markets are going to open. I'm assuming that this resistance will be overcome, and if that happens, then we have two factors to fuel the rise. One is an ongoing uptrend that started yesterday after a small correction, and second, a breakout from a trading range. So I would be a buyer. Now, where exactly you buy, as yesterday also I explained that is a matter of tactics. If you are long, stay long. If you find any minor dip in intraday dip, early morning dip, go long. But primarily in the bank, in the Fin Nifty, as well as in the Nifty, there is an opportunity to stay long.
All right, let's focus on individual stocks then, gentlemen. Sudarshan, you go first. Tell us what's on your radar.
Well, it's an all-buy list with primarily mid-caps. So Zydus Life is a buy with a stop under 868. Glenmark is a buy, the stop under 1384. From the financial space, Manappuram, and if you see the charts, it has been rallying consistently. Manappuram, that's because of financial services, not gold just. Manappuram is a buy, the stop under 227. And Siemens, after that ex-bonus price drop, is now again an opportunity to go long, to stop under 28.50. It's spread across sectors because I think the markets have discounted all kinds of bad news.
Okay. All right. Got it. Let's come to Mitesh's stocks as well. Mitesh, morning to you. So what's the list like today?
Morning should be again an all-buy list for me as well. ICICI Bank is a buy with a stop below 1400 for targets of 1480. Bank of India is a buy as well. Keep a stop at just below levels of 116. Look for targets of 124 half. A buy on Bharat Forge with a stop below 1100 for targets of 1160, and BPCL is a buy. Keep a stop at 304. Look for targets of 325.
Okay. All right, gentlemen. Thanks for the calls. We'll come back to you a little closer to market opening. Take a break and we'll have the pre-opening rates. Also, we will be talking to the management of IRFC about their fourth quarter numbers.
Okay, welcome back. We're, of course, tracking the pre-open rates, which will start to come up in about a minute or so now. And it should be higher. The GIFT Nifty has been indicating a 40-50 point up move. And then we pick up from that point on. Amnish Agarwal has, of course, been sort of speaking with us with his perspective, with his thoughts. Amnish, thank you for waiting. I just wanted to get a quick sense on this entire Apple news flow, which is a big one for the industry, really. But from a listed perspective, do you think there are any opportunities at all? The news that for all the phones, iPhones, which are going to be sold in the US, I mean, the company is saying that they want to make those phones out of India.
You see, if that happens, I think it could be actually beneficial for India, not directly but indirectly, because we are currently in the process of setting up the entire system. And it is, you see, when it comes to purely assembling the phones, there is very limited value addition which happens over here. But when it comes to looking at the, you can say on the ancillary side, there's a lot of scope then to set up the infrastructure for the semiconductor, for other components, etc., which go into that. And I think the major, I would say, gains will lie over there. Okay, so I think it is a positive news more for the EMS companies or the companies which can then collaborate with Apple and they start manufacturing the components over here.
Stocks like Dixon, etc., typically perk up when you have this Apple-related news flow. But the point is, so far, from the listed universe, nobody is part of that sort of ecosystem, that value chain. with regards to Apple. I mean, Dixon, etc. Of course, they've got the entire Android phones on there, and they make them for all the bigger sort of Android brands.
But Prashant, maybe right now I've seen that report, but maybe it's easier said than done, because unless there is a rollback in the US administration sort of thinking, iPhones were one of the things. I mean, these iconic items, right? iPhones, the motorcycles, the bourbon whiskey. There's constant chatter about why can't these phones be made in the US. I mean, logic probably is a different argument. But let's see if they can be allowed to ship the entire manufacturing going into the future to a country, including, of course, India.
I was told that there is apparently right now a 20-25% difference between the cost of production between China and India. And what happens is that if these tariffs in China go up more than what they go up in India, it makes more sense. That seems to be the motivation. Now, of course, if they want everything to be made in the US, that is, of course, far tougher than moving it out of China to India.
Yeah.
I mean, the cost will go up, I don't know how many.
Dramatically, yeah.
Dramatically.
Yeah, absolutely.
But, a couple of, just one word on this, a couple of leading EMS players, they have said that their phones have been ringing non-stop. So inquiries have gone up dramatically. We'll try to quiz them when they come on the channel, but I know, that's the word that's coming.
Absolutely, and even I remember our conversation with Dixon, very small, minuscule portion, but they do some work with not Apple as of now, but with the different clients in the US. Anyway, the pre-open, by the way, has started, so let's take stock of it. About 30 points higher, that's what we're getting in the pre-open. Let's wait for the rate on IndusInd Bank to settle, maybe. It's right now in pre-open is showing down 9%. The thing is, this is not entirely unknown. Like we've been saying, Ritu was pointing this out, that there will be other senior level exits. And that's exactly what happened yesterday. But for what it's worth, I don't know if Amnish is still with us. Amnish, if you can hear me. Very quick last call. IndusInd Bank, 7:55 now after this news.
You see, IndusInd Bank is getting spate of bad news one after the another. First it was MFI, then this year entire, you can say, losses which were there in their derivatives and treasury. So I think one thing is very clear, that there is going to be a very, very big change as far as the entire, you can say, the top management of IndusInd Bank is concerned. And now the main thing is, if you can say your deputy CEO or the person of that stature goes, it means that for the top two jobs, IndusInd Bank will have to now look outward for a candidate. But having said that, if you look at the past history of IndusInd Bank over the last, say, 7-8 years, then it is the second time it is happening, and every time you see stock gets better to even 500, 600 rupees. But inherently, I would say the business model is not bad. They need to put checks and balances in place. And I think over a period of time, the stock has recovered in the past also. So I think it might have some kind of an initial reaction. But I think if they put their house in order, if they tighten their, or you can say, compliances and all you can say regulatory stuff, I think that this could be a stock to watch out for, because the MFI trouble for all the banks is any which way is going to be over, say, in another couple of quarters. So yes, it's a high risk bet at this point of time, but definitely I think all these changes are expected, and more might happen over the next few months.
And the stock, by the way, is already recovering, and that's the point that Amnish, I think, is also alluding to. I mean, if they're cleaning house with a fresh new set of management is going to come in, and it's already well advertised, as we've reported, others, of course, reported after us as well, then I don't know if this, the 9% cut's gone. I don't know if even if this 5% cut will remain, and it should come up. Yeah, I think it already is. It's flat. I think now it's the real rate. It was just the sort of pre-open thing which was happening. But otherwise, I mean, I think, wouldn't be surprised if it goes the other way. But 8:30 now in the pre-open with about 4 minutes in. Najil, but we have the management of IRFC with us.
Well, that's right. And I think on Sami Hotels, we have a large trade that's taking place. So just keep an eye out on that. We had the news flash at the bottom of your screen. But as promised, IRFC, that's the next management on the show. It had a little bit of an off year, actually. It is quite a weak set. The AUM declined, the net interest margin was a little bit weakish, but we want to understand what the management has planned for the coming year. So to help us out with that, we have Mr. Manoj Kumar Dubey, the Chairman and Managing Director at Indian Railway Finance Corporation. Hi, Mr. Dubey. Good morning. Thanks a lot for joining in. Well, let's get straight to the point then. AUM declined on a quarter-to-quarter basis. What happened? And if you could tell us, what kind of growth are you projecting for the coming year? That's FY26. Please go ahead, sir.
So, Prashant, as you know, FY25 we closed on a very steady manner. And the reason for a flattish kind of result is, the fact that for the last 2 years we hardly had any disbursements after doing so well till FY22-23. The reason was Railways was not asking for any disbursement through extra budgetary resources for the fact that government budgetary supports were very high for the last couple of years. So in the last quarter of FY25, we decided to diversify, and that perhaps is going to be a game changer for this company for the fact that in the last 40 years, we had only one client relation with Indian Railways. And the margin there were in terms of 35 bips or 40 bips. Now we have started diversifying in all the assets that are helping to the Indian Railways or the railway per se. And as you know, in the last 4 months of this calendar year, we have already mopped up around 14,000 crores of loan assets. And if this trend continues, we feel that we are into a very exciting times for the fact that with these kind of loan assets that we are garnering, our margins are very high. Yeah.
Right. Mr. Dubey, we appreciate you giving us some clarity in terms of how do you see things pan out going ahead. But we're looking to a couple of numbers. To disbursements, what do you target for this year? What does it mean in terms of AUM growth? And where does the growth come from? Please take it away.
So the growth is coming out from all the assets which are having backward and forward linkages with the railways. And as you know, we have already started participating in the bids. 3 bids on the trot we won in the last 3 months, mopping up around 14,000 crores. What is exciting for IRFC is the fact that the margins that we are going to get out of these bids are nearly 2x to 3x of what we used to get from the railways. So typically, if I give you a number that say in FY26, we are going to disburse around 30,000 crores. It will be akin to nearly 90,000 crores of disbursement to what we used to do to the Indian Railways. So in these terms, we are finding that there is a lot on the platter. In fact, we are trying to diversify on the metro railways and in the rapid rails also amongst the metros. So those businesses are also going to be very attractive for us. Yeah.
Sure. Mr. Dubey, absolutely get your point that you're looking to go beyond just the Indian Railways to newer areas of growth. So give us some sense. Where, when you close the year FY25, what is the total size of the book? And as this, slight tweak happens in the business itself, what will your target be? I mean, where will your total book size be this year? What will be the fresh disbursements? How much to metro? Some sense of a number. So we understand how much is IRFC targeting to lend this year?
So on the ballpark figure, we are targeting around 60,000 crore of sanction this year. That we have taken the approval on the board yesterday also. And we are, on the conservative manner, we are looking for around 30,000 crore of disbursement this FY. And what I was mentioning, Swati, was that the fact that this 30,000 disbursement, if you are able to do it, it will be akin to disbursing around 90,000 crore to Indian Railways for the fact that our margins will be quite high than what we are getting from the railways.
Okay, all right, Mr. Dubey, this is Nigel on this side. With me is Surbi. And Prashant as well is joining us. So just want to clarify on that. And we appreciate you speaking to us here on CNBC-TV18 News. Just clearing that point, sir.
Good to Surbi, yeah.
Yes, sir. Surbi here. So, okay, we've got your numbers, 60,000 crores of sanctions, 30,000 crores of disbursement this year. Yeah. Now let's talk about margin, because you're saying you're targeting these higher margin orders, which could be in metro, etc. So what is the targeted NIM range for this year?
Yes, so NIM, as I'm repeatedly mentioning, and I talked about this in my con call also last quarter. As you know, railways, my margin used to be 35 bps for projects and 40 bps for rolling stock. Here, my margin is going to be around 100 bps to 150 bps. So typically, what margin I used to get from the railways, it will be nearly 3 times of what I was getting. So that is very exciting for us. And this will surely have a very good impact on my bottom line. My top line may not be growing very huge for the fact that numbers that were coming from the railways may not be in those lines. But I can assure you that because NIM is going to improve every quarter now, so my bottom line will be showing a very good, steady upward trend.
Okay. All right, Mr. Dubey, you want to give us that number? As we understand, non-railway business is much more lucrative. But if you want to give us a NIMS number, could you help us out with that, an absolute number? And also the AUM growth for the year, could you help us out with that? Last two details before we let you go.
Pardon?
AUM growth and NIMS absolute number. Please go ahead, sir.
NIM is right now around 1.4, but the kind of NIM that we are expecting should be more than 2% going forward with the mix that we are trying to look forward to.
2% NIM, okay, with 60,000 crores of sanctions and more business coming in from the non-railway segment. That's how FY26 is looking like for IRFC. Got it. Thank you, Mr. Dubey. As of now. Thank you very much. Thank you.
All right, Mr. Dubey, thank you very much for that. Well, I'll just quickly run you through the 9-10 calls now. Sudarshan and Mitesh are back with us. Sudarshan, what do you have?
Well, Manappuram, consider buying Manappuram with a stop under 227.
Okay, and Mitesh?
Pulse. I think that's the buy call which I would recommend for a target of around 1162 million.
All right, there is Manappuram and then there is Bharat Forge from Sudarshan and Mitesh, respectively. Gentlemen, thanks very much. Those are starts in the pre-open as they are coming up. Zensar is the company that we want to talk about. A decent set in the fourth quarter. And just want to kind of play out a few sound bites. We, of course, spoke with Manish Tandon, MD and CEO at Zensar Tech, on the potential impact of tariffs and demand in F526. Listen in.
Tariffs, etc., have been, this whole process has started towards the end of Q4. And that process is still playing out. There have been increases, there have been reductions, there have been takebacks, and so on. So there is a lot of uncertainty just now in the markets. And we are not very sure how this whole thing will play out. So I can't predict what is going to happen for the full year. But I can say that as a company, we are committed to generating growth come what may. And we are geared up towards trying to make the best of whatever is the situation that rises. And that is to some extent reflected in our order bookings. Till now, we have not seen deal cancellations or pause in ramp-ups. But we have seen certain right shifting of demands. So what I mean by that is, when we entered March, for example, we felt that we will be able to do X. The demand was for X. And by the time we finished March, what we found was that it was slightly X minus. Right. So, and it's not that things have been cancelled. What we saw was a lot of things have shifted right to the next quarter. Associated sectors also, travel and hospitality has also, there is some right shifting of the demand. Healthcare, there is some right shifting of the demand. So we are seeing trickle down effects on other sectors also. As of now.
Okay, there's about a minute to go for the market open to come up. I don't know if you can quickly put up the auto ancillary stocks, Uno Minda, Samvardhana Motherson, and those names. I saw some sort of gains come through in the middle of the pre-open. Uno there, Samvardhana Motherson, etc. Also coming up on your screens at this point. There is a reportage which suggests that those tariffs on auto components which are supposed to go into effect on the 3rd of May, there may be something done later tonight. In terms of postponement, etc. We've seen similar stuff done for Canada, Mexico. Will we see something similarly done for China as well? So we'll of course look at that. But it's a good start. I think we are higher. 24,372 is the pre-open, 24,330 is the open, and 60 points in the green. Nifty Bank is up about 1/3%, the Sensex is up about 1/4%, the Midcap index is up 0.64, and I think the small cap index is also higher to begin the day. So very, very good start after yesterday's super kind of reversal from last Friday. essentially is what we had. So 24,400 plus now on the Nifty. 24,545 or so is that level which we put out at least for about 15 days now. 61.8% retracement of the entire fall that the market has seen. And we are about 130 points away from that level. Let's just quickly look at the heat map. Gives you a snapshot view of how things are starting. And then we'll get down to individual stocks because that is where a lot of the action is coming through. So it's mostly all up in the green. I think you got about 5 odd Nifty names which are starting in the red. And as we were sort of saying, IndusInd is very much in the green. Surabhi.
Yeah, IndusInd is starting positive. It's actually the Nifty winner, almost 2% higher. Actually, a couple of lenders are making big headlines. I was looking at beyond the Nifty, UCO and PNB in particular, both reacting to numbers. And for UCO, the business growth has been very, very strong. The deposits are up almost 5%, advances quarter on quarter, I'm talking about. Gross NPA levels have declined. For PNB, I think margins are at a multi-quarter high. So these two stocks are really hitting it out of the park this morning. Anyway, back to the Nifty gainers. IndusInd Bank is in leadership position. But beyond that, BEL 1.5% higher, Tata Motors, Adani Enterprises. Then you have some big stocks like SBI and L&T, which are notching up gains of about 1%. Trent, ahead of its numbers, is up 1%. Titan, Eternal, so fair bit of consumer discretionary plays, doing quite well this morning actually. All about 1% higher, M&M 1% higher, Maruti is up. So auto, we're seeing some buying in auto overall. Actually, hardly any weakness on the Nifty. There's a little bit of a cool-off in maybe Sun Pharma and maybe Grasim. But guess what? Not even a single Nifty stock is down more than 0.5%. It's a strong, strong morning. And look at the Nifty charging ahead. It's broken out of this consolidation band that I was talking about in the morning. Now we're trading above 24,400. So it's absolute leadership and dominance. And the midcaps are doing even better, Nigel. The midcap index up 1%. So it's a flyer of a start.
Well, that's right. A couple of stocks reacting to large trades that have taken place. Sami Hotels, yesterday there was a large trade. I think this morning as well there was one. The stock has opened up with a gain of closure around 4%. Tata Tech, though, I think there was a large trade that was expected. I think that's got cleared out, and that explains why the stock is down closure around 5% in today's trading session. So let's get both those two up. Sami higher. We have Tata Tech that is lower in trade. You have Fino Payments, the FY25 revenue was in line with guidance. Throughput was up by close to 27%, but that stock has come in for some profit booking. You have RPG Life, that's the other stock that I'm looking at. Well, those numbers I think came in overnight. And I think they look quite good. So that's one of the stocks that's perked up in trade. Big gap up is what we're seeing on that particular name. A couple of stocks that did fall yesterday big time. Case in point being Tejas Networks. That's opened up mildly in the green. So let's pull that stock up. RPG Life now bursting away, up close to around 10% as we speak. We'll try to get the management on the show. Tejas Networks, I think it had opened up mildly in the green. And the other one was SML Isuzu. Both of them got clonked back in trade. But SML Isuzu as well, it's trying to find its feet. It opened up with a cut of around 5%. Yesterday it was down 10%. Now, in fact, it's holding with a cut, I think, of around 2% or thereabouts.
I just want to mention that PSU banks are charging ahead. So UCO, of course, on the numbers, but even the others, Central Bank of India, Punjab and Sindh Bank, then I saw IOB pop up as well. In general, PSU banks leading the charge this morning. That index is the best performer at the start.
And just one more stock from the tech pack. We had pointed out Coforge, Sabre, the global company. They have had a problem with their balance sheet. But they went ahead yesterday and they sold part of one of their businesses, and that will help them deleverage. They had signed a partnership with Coforge, and the street initially got excited. Then they were questioning whether or not it can get executed, but they're going to get their book in order. The read-through is maybe, in fact, that deal as well sees the light of day. Could explain one of the reasons why Coforge is doing a relative outperformance.
And Coforge, I think, is getting a little over 400 crores from this exit, if I remember the numbers. I'm not sure.
No. So the deal is with Sabre. Sabre is the one that's getting the money. That's the one that did a collaboration with Coforge for around $1.5 billion. So there was uncertainty whether or not the deal will actually see the light of day. Now with them deleveraging their balance sheet, that's the global company, Sabre. The possibility is that it gets a green signal. So that could be the reason why the stock is in the green.
Okay, results on the 5th of May, Coforge, and it's a name we've highlighted for some time now as potentially, a stock where there is a large disconnect between, or at least there was a disconnect at $6,000 from where it has recovered about 1,500 rupees between actual growth rates and what the market has beaten it down to. So very sharp gains. 100 plus points on the Nifty is what you have. So 24,430 on the index, and it's looking super good. You got about what, 7:1, 8:1 advances to decline ratio. It's still early, stocks are still opening up, etc. But for what it's worth, for now, it's all on one side, mostly everything on one side, which is on the way higher. Tejas Networks was down sharply yesterday. It's up about 2.5 right now. There is Paras Defense, which is up 4%. I'm not sure there's any news flow. And I was talking about auto ancillary companies, right? I mean, look at Sona Comstar, 4% gains. And these are all coming with solid gains. Bharat Forge is up 3%. Bharat Forge, I think, was also a call from Mitesh in the morning. And there is Motherson, which is up 2.5%. So Auto Angs as a pack is doing well this morning. I'm not sure, is it with regards to this news flow, pause as far as these auto tariffs. 3rd of May is essentially when they're supposed to come into effect. RK Forgings is another one. RK Forgings was sharply down in the morning. Yesterday, it recovered quite a bit. That issue of inventory mismatch, promoter essentially saying that they are putting in money. And of course, there was a con call as well. We spoke with them. Stocks about 2.5% higher. Still not come up to the levels from where it fell the week before last. Last week, it was down about 12-13% or so. But otherwise, I mean, it's a pretty good-looking screen, I have to say. Surabhi?
Prashant, on auto, I don't know if this is what you were referring to. But there was a Reuters story that I was reading that seems to suggest that Trump and his administration is in very close talks with US automakers, and they've agreed to remove, I think, duties from specific parts, components which are needed.
So those tariffs are supposed to come into effect on the 3rd
of May. Yeah.
And I mean, some deal may, I would say, the report said tonight we may actually see something which may
This is, Lutnick is on record to Reuters, a statement saying that there will be a deal and a lot of the components which are required, they will be exempt.
Absolutely. And we'll, of course, as and when that happens, we'll try and speak with Indian companies as well if there is any implication whatsoever. But for now, I think there is a bit of a bump which is coming through. Ajay Argal is with us, Senior Vice President and Portfolio Manager, Emerging Markets, Equity, India at Franklin Templeton. Ajay, good morning. Good to have you with us here. Prashant, this side. It seems to be a clear marked shift. Determined FPIs wanting to come in and come in quickly, lifting all boats here. That is on one side. On the other side, you've got earnings for the 4th quarter, which were not expected to be great, and they're not great so far what we've seen. I think that's at least what I've observed. So just that dynamic which is playing out, Ajay, how do you look at it and how far more to run?
Yeah, so this is typically the way the foreign investors work because they have been, as we are aware, selling India for a long time. It is just that right now the confusion which is there in the global markets with respect to the tariffs and the implications thereof on the various economies and the stock markets is just that some of the foreign investors think that India has kind of underperformed slightly during the first few months of this year. So it was kind of a trade for them because they continuously need to get in and get out of the various markets, just like we kind of try to do the same with the stocks. So it's part of their daily job in terms of trying to identify some short-term opportunities as well. So I would think that they're approaching it this way, and everyone is looking for more direction and more clarity as to what is happening on the tariffs front. And till then, right now, maybe they were spotting some opportunities.
What's your assessment of earnings so far, Ajay?
Yeah, as you rightly mentioned, the earnings are expected to be muted, and they are in line with that. So generally, the expectations have been kind of met, and the expectations itself was very low. So it's kind of mid-single digits. So two of the largest sectors, a lot of earnings have come out, which is financials and IT. So financials, generally, the earnings have been in line and slightly better in some cases. Whereas IT, as we all know, the earnings expectation was very low. and it was kind of met. But more importantly, the commentary was slightly more muted than expected. So in that sense, there is no positive surprise from the major earnings which have been declared so far.
Okay. Ajay, hi. Good to have you on the show today.
Good morning, Survey.
Good morning. Good morning. So the sense is, I mean, how to sort of play things from here on. And first of all, give us the sense on whether you expect the market to get back into its winning ways, or do you expect more consolidation? Because the recovery from the lows in April has been quite dramatic. It's been, I think, better than what most bulls would have forecast. So are you expecting a very momentum-driven market again? Or do you expect more consolidation, in which maybe, just going back to quality, going back to value might be a good approach?
Yeah, I would be in the latter camp, because there is a lot of, let's say, confusion in terms of what the global situation is. So we are aware of the tariffs, and I guess you were talking at the beginning of the show how some of them is getting reversed. So every day the dynamic is changing, and even the companies are finding it very difficult to make any plans. All the capex plans are on hold. It's a bit difficult for companies themselves to assess, and so therefore for the investors it is even more difficult. So generally the investors are more in a reactionary mode. On top of that, of course, as far as India is concerned, now we have this India-Pakistan situation. So I don't think the market is right now discounting any of the repercussions out of that. And obviously, no one knows what's going to happen in the future. But the point is that the markets don't like uncertainty. And we are also aware of the slowdown in the global growth and the growth in India. All the estimates in India GDP growth also have been cut to the extent of 30, 40, 50 basis points. We are now closer to maybe 6.2, 6.3%, which also might be difficult to achieve. The earnings growth also have been downward revised. So till some time back, we had kind of 15% for FY26. Now maybe the analysts are estimating more in the range of 12 to 13%. So there is a bit of caution in the air all across because the clarity is not there in terms of the immediate future. Though the attractiveness of India continues in terms of the relative growth being higher. So that story does not change. And that is why, as you were asking some time back in terms of the foreign investor interest, every now and then the interest will be there. And the foreigners will also be looking at the trading opportunities. So it will be a very kind of a consolidation market. I don't think it will be a very momentum, secular, one-way kind of market.
Okay, all right. Hi, Ajay. Good morning and good to see you, Ben. Ajay, the markets are appearing to get their mojo back. And if this sort of buoyancy continues, then maybe those stock market players that had seen a big pullback, barring a BSE, of course, they could return back into play. What's your take on them? You have BSE that's made a fresh all-time high. Valuation-wise, you can argue that it's got too expensive. I think yesterday they've introduced the block deal window with T+0 settlement. So that could be one factor that's playing out. But otherwise, as a space, that got a lot of attention. Then it got slammed. And some of the stocks are making a comeback. How do you play it?
Yeah, so we are generally a bit cautious on the capital market related plays. We had played it earlier till last year. And of course, last year the markets did very well, and all the stocks related to that, they being derivatives, their business being derivatives of the markets doing well, they had done well. So in some of our funds where we had positions there, we had booked some of the profits. So right now we are approaching it cautiously because, as I said, we believe that the markets will be in a consolidation phase. It will not be a very secular kind of market, which really helps the capital marketplace. So it is better, the better opportunities are available in terms of relative growth in the other sectors.
Okay. Ajay, then let's ask you what you would definitely avoid in a market, given the uncertainties that you described. And earnings are obviously a big risk. What are you strictly staying away from?
So there isn't a particular sector which is looking like very bad because most of the sectors, it's not as if any particular sector, the valuations are very attractive, and some sectors, the valuations are very high. So there is a bit of correction within the valuation. So as we have been talking for some time, and I was here on the show as well talking about how we used to like financials. We still like the financials, but now the valuations are better. So if you look in terms of avoiding sectors, we haven't avoided any sectors as such, but we are underweight a few. So IT is one sector, at least in the focus fund, we are underweight. We have been underweight with the same assessment that the earnings growth and the business growth, especially in the US corporate sector and the big banks there, which are the big clients for the Indian IT, they will have an issue with this kind of confusion and talks of US recession, and therefore the IT expenditure, the growth may be muted. So we have been underweight. And though the stocks have corrected quite significantly, we still feel that it's better to remain underweight till things improve on the business front. Consumer staples is another sector where we have been underweight due to the tepid growth and the valuations not being corrected anything significantly. So that is another sector where we remain underweight.
No, got that. Ajay, by the way, defense stocks are doing well. The shipbuilders are looking up. Mazgaon is up 3%. And I saw Garden Reach as well, which was up some 3-4%. There is Paras Defense, which is higher, Data Patterns, and a few others as well. So that's one pack which seems to be coming up. Bandhan Bank is up 4%, 171. It was not there in the mix when we started in the morning. We looked at stocks in the first 5 minutes or so of trade. And more names are sort of course, being joining the list. Premier Explosives, I think, right? I mean, the 7-8% pop coming through on that one at this point in time. Ajay, thank you very much for joining us. Good speaking with you, and we'll speak again soon. Thanks indeed for joining us. Surbhi.
Okay, all right. That's the market conversation. And the market, for the time being, is having another good morning, 100 points up on the Nifty. The next company on our radar is AWL Agri Businesses. Of course, earlier, this company was known as Adani Wilmar. And then Adani's, of course, have moved out. The company reported a mixed set of numbers for the fourth quarter. The revenue zoomed higher, almost 37% growth at the top line. The margin, however, has moderated a bit as edible oil prices have been on the rise. To talk about this and more, we have Angshu Malik, MD and CEO of the company, joining in, as well as Shrikant Kanhare, Deputy CEO and CFO of AWL Agri. Gentlemen, thank you very much for joining it, both of you. Mr. Malik, if I could open with you, and I'm just sort of rewinding back the numbers for our viewers as well. We'll just have them up on the screen. If we talk about the volume growth, I think it's been pretty good, because in the fourth quarter, edible oil saw about a 7% volume growth. And that's obviously helped boost your revenue, the top line, to 37% as well. What is the outlook? Let's start with the edible oil business. What's the outlook for the next couple of quarters, or if FY26, if you can share that, both in terms of pricing on edible oil as well as volumes?
Thank you and good morning. The volume growth essentially has come from our aggressive distribution expansion that we have been doing for the last couple of years, particularly the rural markets. And we now have touched more than 50,000 small towns, as we call it, where we have appointed direct distributors. Direct reach has also gone up by 19%. So number of people on the street has improved, and we have increased the direct coverage, because in essential commodities, the most important part is your availability in the retail outlet, and that is why the volume has gone up. On the edible oil front, I think the prices and all this are very stable now. And over the last couple of months, things have been stable, and we expect this to continue with good monsoon coming, and that is what we are all hoping for. The Rabi Kharif crop will be very good, where soybean, groundnut will come. And because of the new crop that will come, I think the prices will be stable. Mustard oil crop has been very good. Mustard seed productions are around 108, 120 lakh tons, in that range. That is what people are saying. Very good crop, and the yield, oil content is also good. So overall, I think edible oil is very comfortable in terms of.
So you did 9%, I think, volume total full year. This was in, I think, in FY20, in the previous year, basically. So 9% volume growth. On what will you do this year in edible oils, and also what's the margin going to be? Some sense of pricing, and therefore what margin should we expect on this business?
See, on growth front, we are considering a target anything between 7 to 10%, depending on how the first two quarters go, because that is very important. One and two, on the margin front, I think stable prices will help the brand to give a stable margin, and brands always like stability in prices, and that I think this year the brand will give a better margin.
So just one final question, Mr. Malik. Since you mentioned that a bulk of this 7% growth is coming because you're, boosting your distribution in rural, and you really want to be where your customers are. I just want to understand, and quick commerce has been growing very well for you as well over this year. Just want to understand whether quick commerce is basically replacing the demand that would have otherwise come from Kirana, or whether it's adding to your volumes.
One is that quick commerce, we have grown by more than 100% this year. And that is helping us because good brands are picked up by the consumers, because we understand that these consumers are better educated and all that. So they like to buy brands which they are aware of. That is one. Two, it has slowed down the modern trade to some extent, because the consumers who are going to modern trade, who are used to going to bigger shops or self-service stores, have now gone online. That is one. Tier 2 and Tier 1 cities, we have seen that some of the big Kirana shops have got impacted because they had good clientele, and those were the people who shifted to online.
All right. Hi, good morning, gentlemen. Good to see you all in. So alternate channels, they generated close to 3,600 crores in the last year. For this year, how much will it generate?
I think it should grow at around 35-40% minimum.
Okay, got that out of the way. Also, if you could help us out with, the South focus. In FY25, the South region has grown by close to around 25% in branded edible oils as well as foods. Yes. I think roughly it contributes close to around 10% of the total branded sales right now. Yes. What kind of a contribution we're looking at from there?
See, we have not been very strong in South historically.
Yes.
And we have been focusing on it for the last 3 years. Now it contributes 10% to our overall volume. Both food and oil is growing there. And I think this tempo of 25% growth should continue for a couple of years.
Okay, got that. All right. So also, if you could help us out with your market share, the palm oil market share, I think there was a bit of a decline by around 140 basis points. So could you tell us category-wise, how do you see your market share move? And if you have a target, you could help us out with that as well.
See, edible oil, on palm, you are aware of that the palm prices went up and it was higher than sunflower oil prices. So obviously, consumers who were buying palm oil shifted to the next available soybean and sunflower. So the palm oil volumes dropped, and our share also dropped. That is one. And we are number 2, second largest palm oil player in the country in terms of branded packs. Our soybean oil volumes have gone up, so market share has gone up by almost 10 basis points. Sunflower by 20 basis points, mustard by around 30-40 basis points. So overall, all other oils have grown well, but palm has gone down. That has impacted our overall market share, which has come down by 30 basis points.
Gentlemen, morning. Prashant here. Mr. Malik, if I can ask you, I remember when this entire Russia-Ukraine war started, we used to discuss impact on edible oil prices, etc., impact on crop prices. Now we are at a position, I don't know, but I mean, it's been on for 3 years now, much longer than what anyone thought. If this were to get to a near-term resolution, Mr. Malik, could you give us a sense of what the implication could be on pricing or prices?
I think over the last 3 years, the trade has managed to how to grow crop and process and export. So all the roads, whether it is from road route or the sea route, everything has been explored. And today, by and large, supply chain is very, very comfortable. And we see no reason to be afraid of any eventuality in that area. Things are much better, and supply chain is much better. Argentina and Brazil also supplies us some amount of sunflower oil, so we are having from there. So overall, I think edible oil is very well placed today.
So there is no, premium which has been built in where prices, if this were to be resolved, so I'm talking about resolution here, not escalation. There's no implication. It's kind of settled prices.
Yes. Because by and large things are stable. So even if war comes to an end, nothing much will happen.
Okay, got that. Mr. Kanhare, if I could come in over here, let's talk about the FMCG business as well. What sort of growth are you expecting? In the previous quarter, I'm looking at the numbers now, about 9.2% growth over here. Again, overall for the year, what can we expect from your FMCG business? Which segment will drive it? How are margins looking at commodity prices right now?
See, the food FMCG business certainly is a focus area for us as we go forward. This year, we have been able to showcase a good volume growth in FMCG. And I think the two basic food sub-segments we have, one is rice and wheat flour, which will drive the growth next year for us. Currently, this business, of course, we are running at a EBITDA neutral by design as we are aggressively spending on distribution and infrastructure for the food to grow. This basket is already now close to 1.2 million tons of basket for us in our entire scheme of 6.5 million tons. So it's already contributing close to 18-19% of our overall schemes. Our expectation is that this should continue to grow in a double digit as we go forward. On margin fronts, as I said, currently it is by design EBITDA neutral, should continue to be in EBITDA neutral for next couple of years, given that it is still in investment phase. And
right.
So that's what our outlook is on this particular segment.
All right. We had many more questions, but we're out of time. We're on a earnings treadmill. Hope you understand. Mr. Malik and Mr. Kanhare, appreciate both of you coming on and sharing those details with us and, of course, providing us with some outlook. Very helpful. Thank you. Markets, of course, by the way, come off the day's high. Nifty's got about 50 points on it. We are back with the management of Hexaware on the other side.
Welcome back. Let's focus on a tech company. We have with us Mr. Sri Krishna Ramakarthikeyan, the CEO and Executive Director at Hexaware. Hi, sir. Good morning and good to speak to you as always. Well, the global environment is quite uncertain. I think because of that, you haven't given us a concrete annual guidance. But in the previous year, in calendar year 24, you grew by roughly around 13.5%. What about this year? What kind of a growth estimate could you give us? Will it be better than the growth in the last calendar year?
So the fact that we've not given a guidance is a conscious choice we made at the time of listing. We said there'll be good and bad economic cycles. We will not provide a guidance. So it is not as a result of the current macroeconomic situation. So that's point one I want to clarify. Point two, on our performance, we actually gave some detailed commentary earlier today about what we expect our outlook to be. I mean, Q1 is expected to be a soft quarter, which it was. But the good thing is that we won a number of deals, which puts us in a really good spot for the remainder of the year. We said Q2 will be a good quarter and Q3 will be a great quarter and Q4 will also grow.
Okay, all right. But you don't want to tell us whether it'll be better than last year in terms of a growth rate?
We've chosen specifically not to give a guidance.
Let's focus on a couple of verticals then. The banking vertical. In the past quarter, you saw a revenue decline of close to around 12% on a quarter-to-quarter basis. What went on there? Was it the client-specific issue or, if you could clarify on that front?
So let me zoom out a bit. I think banking for the full year for us, for the full calendar year, will actually outgrow company average. They will do very well. You will see a sharp turnaround, potentially with a double-digit Q-on-Q growth for this vertical, even in Q2. So there's a number of one-offs that led to our reduction in Q1. This was also there in Q4 last year. So it's somewhat a continuation of that. But actually, banking will do very well for us this year.
Okay, you're saying it'll outgrow the overall company growth. Just a quick word on margins. So margins were at about 17% odd in the first quarter. You've said in the past you have levers to improve margins. Could you talk to us about what we can expect for the year?
So we've said we will be in a range of 17.1 to 17.4 for this year. And we've been steadily improving our reported margins for a number of quarters, and we will get to this number. We actually have further levers for improvement from that point onwards, 100 to 150 bips. However, for the next, I'll say several quarters, our focus is to improve growth and not to improve margins. So we'll get to that 17.1 to 17.4 range and then stay there.
Sri Krishna, I just want to go back to the BFSI point that you made, because you seem to be sounding very, very optimistic that that will continue leading growth. Though this segment declined quite a bit in the first calendar quarter for you. So can you just explain what happened? Yes. Are decisions getting deferred? What gives you the confidence? And also, what is your total exposure to US as a geography? And within US, the BFSI part?
So, number of questions, number of answers. First is BFSI is 3 different segments for us. So this is specifically banking. FS is another segment, and healthcare and insurance is another segment. All of these we actually expect to do well. We expect to lead company growth. But the specific decline was in banking. This is not as a result of new decisions being delayed. Actually, we won a number of deals. This is as a result of a number of older projects that are coming to an end. That's the nature of these programs. They are, one-off builds of a digital bank and things like that. So that was expected. But we will do quite well for the remainder of the year. FS, which is the other component you referred to, already grew very well, in excess of 20% year on year, 5% quarter on quarter or so for this quarter. And that will continue.
Banking to come back as well. Just very quickly, 10 seconds left on the call. Wage hikes. TCS is delaying them or deferring them. What about you? Are you looking to give wage hikes?
Our wage hike cycle is effective July 1st. We will stick to it.
Okay, all right. You will stick to wage increases. Now, do you want to squeeze?
No, I just want to know
the wage hikes.
Wage hikes. Any kind of guidance, quantum, anything? If you could give us, and also if you could look at it, there was a decline in the number of people you'll have put on in the last couple of quarters. But I believe in quarter 2 you're looking at upping that number, right?
So even the decline in quarter 1, actually, if you peel the onion a little bit, we actually added about 100 people in IT. We reduced several hundred people in our BPO business. In quarter 2, we've said we will hire between 1,800 to 2,000 people in IT. So that's the gross hiring, but that's a confidence of our future. On wage hike quantum, it's still a little early. Our cycle is effective July 1st, so we don't know that answer yet.
Got it. All right, we'll leave it there, sir. Thank you very much for your time. Appreciate you joining us here on CNBC TV18. Good luck. Well, another IT company, we are KPIT Technologies in focus. Now, with KPIT, the numbers are very good. Deal wins are good, I mean, revenue growth margins, but the bummer, if I can call it that, is that there is no guidance. So let's welcome in Mr. Kishore Patil, co-founder, managing director and CEO at KPIT Tech. Mr. Patil, good morning. Thank you for your time. Prashant this side. Why no guidance, sir? You have enough orders on hand, you have visibility, but no guidance. Why is that?
I think we should start with celebrating something which already have in hand, which is rare in the industry right now.
No, it is rare.
That's a good way to get into the next year. So that is the number one part.
Yeah.
The second is, I will answer your question, but just to give you the, if you look at the deal wins have been very good. And if you see that there were certain questions earlier about we have won this large program, SDB, is that over? Are there going to be new programs, etc.? So we have, MBRDI, we have also the partnership which we have announced during the quarter. So the point is that we are making a good progress overall, and we are also, increasing the pipeline. In the quarter two, we said that the market is a bit uncertain, soft, is what I said in the analyst and other calls also. In the quarter three, we said that we are moving from there and we are seeing a better visibility. Things are happening. We know exactly what they want and what we need to address, and we are ready for that. On the quarter four end, now that the March end, I feel we have a better understanding. Not only that, now engagement and also the pipeline to do that. I think, if I may say that, so there is a good progress which is happening. What is happening in the US is kind of an interruption, and the dust should settle down in a quarter or two. It is not a full, it's not like a 0-1. It's happening in pockets, things are happening. But some of these larger engagements, wins which we are having, already we have started working in some cases we have started transitioning. But the big scale up is, I think, will happen once this uncertainty we should go in next 3 to 4 months. And I think that will give us that would be a good time for me to come back.
With a guidance, right? in 3 to 4 months. So it's possible you reinstate a guidance once you have this some more clarity coming through. But at this stage, as you look ahead, will we see at least a 10% growth for FY26?
Yeah, I know that you want to put me a number, but I can only say that.
At least. I mean, that's, and that could be lower number as well, but gives us some sense.
No, I think, let me tell you, it is not that, we are a pretty ambitious company and we have a certain goals. And I have always said that if you look at, I am very confident that if we go to medium term, if this interruption was not there, we would have been anywhere between 18-20%. So I think that's what we are calibrating due to interruption. So for this year, this first half, of course, is something which is going to be a softer one for this reason. But I feel we should be in a position to come back reasonably well in the second half.
So, Mr. Patil, just to understand that what you said is that if there was no tariff uncertainty, then you would have been reasonably confident of doing at least 18 to 20% growth, right? Which is ballpark what you did in FY25. Yeah. So should we take that as a sustainable run rate? And this is not a question only for Q1 or Q2, but is 20% growth a sustainable run rate for KPIT Tech, X of global disruptions, like what we are witnessing right now?
Absolutely. And that's what we have been saying, that in the medium term, we have been saying that that's what we can generally
Got it.
And if you look at last, we have done that. I think this is at a high level, I would say
absolutely,
that. But don't put any number right now.
No, absolutely, sir. We're just trying to understand, because from a higher base of almost 35-40% growth, now you're saying 20% is very sustainable for the company. Now let's talk about the current disruption, because from what you're saying, it seems that everything has not stalled on ground. Your partnership with Mercedes is progressing. I think you've also indicated that you could be looking at more wins in China. So to what extent can can you give us some more color? Have companies deferred, decisions? Will program ramp-ups be, say, impacted? What exactly is happening on ground? Because I think we'll have more clarity in July once this, deal window, 90-day deal window is open, is shut. But exactly what's going on and how much more additional revenue are you hoping to get from the Chinese OEMs?
Chinese OEM, so let me first address China and then I will come to your second question. So China is more strategic for me. I mean, for our business, because it's the largest market in automotive, it's a very innovative market. So we want to build an organization there. I mean, we'll have revenues, this, that, but we'll be patient. It's a long-term commitment we are making to build it. But at the same time, we see clear opportunities for us to engage with them. Whether it is first for understanding technology and taking it to our global OEMs, how efficient it is because they want to bring some of those features in their cars, etc. The second is for our global OEMs who are in China to build a competitive features for China market. And third is some of these Chinese companies who want to go outside China, what we can help them. So I think there are 2-3 ways, and that's what we are focusing on. It is going to be a little long haul for us, I would say at least a medium term, but we are making very concrete progress in building alliances, partnership, engagement, and building our own organization to begin with. And of course, very importantly, first priority learning from China. So that's what we are doing for the first part. Coming to your second point, right now the way it is globally, most of the OEMs have the production program in next year or year after. So 2.5 years, even if they delay a little bit due to some of these changes, it's between 2 years to 3 years. They have most of 2 to 2.5 years, their production programs are coming out. Most of them are horribly late. They are not sure about, they are facing some quality issues and etc. I think in that case, that's where as you know, KPIT as an independent software integrator, we have built platform, we have built technology, we have tools. And what we have done is we have built a very, very compelling story for them in terms of AI plus platforms plus our knowledge, what we have. And that is what we will be in a position to take.
No, sir, I was... Sir, please, my apologies for interrupting. It's just because we're so hard-pressed in time. I completely understand that. I mean, the solutions and the tools that the company has already built and the relationships. My question was more direct for the here and now. I mean, do you anticipate a disruption in deal flow or in revenues in Q1 and Q2 till this settles?
I don't think so. I mean, if you really look at OEMs, because they are in a hurry, they have to deliver. The point I was trying to say is they have to deliver the programs and they have to deliver in a different way. That's what they have to realize. So actually, all those actions, discussions are happening right now. So it is a question of a bit of a time. So the only point, if you ask me, also we are doing very well on the off-highway commercial part also. The only place where probably, if you may ask, is there is certainty will remain for some time, and which is a very, very small part of our business is tier 1 business. So I think that's what I would put it.
All right. Hi, Mr. Patil. Good morning and good to hear your thoughts. You know, your order book is quite good. The potential for business is very good. The only problem was you're not giving us a guidance. But as you said, in the next few months, hopefully we hear on that front. I wanted to focus on Europe. Europe, you know, you're doing at a run rate ballpark of around 75 odd. Then it went to around 80 and it continued to grow. But in the past quarter, there's been a bit of softness out there. It came down to around $77 million odd. What's the outlook out here? What is the run rate you should be looking at from the European business? And also the other positive has been the margins. I recall, Mr. Patil, over the years, you started at around mid-teens, it went to high teens, and now you're clocking 21%. Say in the next few years, where do you see this margin number headed? And in the near future as well, should we be counting on a 50 to 100 basis point increase in margins on a year-to-year basis?
I think I'll answer the first question. I think first, our goal is to see how we can help our clients, which are in a real pain. And I think this, the large pipeline we have, which we have mentioned is the highest pipeline we have in our pipeline is from Europe. It is across the geographies, but the highest is from Europe. So I think that is something which will come back. I don't think, when we are already engaged, some of those projects have started, transitioning is happening. So that will happen, and you have seen some of the announcements. So I don't see a big issue on that part. On the margin side, I think we have worked very hard on this part, and we believe our current strategy would be to maintain the profitability. As you know that most of the OEMs, most of the service providers or technology companies globally have margin dilution during this quarter and last year. We have maintained that, but we believe that in the next year our goal is to really reinvest into some of this problem solution fast, accelerate that, and AI transformation. So we will be making more investment in this area. So right now I'm not sure whether we will be in a position to increase the margins from here.
But you can sustain at 21% for sure, right? That confidence you have.
Yeah, that's what we.
And in the next few years, we'll obviously look at improving from this 21% odd mark once growth comes back, once there are finalization of more deals.
We'll see where we are, and we have to see where the currencies are, and then we can take the view. Nobody nowadays in the world knows what happens tomorrow. So, yeah.
Indeed, Mr. Patil. We appreciate you joining in. I recall many quarters ago, you told us that 20% is possible and then 21%. Congrats on that front. The globe is a little bit uncertain, but you're giving a hint of optimism in the commentary that maybe things improve from here on. Appreciate you joining in and giving us all of those details.
Nigel, the analyst at JP Morgan, Ankur Rudra, says that if KPIT were to do 10% growth in FY26, so how difficult is 10% in this environment? It's only the third company in their coverage universe which will do 10%, if KPIT does 10%. So I think that's essentially what Mr. Patil was talking about as well, that he began by saying, I mean, you should, in this environment, the way they're doing, actually has been very, very good. But of course, I mean, environment over the next 3-4 months, maybe clarity, then the guidance is restated. We'll see. We'll find out, as we heard from the company. Well, let's just quickly run through the market action as well. I think we've dipped quite a bit. We've come up a little bit, all in the space of the last 30 minutes or so. So what do we have, actually? The high today has been made on the Nifty at about 24,457. And the low, which was made about 10 minutes back, has been about 24,290. So I think we sort of dipped into the red by a little bit, and we are up about 50 points. It's a little volatile out there. Mitesh is back with us. Mitesh, what does one do?
Morning. So, I was talking about this supply coming in closer to about 24,500. That's what we were. So I think, from a trading point of view, we're carrying index positions. I think good to take part of off around those levels. I said ending in excess of 24,450 should provide some profit. And re-enter on dips. I think that's something to go for. Once we have a closing about 24,530, then I would look at 24,750 weighted zone as the next target. But for the timing, there's a good chance the next couple of days, maybe 3, 4, 5 days, could be spent within the trading time that you will see moving at or around levels of 24,450, 500. Having said that, I have a buy on LNT. I recommend to buy here with a stop just below today's low of 33.35 for targets of around 34.50 to begin with. And PNB Housing, the stock is up significantly, but the way this breakout has taken place suggests we could have more in future. So we'll take a stop just around levels of 1,050 and look for a target around 1140.
1,200 was the high. 1,200 exactly was the high on the 12th of September last year. And from there, it kind of fell back. I was going to ask you that, but that's a call coming in from you, Mitesh. Thanks very much. Manisha is here with us to tell us what's happening as far as the commodity space is concerned. Manisha, morning.
Morning, Prashant. Thank you for that. I want to start with the crude oil prices because this is an area where you have seen the maximum price moves come in the overnight markets, and a lot of pressure as well continues. Overnight, we've seen nearly 2% of a decline come in for the crude oil prices. That makes it 3% down in the last week. Also, when you look at this current year, 2025, we are down by 14% for the crude oil prices. If you look at the last 12 months, then we are down by 25%. And it's not just about this year. When you look at the last couple of years as well, it has been a negative returns that the crude oil prices gave you you. So 2024 was 3% down, 2023 was down 10% as well. So 2025 in that sense is a third straight year that you are looking at negative crude oil prices continuing. Having said that, we have been making lower lows because when you look at the average in 2023, crude averaged at $100 a barrel, then it averaged at $80 a barrel in 2024. In this year, we haven't really been able to go to 80 at all. So we're averaging at around $68 to $70 a barrel when it comes to 2025. Well, various reasons which are putting pressure on prices. One clearly comes in from OPEC and allies, which are adding 411,000 barrels from the month of May. And OPEC has a meeting held on 5th of May. That is when they will decide on what they want to do with the month of June. An expectation is that they will be increasing production further for the month of June as well. Apart from that, there also is Russia adding to Asian inventories. We have discounted barrels coming in from various countries as well. The US shale output is at a near record of 13.5 million barrels per day. So there is no dearth of supply. OPEC is going to add to it. US shale output is near record highs. Then you have discounted barrels coming in from Iran and Russia. That is adding especially to the Asian inventories also, which has been pulling the Brent prices on the lower side. And then the markets also are looking at developments from US, Iran, and then Russia, Ukraine conversations. If this continues well, then you could be looking at more supplies coming in from here. The dollar index is strengthened from its 3-year lows. That is putting pressure on prices also. And then there is uncertainty when it comes to US and China trade conversations. That also seems to be weighing on. I also want to talk about various cautious sentiment that we have ahead of many data that is going to be deleted in this week itself. And then it is about US consumer confidence numbers that come in today. And tomorrow is a heavy day, by the way. You have the US job claims number coming in. It also is about the first quarter GDP numbers, pending home sales, and the Japan monetary policy meeting also gets released tomorrow. So a lot of data, 5-6 important data points that the markets will be reacting to.
Okay, all right, got it. Manisha, thank you very much for that. Let's move on to a couple of specific stocks which are in focus. And we've seen PNB Housing Finance be the high flyer this morning, almost 7-8% higher after reporting numbers yesterday. Let's ask Abhishek. Abhishek, what has worked for PNB Housing?
Well, across parameters, things have been pretty good for PNB Housing. Take a look at net interest margin. It's at 6-quarter high of 3.75% versus 3.7% in the previous quarter. The spreads have been at 2.2% versus 2.3% in the previous quarter. Asset quality has improved. Gross NPA ratio of 1.08% is perhaps one of the lowest in last 22 quarters. Disbursals momentum is stronger. Disbursals are up nearly 24% YOY and about 27.5% on a sequential basis. Even the tenure of the book has increased. Disbursals to AUM ratio has improved to 51.9% when compared to 39.3% in the previous quarter. AUM growth is strong at 12.85% YOY and 4.5% quarter-on-quarter. YOY, this is a 21-quarter high run rate that they have seen with respect to their AUM growth on a YOY basis. Back to you.
All right. Abhishek, thank you very much for that. 20 points is all that is left. So, I mean, the market's finding it difficult to sustain, but we've had such a phenomenal run yesterday and this morning earlier as well. 24,350 is where we are at.
Okay. I just want to take up one stock in particular, and that's TVS Motors. Now, at first glance, the numbers look really good for TVS. The profit is up 76%, revenue up 17% at a time when OEMs are struggling to grow. So why is the stock down there? I think the company has clarified in the conference call that the reason the margin shot up to 14% was because of the PLI benefit. So you have to sort of account for that. And X of PLI, our colleague Sud points out, the margin is at about 12.5%. It's still a growth, but you have to factor that in. And then it's saying that growth momentum in the domestic market may be like last year. First quarter could moderate. So the caution is that, maybe we have a bit of a speed bump on growth going forward. And that's the stock is taking cognizance of that. But back to more stocks. Oro Pharma in focus this morning. We have Ekta joining in with the latest. Ekta, good to connect on air again. And tell us more about Oro.
Thanks, Surbhi, for that. Well, Aurobindo Pharma, there is a little bit of news around that. What the company did notify to the exchanges is that there was a fire incident which occurred near their coal crusher area at their Penicillin G facility, which is in Andhra Pradesh. There was the damage which took place was in fact limited to ancillary equipment. And the core manufacturing infrastructure was unaffected according to them. There were no injuries as well. And there is no material impact which is expected on the group's operations or financials. Though the damage assessment is underway at this point in time, the facility is fully insured and the operations are temporarily paused, so they could see some amount of disruption for the next 20 to 25 days, and that's probably weighing on the stock at this point in time. But the company has indicated that as of now, there is no material impact and on the company's financials.
All right. Thanks very much, Ekta, for that. Just quickly take a look at the life insurance names as well, because our colleague Yash reported towards the end of the trade yesterday that the DFS secretary, Department of Financial Services secretary, in a meeting, and this is of course source-based, exclusive information, the DFS secretary told life insurers that no, the government will not take any action with regards to the bank assurance channel, essentially life insurance companies selling insurance products through the banking channel. Remember, I mean, for companies like HDFC Life, HDFC Bank is a large sort of channel through which it sells its policies. Same is the case with SBI, Max. I mean, actually for everyone, it is a pretty large, the degrees vary. And we'd been reporting, beginning late last year, starting with the finance minister, if you remember that comment which was made that bank assurance is a channel, probably a little problematic and banks need to reduce the dependence. Then, of course, IRDA got into the action. So what we put out yesterday is a bit of a reversal to that entire sort of news flow. And if you looked at the insurance sector coming into this year, this is one of the big regulatory changes, action or otherwise, was a big thing which many investors were waiting and watching. And that story yesterday clarifying that, I mean, that's not what the government wants to do. They recognize the importance of the channel, the bank assurance channel, but at the same time, I mean, they are asking insurers to be cognizant of mis-selling, etc. So even as the bank assurance channel expands, it should not result in increase in mis-selling, cases of mis-selling, etc. The industry needs to keep a lid on that as well. So just wanted to kind of sort of highlight once again what we put out yesterday. What we'll do is we'll take a quick commercial break here. We're going to come back. It's our special segment. It's the economy. Lata in conversation with MPC member Saugata Bhattacharya on the state of the Indian economy. Stay tuned.
Welcome to It's the Economy. Last evening, the Reserve Bank announced it will pour in another tanker load of 1.25 trillion rupees of liquidity into the interbank market in May. The Reserve Bank is clearly way more interested in growth and much less worried about inflation. Of course, this was evident in the minutes of the Monetary Policy Committee meeting as well, when practically all members argued that inflation is well within the MPC's comfort zone, while growth is under pressure both domestically and due to the global tariff wars. Only one member, Saugato Bhattacharya, sounded a tad cautious in the minutes. Joining me now is this external member himself, Saugato Bhattacharya. Good morning, Saugato. Thank you very much indeed for sparing time for us. Well, I just wanted to start with your minutes. In the minutes, you seem to be not wanting to vote for the accommodative stance because you wanted the freedom to pause when needed. So you think a series of rate cuts are not in order?
So first of all, thank you so much, Lata. Great to be back on your show. Thank you very much for having me.
Thank you.
Yes, I mean, as you could tell, of course, I mean, there was no voting on the stance this time. It was just a unanimous decision. Going into the minutes meeting, I was a little cautious about switching from neutral to accommodative, because I mean the implication was that this indicated a pre-committed rate decision, a path of rate cuts, which I was a little cautious, because remember, I mean, given the uncertainty, the extreme uncertainty, which at that point in time was characterized by the global situation, the trade tariffs and other retaliatory measures. I felt it would have been good to retain the option. As you mentioned, I mean, there's very little chance of a possible need for a rate hike at this point in time. The balance of probability is clearly against such a move. But as you've seen with multiple central banks, they have indeed paused in their rate cut trajectory, rate cut, or in the Bank of Japan, a rate hike. So I mean, there is a possible need for a pause. During the deliberations, it was clarified that a shift to accommodative just took a rate hike off the table. There was, I mean, in that guidance, there was the possibility of a pause. So I'm fine with that. I just indicated that a potential for a pause might be a good option to optionality built into the policy at this point in time. It's as simple as that.
Okay, got that, and it's important for you to clarify. But just a clarification for me as well, isn't the stance put to vote? I mean, was there a change this time? Did you all vote last time but didn't vote this time?
Yes, there was a change in the process. Remember, in the MPC Act, in the RBI Act, well, for the MPC, there is no mention of a vote for a stance. There is no mention of a stance. And there is that phrase that the chairman of the MPC, which is the governor, the RBI governor, has the right to put in. I'm just paraphrasing. I don't remember the exact wording of the act. That the chairman of the MPC has the right to pull in anything that he or she might deem important at that point in time. Also, remember, in terms of history, that the stance, voting on the stance, was only introduced in October of 2018, not before.
Oh, it was not introduced in October 2016.
I had forgotten that.
Okay.
So, yeah. So that
2018, you all voted, and you all voted till December of 2024. February. And in February of 24, till February of 24, you voted. But in April of 25, the stance was not put to vote.
Yes.
Okay. That's actually an important nugget. Not that it makes a material difference, but it's important to know that it was not voted in April itself. But Saugata, to come back to what you are seeing in terms of the inflation trajectory, if you look at 3.6, if you looked at the Jan, Feb, March, April numbers, we are running almost at 3.5% in terms of an average CPI. That would give a real rate even at the moment of almost over 2 percentage points. So would you say that 2 percentage point real rate is needed, and Or would you say that it needs to fall?
I think the balance of probability, given what we expect of inflationary pressures going forward, given the fundamental drivers. Remember that at this point in time, forecasting is essentially just indicating the direction of travel. That's all. We really don't know how things will pan out tomorrow, 3 months down, when the 90-day period ends, what kind of trade deals come in, what supply chain responses, etc. are. We really don't know. So that's just indicative of the direction of travel. So even if these tariffs remain in place in the event, there might be a short-term increase in inflationary pressures because of supply chain dislocations. This is exactly the same that happened during the COVID period and then to a certain extent during the start of the Ukraine war. But there might be some short-term inflationary pressures. But over the medium term, the dynamics governing global growth, global trade, whatever is happening in China, etc. So oil is likely to remain fairly moderate. Commodity and metals prices are likely to remain moderate unless there is a major increase in Chinese growth impulses. So all of this, a normal forecast monsoon, etc. So given all in totality, the balance of probabilities that inflation is likely to remain moderate, and hence, as you mentioned, at this point in time, the real interest rate is higher than what the last known analytics of the real interest rate. Which, if you remember, during last year, in January to March of 2024, the RBI analytical studies had indicated the real natural rate would be about 1.4 to 1.9%. Right. So if you assume that inflation is likely to be at the target of 4%, then that would translate to and this is, remember, the 90-day treasury bill, 3-month treasury bill. So which is about, in a steady state, which is about 20 to 30 basis points above the repo rate. So there is space for rate cuts. There's absolutely, I'm not saying anything which is really startling or whatever. So, we are proceeding with caution. This is what is now being called in the markets as good news, the space for good news rate cuts. So I think that's exactly it. However,
I take your point. Yeah, go ahead.
Having said that, 5 more seconds. Having said that, the growth that we are now seeing does not really necessitate a rush into front-loading rate cuts. We are okay. 6.2, 6.3% FY26 growth rate, even if it comes down to that, is fairly okay to my thinking, given whatever we are seeing in the global economy. So I think there's no need to rush into front-loading rate cuts, but a steady reduction of interest rates, I think, is needed at this point in time to support growth. And 5 more seconds, and you've done an extensive recount of the liquidity measures that are now being put in place. So I think even with these rate cuts, with a steady pace of rate cuts, I think actual transmission into lending rates and deposit rates will happen fairly quickly. So I think we are okay on that part.
Okay. Yeah, I'm glad you touched the liquidity part. I will come back to growth, time permitting. But liquidity, of course, is needed for rate transmission, as you pointed out. But as Samiran Chakrabarti pointed out in this morning's note, the amount of liquidity the Reserve Bank has given from January to today, or rather today, till by the time the May calendar ends, is 5.3 trillion. The only other time when it gave 5.3 trillion was during COVID, and that was over 6 quarters. Now they are doing it in less than 6 months. Does the growth situation warrant so much generosity?
Well, I'm not going to second guess the Reserve Bank of India's thinking on this, but I think it wouldn't hurt at this point in time. This is, again, I think in the nature of a preemptive move to try to neutralize whatever is expected will be the outflows from the system through cash extractions, through the ongoing Rabi procurement season, etc., which is typically, this is the time when there is an upsurge in liquidity outflows from the system. And then there are the expected, I don't know that. I mean, the presumption is that there are some, in the FX space, there might be some need for liquidity. So I presume this is a preemptive series of measures to put in. And I don't think, given the forecasted path of liquidity and path of inflation, I'm sorry. So given that, I don't think there is anything wrong in this. I think this is a measured step that the RBI is taking.
Okay. Well, I hope it is a measured step. I just remember that between 2010 and 2013, was it, the Subir-Subbarao combo had put in liquidity, and we also harvested double-digit inflation. So anyway, those were different times, very different times. But Saugata, just to come back to the real rate that the Reserve Bank calculated, 1.4 to 1.9, what therefore may be the end rate of this cycle? Should it be closer to 1.9, in which case you stop at 5.5 or something? Or should the end, should you take 1.4 as the real rate, in which case the repo rate cut can go all the way to 5.25? Where would you lean?
Given the current growth inflation balance of risks in the system, that if inflation and the drivers of inflation actually keep inflation towards 4% or maybe even lower, if that actually happens. And this is exactly the reason that why I'm arguing for a measured series of cuts rather than front-loading cuts in the right at the beginning. That if this growth inflation balance happens to be more tilted towards slower growth, then I think I would lean towards the lower end of the band.
Okay.
So 1.4, 1.5 or thereabouts. Because I think, as you would probably agree, itself will be the heavy lifter of supporting growth. And this would probably require a combination of measures: monetary, fiscal, trade, commerce, labor, etc. A whole series of policies that would be needed. But I definitely think that there is probably a need for monetary policy to support growth.
Okay. Well, thank you very much, Saugata. It's been a pleasure listening to you. Thank you very much for parsing the options before the Monetary Policy Committee. And we do hope that you will join us in subsequent meetings as well.
My pleasure.
Thank you. Well, an important point from the Saugata Bhattacharya interview is that the Reserve Bank is not, mandated to put the stance to vote. It is only the rate decision that is put to vote. The stance was voluntarily put to vote only under the Shaktikanta Das regime, not before when Urjit Patel was chairman, was governor, and not now that Malhotra has taken over. I think that's a very important change that we need to take on board as watchers of the market. Wrap up on Bazaar on that note. Chartbusters coming up.
The street gives up opening gains despite positive global cues. The Nifty hovers around 24,300, led by weakness in FMCG and healthcare stocks. The broader market, however, trades with steady gains.
PNB Housing gives up some of the gains but is still up 6.5% after posting its fourth quarter results. The net interest margins come in at a 6-quarter high while gross NPAs are at a 22-quarter low.
TVS Motor skids close to 4% even as the company reports a strong quarter after the management warns that the first quarter FY26 could see some moderation in growth.
Tata Technologies has slipped nearly 6% after nearly 4% equity worth close to 1,100 crore rupees changed hands at 683 rupees a share. Sources say that TPG could be the likely seller.
Oro Pharma is under pressure after a fire at its Andhra unit. However, the management says there's no material financial impact from this particular incident. Hello and welcome to Chartbusters. We are coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel. With me is Harbaz. And Harbaz, we have a flat screen as we speak. Though the market started off well in the green, I think we're facing some resistance at higher levels. So on the Nifty Bank, the 56,000 odd mark, it seems that the bulls are making a bit of a meal of that because the bears are coming to fight out there. And on the Nifty as well, that 24,450 odd appears to be a bit of a resistance zone. So let's see how it goes. But for the time being, we've come off the highs of the day.
There's some bit of geopolitical tensions as well, right, on the border, and that is causing that fall from the highs. And of course, it is this conundrum, right? We are failing to cross that high made last Friday, which was 24,365. We did make that on an intraday basis. At the highs of the day, we were well above that. We were at 24,460, but we're failing to sustain at above those levels. 24,365 is Friday's high. In fact, the highs of the last 4 trading sessions too have been in this 24,340 to 24,360 range. So it's this 100-point range that where the Nifty is finding some bit of resistance. Of course, we need to make sure of the fact that there are a lot of earnings reactions today, a lot of earnings reporting today as well. See the likes of Trent, Bajaj Finance and the likes, and a lot of broader market names as well. So it promises to be an action-packed day. Of course, it's a truncated week, so you need to keep that in mind as well. But what are the charts indicating right now? Shilpa Raut of Prabhudas Leeladhar joins in for just that and also with some trading ideas. Shilpa, good morning. Thank you for joining in. We've had a substantial recovery from the lows, right? And it's just because of some of these geopolitical tensions that we're taking a bit of a pause or adopting a cautious stance. What do you do here with the index now, both for the Nifty and the Nifty Bank? And of course, your stock recommendations for the morning.
Good morning, Nigel and Thomas, and thank you for having me on the show. If you look at the rollovers analysis, we were very clear that 24,600 should act as a resistance and the support is at 24,000. So this range is very much clear for this, at least for this truncated week. So for now, that range on the upside of 24,500 to 600 is acting as a resistance. So any rise towards that can be an opportunity to go short, and any fall towards 24,200 can also be an opportunity to go long. So as long as we are not breaching above that, so we can play this range very well. Talking about Bank Nifty also 56,200 is a resistance, and we see time and again 56,000 zones is acting as a tough upside resistance there. So as long as we are not above 56,500, we'll not see any good upside towards 57,000 or 58,000, as a matter of fact, of new highs that we talk about. So for now, I wouldn't say that there's a trend reversal, but yes, some profit booking on the higher levels are definitely pitching in.
Okay, all right. Let's focus on individual stocks. And Shilpa, what's on your radar?
Nigel, I have one buy. The buy would be in Britannia. Britannia futures trading at around 5,500. I believe, stock is showing some sort of resilience, and it is attempting a breakout for levels of 5,600 to 5,650. So keep a stop loss of 5,480 in futures and stay long in Britannia. The other one would be a sell. Sell would be in Coal India. Coal India has slipped below 500. So I believe, levels of 460 can also come in again. So the stop loss should be at 405 and look for levels of 360 in Coal India.
All right, Shilpa, thank you so much for sparing time and joining us today with your views on the index and on specific stocks as well. Shifting focus to our special segment where we get you a few ideas for profit from Money Control Pro. Neha Dave joins in today with a stock that she's tracking very closely.
Today's stock pick is HDFC Bank that posted muted earnings in FY25. However, the improvement on the balance sheet front was positive. In FY25, HDFC Bank focused on managing the balance sheet that got unaligned following the merger. Moreover, the bank had a cautious view on the credit environment. Consequently, the bank's loan book growth of around 8% in FY25 was lower than the industry growth. However, the bank saw a strong deposit growth of 14% in FY25. Thanks to slower loan growth and solid deposit growth, the bank's credit to deposit ratio improved to 97% as of March end from a peak of 110% that the bank saw in December 23 following the merger. Going forward, as per the management, in terms of advances growth, the bank will match the industry growth in FY26 and it will grow faster than the industry in FY27. With the likely reduction in the policy rates further, margin will come under pressure over the next couple of quarters as loan book will get repriced faster than the deposit book. However, the margin will get support in the medium term as HDFC Bank replaces market borrowings which it has inherited due to the merger with relatively low cost deposits. Overall, higher advances growth, range-bound margins and stable asset quality will lead to better earnings in FY26 and which can lead to valuation re-rating for the bank. Currently, the bank is trading at around 2 times core book value estimated for FY27 after adjusting the valuation of subsidiaries. The valuation is reasonable given that the bank delivered return on asset of around 1.9% and return on equity of 15% in FY25. Moreover, HDFC Bank is trading at a 10% discount to ICICI Bank in terms of valuation. Long-term investors should accumulate the stock.
All right, thanks for that, Neha. Well, time to slip into a short break. On the other side, we'll be joined by the Managing Director of Castrol India. Mr. Kedar will be waiting by.
Welcome back. You're watching Chartbusters here on CNBC-TV18. Continuing with corporate conversations, then Castrol India's quarterly performance weakened on a sequential basis. Margins also came in below the guided band of 22 to 25%. And to discuss the quarter gone by and the road ahead for the company, we are now being joined by Kedar Lele, who is the Managing Director of Castrol India. Kedar, good morning. Thank you for joining in. You know, your margins are below the guided band. It's been a subdued start to the calendar year as well. Could you tell us what are the challenges that you faced during the quarter and how is the current quarter shaping up as well? We are 30 days into the new quarter. So what's the on-ground situation now as well?
Good morning, Orvaz. Namaskar. Very good to see you and thank you for getting me on the show. While you started with the reflection on this quarter being softer to preceding quarter, I would really request you to really focus on year-on-year performance. And I'm quite satisfied with how the quarter one of this year has been. We have grown our volumes by 8%, our top line by 7%, and the PAT has come at 8%. Now, when the quarter started, to be honest, I was really worried because of the clouds on our larger geopolitical scenario that all of us are aware of, our forex ratios, because the dollar was rupee dollar conversion was getting weaker and we were seeing those headwinds. And in that in those circumstances, this performance is really, really delightful. It's come because of innovations that we have done, because of our market coverage that has gone up, and sustained executional excellence that we have seen in the market. So as a whole, we are very, very happy. And I keep explaining everybody that the Q4 of the calendar year is not the right thing to compare. We have always given the guidance of our profitability in 22 to 25, and this quarter has come at 22, despite all the headwinds that we saw in the business and the environment.
All right. Hi, Kedar, and thanks a lot for joining in. This is Nigel on this side. So let's focus on the yearly aspect then. What kind of a volume growth can you guide us for the year? And as you said, last quarter had a couple of headwinds that forced the margins to come in at the lower end of the guidance band. Given that a couple of input costs have cooled off, you're focusing on some operational efficiency as well. Should we see an improvement in margins in the coming quarter?
I resist from giving a forward guidance on the business, to be honest, because what keeps us going is a good insight on the long-term focus on our segments, which is trucks, cars, and bikes. We stay focused on how we land our innovations, like we did with Shah Rukh Khan taking the Garmi Maybe 3x prediction during this quarter. And that, of course, in the summertime will become more relevant for all of us. And we keep expanding the volume growth for the business ahead of the industry. If we did that with discipline, I have no doubt that earning per share will continue to grow handsomely in the time to come. Now, you asked a question, and I should say that in this quarter, the team prioritized on our ASP investments, which is advertising and sales promotion investment. And it was much, much higher than what we have done in the past, almost 45% higher than what we would have done in the past. And that augurs well, because in the beginning of the year, when we invest behind our brands, that creates a fuel for growth. So I'm quite pumped up with the strategic choices that we're making and the performance that we will deliver in the time to come.
Kedar, you spoke of investments and that they have been substantially higher behind the brand. Does that continue for the rest of the year as well? And if so, does that impact your margins, or do you maintain that for 2025 as well, you would remain within this 22 to 25%, maybe slightly higher than what you reported in 2024?
That's a great question, because the everyday balance that one needs to do while running business, as they say, walk and chew gum at the same time, deliver the volume, deliver the margins. And I genuinely believe that being able to do that on a daily basis, on a monthly and a quarterly basis, is the art of running a successful business. So you will see us driving growth on volumes. You will see us investing behind our brands, being more, bringing ourselves closer to our consumers, innovating, and then performance will come out as profitability for our investors and stakeholders.
All right. Kedar, you're refusing to give us any numbers, or avoiding it at least as of now. Maybe the next time around we'll squeeze you on some numbers. But for the time being, at least give us some inputs, on the EV opportunity, the data center opportunity as well. You all were talking about that in the past, but I think the last couple of quarters that's been missing. So if you could tell us, what is the opportunity and how are you all progressing on both these two fronts?
Yes, I think, Nigel, great question. The challenge in front of oil and gas industry, and maybe specifically for lubricant industry, is to be able to perform while getting ourselves ready to transform for the time to come. And both EV and the data center opportunities are small at the moment, will become larger as the time passes by, and will become core to most of our industry in, say, 10 to 15 years. Now, are we ready for that? The answer is absolutely. For example, the Castrol ON range of products, advanced transmission fluids or coolants, are the products being used by the EVs in India and abroad. We have invested huge amount of capital in our research and development, both in London and in India and across the world. And that prepares us for the transition that will take place. Why I don't talk about it in my result conversation is because the contribution is insignificant at the moment. It is exciting to talk about these things, but does not make a difference to this quarter or next quarter's results. So it's important that we keep performing while preparing ourselves to transform in the time to come.
Will you be setting up at least a separate marketing vertical for both these two segments, EV, data center as well? If you could give us some clarity on that front.
So thing is, if your customers come from a different segment, you do need dedicated manpower to service those. And we've already created those manpower cells across functional team to be able to approach those customers, work with the opportunity, and of course, tap them in the time to come. It is a different route to market. When it comes to EV, it's the same because most of our current OEM partners or OEM customers are in fact evolving. Tata Motors is the leader, and we are a very frontline partner when it comes to EV fluids for them. When it comes to data centers, it's a different business, and we have now dedicated manpower which is working with some of the large data centers which will go for immersion cooling or direct chip cooling, which will involve our coolants and fluids.
Paucity of time, Kedar. So just bunching two questions into one. If you could share the volume growth number for the first quarter, what was it? And if you could break that up as well as to what led to that number. Was it personal mobility? Was it industrials? Or was it commercial vehicles? And part two of my question, which is on a different tangent, is that you had a market strategy of crude oil prices being around $75 to $80 a barrel. With all the volatility that you have seen in crude oil prices falling to 60, now heading back to 70, do you see some benefits percolating into the current quarter as well?
Okay, two very different questions. So let me answer the first question first and then conclude with the second one. The volume growth has been 8%. And if you've been an observer of our business in the industry, you will realize it's one of the best that we have delivered so far. And this has come on the back of very handsome double-digit growth in our passenger car as well as commercial vehicle oil segment. We have also been able to deliver healthy growth and high single digit for our two-wheeler business. So all across personal mobility and commercial, we've been able to fire on all the cylinders. Otherwise, growing this large business in lubricant in high single digit volume would have been really, really difficult in a quarter like this. And hence the combination of all of three has worked really well for us. Now, on your question on extremely volatile crude oil, now, I keep educating everyone that crude oil is of course the raw material that goes into creation of base oil, and base oil is the raw material for lubricants. And while we see a correlation, the correlation is not very strong between the prices of crude oil today and the prices of base oil in the market today, because there's always a lag and the correlation is weak. Now, it does benefit sometimes, and it's adverse in other times. The task or a job of a brand like ours is not to pass on these shocks on a regular basis to our consumers, because customers don't like those shocks. So we'll absorb the shocks when the prices are high, and we will of course make some margin for a short period when the prices are going down. It is the management of my team, which of course invests in these to deliver consistent results for our stakeholders. So as long as I'm predictably boring, I think I'm doing a good job, and so is the company.
All right, Kedar, thank you so much for sparing time and joining us today to discuss your quarter gone by. Wish you good luck for the rest of the year as well. The management of Castrol India discussing the road ahead for the company. The stock, though, at the lowest point of the day, almost 2.75% lower at 204. The other stock that's not doing well today, though, is TVS Motors, and that is despite a strong fourth quarter, because the management is indicating some caution on the growth front. Sudarshan is joining in with more on that. Sudarshan.
So I'll divide it in two parts. First, talking about the earnings. Earnings, by the first look, it was in line, or say beat. It had beaten the estimates of in Q4 FY25. Margin had come at 14% against our estimate of 13%. But that margin of 14% had factored in PLI benefits for the entire year. Now, if you exclude that PLI benefits, margin was at 12.5%, which was largely in line with all the estimates. Now, coming to the second part, that is the commentary. So we'll start with the global, where company sees the global growth to improve going forward, and one of the major markets, that is the African market. As per TVS Motor, African market has hit the bottom, and from here on only growth will improve. The second, coming to domestic growth outlook for FY26, as per the management of TVS, FY26 domestic growth outlook is same what the industry has seen in FY25. Now the question why this stock is under pressure. Now talking about Q1, company is saying that Q1 there might be some moderation because last year in April there was a base effect, so it might come as it might impact in April. But here also for month of May and June, company is saying there might be strong sales considering the number of marriage dates this year is more than what it was in 2024. So earnings were beat, commentary is cautious, and especially talking about Q1, the commentary regarding Q1 might have weighed on the stock.
Okay, all right. Thanks a lot for that, Sudarshan. Well, let's focus on IndusInd Bank. They've announced that its deputy CEO has resigned with immediate effect, weeks after the private lender had disclosed accounting lapses in its derivative portfolio. Ritu is here to fill us in with more details. Ritu?
Well, thanks for that. In what is clearly a fallout of the accounting discrepancies in IndusInd Bank's derivatives portfolio, Deputy CEO Arun Khurana has resigned with immediate effect as of yesterday. As we reported a couple of weeks ago, this was likely because Khurana was overseeing the Treasury Front Office, which is the division responsible for the derivatives portfolio, where incorrect accounting had led to a near 2,000 crore rupee hit on the bank's P&L. In his resignation letter as well, Arun Khurana has cited the recent unfortunate developments linked to the discrepancies and this P&L hit as the key reason for his decision. Now, this resignation comes just a day after the bank disclosed that an independent investigation had identified the key individuals who were responsible, and the bank had stated that the board will determine changes and realign senior management responsibilities based on the report's findings. Now, we understand that this independent investigation was conducted by Grant Thornton, which has pegged the adverse financial impact at about 1960 crore rupees, which is very close to the 1979 crore rupee hit, which was determined by external auditor PwC earlier. The bank will now account for this loss in its fourth quarter earnings. Meanwhile, the Reserve Bank of India has already shortened CEO Sumant Katpalia's tenure to March next year, and as we had reported, asked the board to submit the potential CEO candidate names by October. So the accounting fallout is triggering top-level exits, and this may not be the last one.
Okay, all right. Well, time to slip into a short break. But as we do that, here's some good news for all our viewers. India's business news leader is now a click away. Introducing CNBC-TV18's all-new app. Get instant access to breaking news, in-depth articles, and financial world updates. All of this at your fingertips. Download the CNBC-TV18 app from the Apple Store or from the Google Play Store. Or you could simply just scan this QR code that's up for you on the screen. Sources tell CNBC-TV18 that India is considering restricting the export of electronics and e-commerce goods to Pakistan. The move comes against the backdrop of the escalating tensions between the two countries. Abhimanyu joins us to fill us in with more details. Abhimanyu?
Sources have indicated that after Indus Water, Indian electronics and e-commerce goods may face curbs for Pakistan because after passenger traffic, there is a likelihood that air cargo route over Pakistan may get severely impacted. Sources have indicated that the government is collating data from the Customs Department and several other departments to understand the logistics cost for exporters in case of any further disruptions. Also, plans are underway to assess the impact of trade to UAE and Europe as part of multifaceted preparations for a possible disruption which may happen for trade. Also, sources explain that direct trade between India and Pakistan is minuscule as most Indian goods are re-exported via third countries to Pakistan, and the third countries include nations like the UAE, Sri Lanka and Singapore, and it's primarily items like gold, gems and jewelry, electronics and e-commerce goods which are re-exported to Pakistan via these countries. Now, as per GTRI, Indian goods worth over $10 billion per year reach Pakistan from these third countries, which may face fresh curbs based on the assessment which is underway. It remains to be seen what happens with respect to the assessment and based on the stakeholder consultation, based on the information which reaches the government from various departments, any further action would be initiated.
Thanks a lot for that, Abhimanyu. Well, for the time though, we'll have to wrap up on this edition of Chartbusters. You stay with us. Trading Hour comes up next.
Good morning. Welcome to Tuesday's Trading Hour. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Reema Tendulkar. With me is Vinny Motiwala. And today is a quiet session. After the over 1% rally that we had yesterday, today markets are consolidating, at least in the morning. Midcap action is intact. The Midcap index is up 0.5%, and defense That's the big star today. It rallied close to about 3-4% yesterday, and today it's followed it up with another 3% gain on expectation that government spending in the defense sector will continue to remain healthy and will continue to grow, which is why BEL is your top gainer in the Nifty pack. But outside of that, a Mazgaon Dock, HAL, Paras Defense, cutting across market capitalizations, all the defense stocks are buzzing high.
Hi Rima, good morning. So yes, defense is a trend that we're seeing today as well. And other than that, auto ancillary names, they are too buzzing in trade. Updates coming in on the Trump tariff front is something that are keeping the auto anch names in focus today. Now, sector-wise, when you're looking at pharma is not managing to hold on to gains today. It's among down almost 5/10 to 6/10% in today's trading session. So let's watch out for that. Some bit of a recovery that's coming, but pharma is surely down and out in trade. Other than that, we also have FMCG that's not managing to hold on to gains. So that is something to watch out for. What's doing well, what's managing to hold on to the green, PSU banks and realty are among the top gainers in terms of sectors that we're watching out for. One stock that I do want to highlight as well, Whirlpool India, that's also buzzing in trade today, 3% uptick for Whirlpool India. There was some news article that came in from Economic Times, but yes, we're seeing Whirlpool, 9% uptick in the last few minutes. So it's seen a 3% uptick as well. So keep an eye out on that. So yes, Rima, that's how the market setup is looking like. An interesting day that's coming in, though not much in terms of a trading up move that we're seeing for the benchmark indices. But let's bring on board Varun Locha from HDFC Securities also, who's joining in with us to discuss the market fundamentals and his top sectoral picks as well. Varun, good morning. Thank you so much for joining in with us. In terms of the market, we are amidst the earnings season. So overall for the Indian markets, given the geopolitical situation as well as earnings, what are you watching out for and what is the growth that you're expecting this earnings season?
Yeah, good morning. So earnings season this time around is largely on expected lines. We are expecting some more downgrades even in this quarter, largely led by IT and some of the global businesses, like global centric businesses. Domestics, again, domestic cyclicals are still not showing a very strong recovery. I think financials has started off well in terms of earnings season, so that out there we are seeing some marginal upgrades to our estimates. So net, we believe, this year, FY26, we are expecting around 12% earning growth, which is not, I would say, really strong, but better than last year. And there are still some marginal risk to the downside on the earning estimate, but I think the pace of downgrades is definitely reducing. So Q3 and Q2 had very sharp downgrades. Q4 would be a tad lower, and we expect by Q1 we'll be largely done with the downgrades.
Do you have you done the analysis so far in Q4? What's the upgrade downgrade ratio looking like, or the percentage of overall downgrades, and where is it that we've seen maximum pain?
See, so far only 50 stocks out of our coverage of around 240 to 50 stocks have reported. So in that, as I said, financials have generally done better than what we were expecting, and IT, despite we cutting numbers in our preview itself, have seen further downgrades. So I would say, and cement has done better. So those are some of the pockets. Consumer is still on the weak side, but a lot of the numbers are yet to come. So net, I would say as of now, it would be even Stevens, like 50% in terms of upgrade downgrade, with banking leading the upgrades and IT leading the downgrades.
Okay, banking leading the upgrades, IT leading the downgrades. But, right now, what sectors will you look at to buy also as of now? Financials, will that be something that you'll keep looking at? Or maybe, where you're seeing a bit of a correction, pharma, IT, that is also something that attracts you?
I think, the market are not, at a stage where you can expect a very high return at an aggregate level. So in that sense, a lot of frequent rotation will continue to happen even in FY26. That's our view, because valuations are really capping the upside at an aggregate level. At the same time, the downside also beyond 22,000 look unlikely unless we have some really major earnings cut event, either led by global developments or the domestic developments. But as of now, we are not seeing a level below 22,000 either. So in that scenario, we have been having financials as one of our top picks for last 6 months. We were progressively adding that, and we were underweight IT. That has played out to a large extent. While we still continue to prefer financials over IT, but I think IT with the recent correction and financials with the 20% kind of an up move are now looking more balanced in our view. And if there is some more financials rally, then we would be taking money off financials as well, because it's not that financials are going to have a very strong earning growth in FY26. So it's a sort of a range bound market with more rotations and frequent rotations across some of these sectors. Beyond these, I think pharma, as you said, we are still positive, but both IT and pharma, we had cut our weights because they were the only performing sectors last year when domestic cyclicals were under pressure. And in fact, we had added some exposure to domestic cyclicals, both industrials, real estate after the correction, and even consumer discretionary. So those are the other two pockets, some of the consumer discretionary and industrials, real estate sort of segment where we have added exposure. And IT, pharma, if they correct a bit more, we will be looking to add them back.
You said in financials, if they rally a bit more, you would look to trim your positions. So about a 5-10% rally from here on, and then you would look to unwind in which stocks? Which are the stocks that you hold right now where you think, which are prime for profit booking?
See, I think some of the large NBFCs, they have already done well, and now again valuations are starting to look full. Like, some of our, we had gotten quite positive on both Bajaj Finance and Chola. While we still have positive rating, we don't have much upside left on our target prices now in those two stocks. Similarly, some of the large private sector banks, while we continue to like ICICI, Axis and all, but I think the extent of upside left now is a tad limited. So even Kotak Bank for that matter, the upside left now on our target price seems to be on the lesser side. So some of these would be the names where we would be willing to take profits if they rally further.
Okay. Varun, what is your thought coming in on the broader end of the markets? While you did say some of the sectors that you like and you listed out those sectors, but is it more on the large cap side in these sector names that you would look, or would it be more on the mid and small cap side?
I think mid and small cap this entire year, calendar year, we believe are going to underperform the large caps. Valuations are still on the higher side, especially in mid cap, not so much on small caps now, but small caps are anyway struggling for growth in this sort of an environment when neither the domestic growth nor the global growth is too supportive. So we are looking for more ideas in large cap because I think the margin of safety, even from a valuation perspective and resilience of growth perspective, is better in large caps. Mid and small cap, very selective. So some of the selective mid cap where we are quite confident on the medium term growth out there, we are looking to add on dips. But otherwise, generally preferring large caps. We expect mid and small caps to continue to underperform this year.
Okay, and your thoughts coming in on the real estate side. Last 6 months, we've seen a bit of a correction coming in for these real estate names. Would you stay away from these names, or would you look to enter real estate right now?
No, so this is one of the sectors which we are looking to add in this correction because on the numbers we are quite confident that we'll continue to see robust residential sales even in FY26 and 27. We don't believe we are at the end of the rally, while obviously from COVID lows you have seen very high pre-sales growth for some of these developers. That will not continue. But still, it would be a healthy number and there would be a YOY growth. Valuations had gone through the roof 6 months back, but now with almost 30 to 50% correction in a lot of these names, some of them are looking attractive. So we see this more as a consumer discretionary segment where we are confident on medium-term growth and therefore looking to add some of the names in the recent correction.
What would you look to add, if at all, in IT? Would it be the ER&D companies which have fallen 35-40% from their recent highs? Would it be the IT services companies where the free cash flow yield is now looking attractive, but growth is missing? Where would your preference lie?
So for last 6 odd months, our preference was for large cap IT over mid cap IT because valuations were looking stretched out there. While Midcap IT, obviously, some of the names have been doing exceedingly well in terms of growth. We believe the valuation premium they were enjoying is a bit on the higher side. So I would go with large cap IT where there is some valuation support of free cash flow yield coming in with this correction. Our first, sort of point of entry would be out there because we believe the growth rates, even for some of the mid-sized companies which have done exceedingly well, will also slow down in this environment, and therefore, it's better to have some margin of safety in valuations in this sector, given the sort of uncertainty we are in terms of the top line growth.
Varun, just the last word from me is what I want to understand in terms of overall macro indicators. When you look at some of the points coming in, industrial output, credit growth, some of the trends in terms of inflation seems to be like that the worst is behind. Is that the case? And for the rest of the year of FY26, what is the overall growth that one could expect or pencil in terms of earnings?
Yeah, so as our house view has been that the macros have definitely bottomed out. What we saw in Q2 in terms of the GDP growth and inflation at that point of time, they were probably the worst, and incrementally things are getting better. Be it growth, be it inflation, be it the interest rates, be it the RBI sort of stance in terms of providing liquidity and cutting interest rates. So therefore, the downside to the market is limited, but at the same time, the upside, because we are still not in a high growth environment. Our GDP growth this year would be close to 6.3. Next year will not be substantially higher. So in that sense, earning growth, as I said at the beginning, would be, right now we are penciling in around 12%. And if you ask me, the chances of it becoming 10% are higher than chances of it going to 15-16%. So therefore, your upside gets capped. The moment you have a 10% kind of a rally, the way we had in April itself, your upside start getting capped. At the same time, the downside, the 22,000 level, we have seen that a lot of stocks start getting attractive once they come around those levels. So I think it's going to be a range bound market for another 6 months before we either, by that time, if we remain range bound, then valuations will become even more comfortable, and growth, we believe, will incrementally pick up more in second half of FY26.
Okay, markets range bound for the next 6 months. 22,000 is a hold. Is perhaps the bottom for the markets in the near term. Thank you, Varun, for joining in. We'll get into a break. On the other side, we'll talk commodities. Manisha Gupta joins in on the other side.
Hello, welcome back to Trading Hour on CNBC TV18. A quick look at what the market is doing as of now in terms of broader end of the market, managing to hold on to that gain. Advance decline ratio as of now is in the favor of advances versus decline is what we're seeing. Nifty Midcap holding on to gains of 0.5%. Look at the ratio as well as of now. Advance decline ratio 1,621 stocks in the advance versus 865. But yes, market setup looking, managing to hold on to gains, so not much to complain on that front. But what's happening in the world of commodities? commodities. We have Manisha joining in with us to tell us what is she focusing on this morning and what should we keep an eye out on. Good morning, Manisha.
Morning, and thank you for that, Vinny. I'm looking at copper prices, which have seen a decline of around 4% for the month of April. Well, the month of April clearly has been a very volatile year when it comes to copper prices. For the year, of course, we are up by nearly 22% right now. But as I was saying, we saw all-time highs in the US markets when it came to copper. Well, this was all ahead of the tariff that came unleashing around and an expectation that you could be looking at some tariff concerns coming in for copper as well. So for the US markets, we saw a 3-month lows at around $4.03, and then we saw an all-time high of around $5.27 a pound as well. So that's the kind of range that we've seen into the markets. As far as LME is concerned, while we did see very sharp declines there, but for the month of April, we are still up by 15% from the kind of lows that we saw. Having said that, this month is getting into negative when it comes to copper prices there. Well, to depend upon, China has increased its copper production, managing demand as well. And then there's uncertainty about, as I said, on copper being included in the trade barriers there. If you look at the Chinese copper inventories, well, we have seen a record weekly drop coming in for this one. And the Shanghai inventories have declined by 50% in the past 1 month on strong opportunity buying by the physical players there. Chinese demand has been quite resilient. We do understand that the downstream companies are creating stocks as well. And then China also has started to come out with various stimulus measures and expectation of more going forward to boost consumption, and that perhaps could be supportive. The other important news coming in from Russia is that they are also increasing production of gold and copper going forward, because whether it comes about traditional ways of copper consumption or the new generative and energy transition ways of copper, you are looking at higher demand going forward. So markets believe that whatever decline that we had to see in copper perhaps has been done for the month of April, and from here on you could be looking at buying opportunities for this one.
Thank you very much for that. Get into a break. On the other side, market technicals lined up with Mitesh Thakkar. He'll also give us a few trading bets. Welcome back. It's going to be a big earnings day today. So you've got BPCL, Trent, Bajaj Finance. For Bajaj Finance, apart from numbers, the company will also deliberate on a stock split and a bonus share issue, and lots of interesting mid-cap companies like IndiaMart. IndiaMart post the Q3 numbers and the disappointment has fallen close to about 8 to 10%. So whether there is a recovery in IndiaMart will also be tracked very closely. So big earnings day today. But let's welcome, as promised, Mitesh on the show. Mitesh, quiet so far. So how would you approach trade? What's the strategy and your stock picks?
So, good morning. One, I think, I was highlighting that try and take profits once we get closer to 24, 450, zone. I think we've kind of retreated from there. This market to me still looks like we possibly do some kind of sideways consolidation with 24,000, 23,850 as the lower end and 24, 450, 500 as the upper end of the range. So next 2 days, I think, traders should be slightly agile and nimble in looking profits as we approach the upper end of the range. On the stock side, I have a buy on Siemens. I think that's a stock which is breaking out today. Buy here with the stop just below levels of 29.30. and look for a target of 30.60 on the upside. And BEL is also having a good price volume breakout action. So buy here with a stop at 310 for targets of 330.
Okay, Shirley, thank you so much for that. We'll keep an eye out on those stocks as well as the levels in the market as well. But let's move on. And IndusInd Bank has announced that its Deputy CEO, Arun Khurana, has resigned with immediate effect, weeks after the private lender disclosed accounting lapses in its derivatives portfolio. Ritu is here to give us more details on this one.
Well, thanks for that. In what is clearly a fallout of the accounting discrepancies in IndusInd Bank's derivatives portfolio, Deputy CEO Arun Khurana has resigned with immediate effect as of yesterday. As we reported a couple of weeks ago, this was likely because Khurana was overseeing the Treasury Front Office, which is the division responsible for the derivatives portfolio, where incorrect accounting had led to a near 2,000 crore rupee hit on the bank's P&L. In his resignation letter as well, Arun Khurana has cited the recent unfortunate developments linked to the discrepancies and this P&L hit as the key reason for his decision. Now, this resignation comes just a day after the bank disclosed that an independent investigation had identified the key individuals who were responsible, and the bank had stated that the board will determine changes and realign senior management responsibilities based on the report's findings. Now, we understand that this independent investigation was conducted by Grant Thornton, which has pegged the adverse financial impact at about 1960 crore rupees, which is very close to the 1979 crore rupee hit, which was determined by external auditor PwC earlier. The bank will now account for this loss in its fourth quarter earnings. Meanwhile, the Reserve Bank of India has already shortened CEO Sumant Katpalia's tenure to March next year, and as we had reported, asked the board to submit the potential CEO candidate names by October. So the accounting fallout is triggering top-level exits, and this may not be the last one.
Okay, Ritu, thank you so much for that. We'll keep an eye out on more updates that come in from IndusInd Bank. But let's move on and talk about TVS Motors. That has slipped in trade, and this is despite a strong set of numbers that came in Q4 FY25. And this is why, as the management had indicated and indicates some caution on growth. Sudarshan is here to give us more details on what is the highlight he's picking in terms of the management as well as the numbers. Good morning, Sudarshan.
Good morning, Vinay. So I'll divide TVS in two parts. First, talking about the earnings. Earnings were beat than estimates. If you talk about the reported numbers, margin had come in at 14% against our estimate of 13%, but this margin of 14% had included PLI benefits. If you exclude PLI benefits, now the margin was at 12.5%, which was largely in line with all the estimates. Now coming to the commentary, we start with the global outlook. Company is saying the major market, that is the African market, that has hit the bottom, and from here on, growth should improve going forward. Now coming to the domestic growth outlook, company is saying that FY26 should be similar to what the industry had seen in FY25. So in FY25, TVS was one of the companies which had outperformed all the other companies. Two major outperformers from two-wheeler space were Eicher Motors and TVS. Now, why the stock is under pressure? The reason is company has cautioned about Q1. It's saying that there might be some moderation in Q1, especially in the month of April, because last year in 2024, April had seen a base effect. But again, here also, it's saying that May and June are going to be strong, considering the number of marriage dates this year is more than what the industry had seen in 2024. Now, another reason of stock being under pressure is the most expensive stock in the two-wheeler space, and results were better than estimates, but due to mixed commentary, you are seeing a fall today.
Thank you very much for that. PNB Housing Finance has posted good numbers. The net interest margin is at a 6-quarter high, and that stock will also come up for you on your screen. It's soaring in trade. Abhishek is here with the details.
Well, all-round performance has been strong from PNB Housing, whether PNL or the business momentum as well. So take a look at net interest margin. It's at 6-quarter high of 3.75% versus 3.7% in the previous quarter. The spreads have declined by 10 basis points quarter-on-quarter to 2.19% versus 2.29% in the previous quarter. Asset quality continues to improve. Gross NPA ratio at 1.08% versus 1.19% in the previous quarter. This 1.08% is perhaps at a 22-quarter low. Disbursements are robust. Growth is over there, 23.7% YOY and about 24.5% sequentially. The disbursements to AUM ratio has improved to close to 52% versus 39% in the previous quarter. So tenure of the book has increased, and that's caused AUM growth to remain on the healthier side when compared to previous quarters. So the AUM growth is close to 12.9% YOY and 4.5% sequentially. YOY, the AUM growth of 12.9% is perhaps at a 21-quarter high. Back to you.
Okay, Abhishek, thank you so much for that. But on that note, we're going to slip into a very short break. And on the other side, we'll be joined by Rishi Gupta, MD and CEO of Fino Payments Bank, to discuss the company's performance in the quarter gone by.
Welcome back. Sterlite Tech is under pressure, down nearly 5%. It's not numbers. Numbers are not, it's not related to numbers, but you can see significant weakness in Sterlite Tech, and that's fallen on pretty large volumes. Shriram Finance is correcting for the second day in a row. Yesterday, stock was down 5%. It's fallen another 1% today. And even L&T Finance is a bit subdued in trade. Castrol deserves mention because it's again falling on pretty large volumes, 2% down on that. On the way up, it's many of your banking names. So a UCO Bank, Equitas Small Finance Bank, Bandhan Bank, AU Small Finance Bank, Punjab and Sindh Bank, Central Bank of India. These are stocks where there are gains anywhere between 2 to 3%. Mazgaon Dock Shipyards has hit a fresh 52-week high. The stock is now inching towards the 3,000 rupee mark. And Samhi Hotels is up nearly about 5%. So Eternal, earlier Zomato, is also one of the big movers today. But let's talk about RBI's unexpected announcement yesterday. They will be buying an eye-popping 1.25 lakh crore of bonds over the next 4 weeks. Lata's here to explain what may have prodded the RBI and what the impact is of this.
Yes, that's right. The Reserve Bank is going to buy 1.25 lakh crore of bonds in 4 tranches from May 6 to May 19. Announcement came late on Monday, surprised the market because already the interbank market has excess liquidity of over 1 lakh crore, and which is why the one-day money, what you call the call rate, is trading below the repo rate because there's excess money. The market has 2 sets of guesses why the Reserve Bank would put more money when there is already money in the system. One is it could be because of the FX positions of the Reserve Bank. They had entered into a lot of buy-sell swaps. The sell leg would be maturing now. The data we have is that as of February, they had $80 billion of sell positions. Maybe 30 to 40 billion is maturing now in April and May. And that's why they're standing prepared with extra liquidity, because when the RBI sells the dollars for the maturity, it pulls back rupees and it may take away rupees. The other guess is that no, there is enough dollars coming in from FPI bond and equity funds to meet that RBI sell. This is because the Reserve Bank is calculating for the year as a whole, the shortfall or the liquidity withdrawal would be to the tune of 4 lakh crore. This is how the math is being worked. Cash withdrawal is always there by you and me during festival season. That is about 2 lakh crore over the year. And another 1 lakh crore is set aside by banks for cash reserve ratio. You know, what is cash reserve ratio? Every time you make a deposit, 4% should be kept as cash. That would take away 1 lakh crore. The other 1 lakh crore is Reserve Bank owns bonds which mature this year. When the bonds mature, the bonds are returned and money comes from the government to the Reserve Bank. So that is liquidity withdrawal. To replenish that, part of this is coming as 1.25 lakh crore. Whatever be the prodding, the impact is that bond yields have fallen by about 7 to 8 basis points today, from 6.4 plus to 6.3334, and banks and NBFCs are having a very good day, and that's because the rate cut transmission is expected to happen very quickly when there is good liquidity.
Okay, Lata, thank you so much for that. But do stay on with us because the Monetary Policy Committee only voted on the rate cut in April and February policies, not on the stance. This was revealed by the external MPC member, Dr. Saugata Bhattacharya, to CNBC-TV18. And we spoke to him today. Lata is joining in with us and she's here to actually explain us and put this into context. What does this mean as well, Lata?
Well, it is not very widely known that the MPC, when it meets every alternate month, votes only on the rate, the repo rate, not on the stance. Because the experience is not very clear. What Saugata Bhattacharya, the external member of the current MPC, told us is that in the current and the February MPC, there was no vote taken on the stance. People were generally asked. The vote was only on the repo rate, which was the action was to cut. Now, what he explained is that under the RBI Act, which was amended in 2015 by the flexible inflation targeting framework, the position was made very clear that whether the repo rate will be hiked or paused or kept unchanged or cut will be taken by the MPC by a vote. It was left at that. Anything else can be put to vote by the chairman of the committee, which is the RBI governor. So mandatorily, the stance need not be put to vote. Dr. Bhattacharya also told us that the experience has been depended on the governor. From 2016, when the MPC first started, to 2018, under Governor Urjit Patel, the stance was not put to vote. Under Shaktikanta Das, from 2018 to 2024, the stance was put to vote. Under the new governor, the opinion is sought, but it is not put to vote under Governor Sanjay Malhotra.
There is no mention of a vote for a stance. There is no mention of a stance. There is that phrase that the chairman of the MPC, which is the governor, the RBI governor, has the right to put in. I'm just paraphrasing. I don't remember the exact wording of the act. That the chairman of the MPC has the right to pull in anything that he or she might deem important at that point in time. Also remember, in terms of history, that the stance, voting on the stance, was only introduced in October of 2018, and not before.
Okay, moving on now to corporate earnings. For Fino Payments Bank, Q4 turned out to be a good quarter. Rishi Gupta, Managing Director, CEO, is now with us. Thank you very much, Mr. Gupta, for joining in. So you delivered on your revised guidance of 25%. At the start of the year, it was 20% for FY25. You upped it during the course of the year to 25%, and you managed to deliver on that in terms of a top line. Now for FY26, what are you guiding?
So right now, good morning to all your viewers. So for 24-25, we have said we'll do a 25% growth, and we have been able to achieve that growth for 24-25. For 25-26, we have not put a guidance number right now as such, but looking at the momentum, we see a healthy growth in 25-26 as well, compared to what we happened in 24-25. You also have to factor the fact that the base has also substantially grown in the last couple of years.
So you're not giving a guidance for FY26?
Yeah, right now we are not giving any guidance for 25-26, but we will come back at the appropriate time.
Why? You typically give a guidance. So what's stopping you this time? I understand the base is bigger, but that may affect the growth rate.
So our guidance have been, like we were used to say 20% earlier. In 25, we said 25%. At 25-26, right now we say between 20 to 25% is something which we are looking at. But to get a better exact number, it will take a little bit more time because there's a lot of changes which is happening in the ecosystem as we speak.
Can you talk about that and why you fear that might, I mean, how will that impact the way the growth pans out for the company?
See, we have grown substantially in the last year. We have seen a big growth happening on the digital side as well as on the CASA numbers. And the base itself has grown substantially from our opening numbers in 23 for CASA and 24 for digital.
To grow on top of that, we have to add more products, which we are in the process of approvals, as well as some being getting rolled out in the next 1 or 2 quarters. So looking at the growth of those products and looking at the approvals which come in our way, that is where we said we need a little bit more time to come at a more firm guidance, so to say.
Right. Good morning, Mr. Gupta. Thank you so much for joining in. This is Vinny this side as well. What I also want to know, there was some persistent weakness that we saw coming in on the micro ATM side, certain issues on remittance business as well. So why is it, still continuing? Do we expect this to still continue in going forward as well? And because we've seen a decline, QOQ, YOY, whatever you compare. So what are we watching out for?
Yeah, you're absolutely right. Actually, as a company, we have moved from a more of physical company to more digital company. Nearly 50% of our revenues are coming from UPI and related digital products. The physical ecosystem has come down in the last couple of years, mainly because of remittance as well as micro ATM. We have also seen a lot of customers who used to come to our platform to do such kind of products have now become our own customers, and we see that revenue shifting from transaction to more ownership revenue, so to say. So part of the shift, which part of the decline is because of the shift of customers from transaction to our own customers. Part of it is also because of the ecosystem change and some regulatory changes which have happened specifically in case of remittance in the last 6 months. So we expect that the numbers of Q4, which is there, largely to be there for the full year as such for 25-26.
Also, just want to understand in terms of your margins, what are we expecting there as well? What is it that we watched out for in terms of Q4? Seems like overall margins somewhere were at 12.95%. From here on in FY26, what could we expect?
So when we look at the net revenue margin, that is something we keep on giving guidance around. It's been around 30 to 33%. And we expect that the net revenue margin will be in the same range. Even for Q4, it is around 31.5. So it's in that range. Will continue to be that range. Our PAT numbers have been, PBT numbers have been around 6%. And hopefully we'll continue to be in that 6% range. And maybe as we go forward with more of our ownership products, the margin should go up.
Mr. Gupta,
one more thing which is important is that in the last couple of years, we have done large capex on the IT side, which has impacted the depreciation as well as the operating cost or the OPEX on the IT. So that is substantially increased in the last 2 years, 3 years. And we expect that momentum to continue because a lot of IT spend is actually being done on the back of the digital growth, which we are seeing.
I think CASA is now, what, 24-25%?
CASA, if I include the liability income, which is the treasury income on the CASA deposits, is about 30% for the full year and 31% for Q4. And we have seen a substantial jump on the CASA overall revenue by 42% in 25 over 24. And similarly, digital now contributes to nearly 21% of the overall revenue. So between digital and CASA, more than 50% of the revenue is coming in 24-25.
And how will these numbers trend going ahead? So CASA currently is about 30-31% and digital is 24%.
21%.
Sorry, 21%. I know, yeah. So your own expectation on these two?
My own expectation is that between CASA and digital, we should be somewhere between 55 to 60% for the full year in 25-26.
Okay. Mr. Gupta, I just have one doubt is in terms of why have you stopped giving those debit card spend details that we used to see coming in before as well? My colleague has highlighted it, Abhishek. So I just want to know what is it in terms of why is that missing as well as overall in terms of the sustainable run rate for growth in terms of spends also like you were talking about previously. So what is that we could expect in FY26?
So you are absolutely right. In fact, if you look at ecosystem, you look at our own way we deal business. We have stopped using debit cards to a large extent. Everybody has moved to UPI. So if you look at the UPI P2M number, which is just flashing it on your screen right now, we'll see a substantial jump, nearly a 2x number for the full year compared to what was there in 24. So debit cards in particular or in general, the spends have come down. People have moved to UPI now rather than debit card. So debit card volumes have not grown, where the number of cards should have grown, but the usage has not grown to that extent because of the shift on the consumer behavior from debit cards to UPI. There is no other reason.
Mr. Gupta, we'll leave the conversation here. Thank you very much for joining in, and we'll await that official guidance for you. We're used to those structured numbers, so we'll await that. Thank you very much for joining in. But the company, in a way, is saying 20-25% growth is sort of sustainable. But we'll slip into a break on that note. As we do that, some good news for all our viewers, because India's business news leader is now just a click away, introducing CNBC TV18 all-new app. Get instant access to breaking news, our articles, financial world updates at your fingertips. Don't wait. Download the CNBC TV18 app now from the Apple Store or the Google Play Store, or you could just scan the QR code on your screen. Welcome back to Trading Hour on CNBC TV18. Let's shift focus to gold now. We are witnessing a true gold rush, not fueled by inflation, not just by financial markets, but by geopolitics, trust and fear. Why central banks are hoarding on gold? Prashant is joining in with us to explain us that.
Let's take you into a global financial story that's unfolding quietly but powerfully. A new gold rush 2.0, led not by consumers or investors, but by central banks. Why are the world's top and most powerful monetary authorities hoarding gold at record levels? Let's break it down. Let's look at the pace of the rise in gold prices to begin with. Now, the rise in gold prices is not new, but the tempo has shifted. After the US abandoned the gold standard in 1971, it took nearly 38 years for gold prices to hit a $1,000 mark, a milestone finally reached in March of 2008 during the global financial crisis. The next leap was quicker. Gold doubled to $2,000 in 2020, August 2020, fueled by the economic uncertainty of the COVID-19 pandemic. That took 12 years. But the pace has since accelerated dramatically. On March 14, 2025, this year, spot gold prices broke through the $3,000 barrier for the first time. The climb now for the last $500, $25 to $3,000, took just 210 days. A stark contrast to the previous $500 increments, which historically averaged more than 1,700 days. Now, gold's rise is no longer gradual. It's gathering speed. Now, the analysts at JP Morgan have divided the gold era, modern gold era, into three regimes, three periods. Let me put this out. First, as a pure inflation hedge from 1970s to 1990, then as a mirror against real US bond yields, 2000 to 2021, and now a geopolitical safe haven driven by central banks pivoting away from the US dollar. And of course, I mean, you could add a fourth one. There is Trump driving an American breakup from the rest of the world. Let's take it one by one. The first era, in the 1970s and 80s, gold was all about inflation. When inflation expectations surged, and they surged to 8% in the early 1980s, gold prices exploded eightfold. But once Paul Volcker, the then Fed chair, crushed inflation with aggressive rate increases, gold prices collapsed. Now, from 2000 to 2021, this is the second era, the second regime, survey-based 10-year inflation expectations remain largely anchored between 2 to 2.5%, while real gold prices increased significantly. Now, this was a new dynamic, a newer relationship. Now, the relationship between gold and US treasuries is rooted in the competition between two so-called risk-free assets. Gold, which offers no yield, becomes less attractive when real yields on longer-dated US treasuries rise, because the opportunity cost of holding gold increases. Conversely, when real treasury yields fall, gold becomes more appealing, more valuable as a store of value. In the 2 decades starting 2000, gold consistently showed a strong opposite inverse relationship with a 10-year US real treasury yield. And this is the third stage then, the rupture. In 2022, US and its allies froze $300 billion of Russia's foreign reserves. This shocked the world. Suddenly holding dollars or euros or other currencies, paper currency, wasn't just about economics. It carried geopolitical risk. Since then, central banks have turned into super buyers of gold, price insensitive. Price matters little, securities matters a whole lot more. Adding to this, the US under Trump 2.0 has moved towards isolation, America first foreign policy, pulling back from alliances like NATO, the United Nations, the World Trade Organization, and of course, as I described earlier, weaponizing sanctions as well. This has reinforced the instinct amongst many nations to diversify their reserves, and gold is the fallback. The result, a historic buying spree surge. Central banks used to buy around $400 tons of gold per year. In 2022, they bought more than 1,080 tons, the highest on record then, and they kept going. 1,051 tons in 2023, another 1,045 tons in 2024, and this year, 2025, has started no differently. Today, central banks collectively own around 36,000 tons of gold, nearly 18% of the total reserves. That's a sharp jump higher from 15% just a year ago. I mean, 3%, right? But it's happening at the highest levels of global finance. It's meaningful, it's chunky. Meanwhile, you can ask the question, is supply of gold keeping pace? The answer is no. Mining output has been flat since 2018, constrained by falling ore grades, rising extraction costs, and stricter environmental regulations as well. In short, you got demand, which is strong, central banks are big buyers, supply is constrained as well. I mean, just a factoid, right? I mean, interesting factoid, just to remind us that gold is rare and that scarcity drives value as well. If you look at all the gold which has been mined through human history, it's about 2 lakh tons. It's enough to cover a soccer field, but only to a depth of 1 meter. And most of that gold is with us right now. To conclude, what we are witnessing is a true gold rush 2.0, not fueled by just inflation, fiscal deficits, paper currency debasement, etc., but by geopolitics, trust and fear. In a world where financial assets can be frozen overnight, gold once again is the ultimate fallback.
What an interesting link, Prashant. Thank you very much for that, and ending it with that factoid. Now let's get to the big earnings that we're tracking today. So first up, we've got Abhishek joining in with the key expectations from Bajaj Finance. Abhishek.
Well, Bajaj Finance gave out the preliminary numbers with respect to the business momentum, wherein the AUM growth was weakest in 8 quarters on a YOY basis and weakest in 11 quarters on a sequential basis. So key things to watch will be the net interest margin can decline both YOY and quarter on quarter. Kotak Securities estimates a 71 basis point YOY and 14 basis point quarter on quarter decline in net interest margin. Now, credit costs can decline on a sequential basis as well. Kotak Securities estimates an 18 basis point decline in the credit cost of Bajaj Finance in Q4 FY25. Cost to income ratio can rise marginally but remain stable. So, Kotak Securities again estimates a 16 basis point increase in cost to income ratio. Now, stability in asset quality will be positive. Management commentary with respect to future outlook and guidance for FY26 will be seen closely. Our polls suggest NII growth of 23.3% YOY and about 5.3% sequentially. We are working with a profit growth of 19.7% YOY and about 6.3% on a sequential basis. Back to you.
Okay, thank you so much for that, Abhishek. But we have Sudarshan who's here to tell us in terms of BPCL, what are they expecting from the Q4 numbers? Sudarshan, over to you.
So earnings for BPCL might be slightly on a weaker side, mainly because of fall in refining and marketing margin. Marketing margin Q4 FY25 has fallen up to ₹4. Now coming to the headline numbers, profit is seen falling 42%. Revenue may be subdued, maybe just see an increase of 1%. EBITDA can fall up to 31% and margin can come below 5%, likely at 4.6% versus 6.7% that company has reported in Q3 of FY25. What about the GRM? GRM may fall YOY, but on a sequential basis, it might be flat. It might come at $5.60 per barrel versus $12.50 per barrel that company had reported in Q4 of FY24. crude throughput may increase and it might come at 10.4 million tons versus 9.5 million tons reported in the last quarter. What would be looking in the management's commentary? First, what's the on volume front of the two major refineries, and second, what's the update on Nunukan block, because company had announced investment of $121 million, and what's the update on listing of Maharashtra natural gas, and also lastly about the crude sourcing after Russian sanctions.
Thank you very much for that. And Ambuja Cement will report their Q4 numbers. Nigel is with us.
Well, that's right. We'll keep an eye on Ambuja Cements, and what will be new in these numbers will be the standalone part of the business. But most of the street have given the consolidated numbers. Why do I say the standalone numbers will be the new part of the business? Because we already have numbers coming in from ACC as well as Sanghi, which will be incorporated in their consolidated numbers. Nonetheless, in terms of the numbers, the expectations on a consolidated basis, 9,900 crores is what we're looking at in terms of the top line. The EBITDA number should come in at around 1,600 crores ballpark, which on a sequential basis will show a big jump because Q3 was an absolute washout. The margins as well should scale to close to mid-teens. That compares with sub 10% margins that they delivered last time around. The important factors to track, how are the inorganic acquisitions moving around? That's the Sanghi Industry acquisition, the Penna Cement acquisition as well, and what's the path that they're laying out there. The growth on the top line will be led by volumes, and volumes are estimated to grow by around 15 to around 19%, primarily led by inorganic growth. Blended realization should decline on a year-on-year basis, though on a sequential basis will spike up by close to 2 to around 3%, though the costs will decline. Remember, in Q3, you had a one-off high maintenance cost, which this time around will not be there. The profit number, well, we'll see a bit of a restriction in terms of growth, because there'll be higher depreciation costs. For these companies that have already delivered parts of their business, the commentary is most important. And for Ambuja Cements as well, will be important to hear how they see pricing, demand, as well as how they integrating the inorganic growth. Back to you guys.
Thank you very much for that. And Trent will be the other big one to track today. They've already given a Q4 update where the company has spoken about a 28% top-line growth, which is the lowest analysts point out in the last 16 quarters. And FY25 growth will be about 39%. So we have a sneak peek into what the quarter will look like. But the street will track very closely in terms of the store additions, the guidance on revenues, the extended end-of-season sale, which could impact margins. So lots of details awaited. This is a highly tracked company. The stock is corrected nearly 37% from its 52-week high, and still it's quite expensive at about 70 times forward PE multiple. So Trent is the other big one to track today. Get into a break. We'll come back with more on the markets. Welcome back to Trading Hour on CNBC-TV18. Now, sources tell CNBC-TV18 that India is considering restricting the export of electronics and e-commerce goods to Pakistan. The move comes against the backdrop of escalating tensions between the two countries. Abhimanyu is joining in with us to give us more details on this front. Abhimanyu?
Sources have indicated that after Indus water, Indian electronics and e-commerce goods may face curbs for Pakistan because after passenger traffic, there is a likelihood that air cargo route over Pakistan may get severely impacted. Sources have indicated that the government is collating data from the Customs Department and several other departments to understand the logistics cost for exporters in case of any further disruptions. Also, plans are underway to assess the impact of trade to UAE and Europe as part of multifaceted preparations for a possible disruption which may happen for trade. Also, sources explained that direct trade between India and Pakistan is minuscule as most Indian goods are re-exported via third countries to Pakistan, and the third countries include nations like the UAE, Sri Lanka and Singapore, and it's primarily items like gold, gems and jewelry, electronics and e-commerce goods which are re-exported to Pakistan via these countries. Now, as per GTRI, Indian goods worth over $10 billion per year reach Pakistan from these third countries, which may face fresh curbs based on the assessment which is underway. It remains to be seen what happens with respect to the assessment, and based on the stakeholder consultation, based on the information which reaches the government from various departments, any further action would be initiated.
Thank you very much for that. As we wrap up the show, here is some good news. Network 18 is the leader in the news information category in the on-platform leadership network level, with 183.2 million unique views, beating Times Internet as per ComScore MMX report as of March 2025 at the Social Plus on-platform leadership network level. Network 18 is the runaway leader as per Social Plus MMX ComScore report for March 2025 with 315 million unique views, which is 55% more than the nearest competitor Times Internet at 202 million. News 18 was also races ahead of Times of India. In terms of Social Plus MMX cumulative reach, News18.com overall clocked about 255 million unique views to beat Times of India overall, with 183 million unique views as per the ComScore report. This is all as per March 2025. As per the social media metrics report, Network 18 is 2 times bigger than its nearest competitor with a 54% reach within the 389 million overall social population. And speaking about Indian languages, in terms of Social Plus MMX, the cumulative reach of News 18 Indian languages is the leader in the category with 182 million unique views as per the Coms report.
Stocks swing up and down amid tariff uncertainties. Capital goods and energy eke out gains, while healthcare and FMCG drag. Midcaps fare better.
Arun Khurana, the Deputy CEO and Executive Director of IndusInd Bank, resigned yesterday, taking responsibility for the deviation in derivative accounting. This confirms the CNBC-TV18 news break, where we said that the revelation will lead to 3 senior exits.
KPIT Tech holds back from giving a guidance and expects a soft first half in FY26 and tariff uncertainties, but is confident of delivering 18 to 20% growth annually, sans externalities. Hexaware too sees growth perking up as the year progresses.
The RBI has announced a mega liquidity infusion of 1.25 trillion rupees via the open market bond purchases from the 6th to the 19th of May. Bond yields have declined 7 basis points to 6.33%, while NBFC and banking stocks have risen. Citi's economists say liquidity infusion may be intended for faster transmission of rate cuts.
I guess India would be one of the first trade deals we would sign, US Treasury Secretary Scott Bessent tells CNBC in an exclusive interview. He adds that the onus of reaching a trade agreement with US is on China.
Taking a bit of a cautious stance is the market ahead of some very, very important data points. You're watching Halftime Report live from the CNBC-TV18 Motilal Oswal studios. I am Hormuz Patakia. It's an absolute delight to welcome Ekta Batra back to the studios. Ekta, welcome back. It's great to have you back on the show.
Hi, Hormuz. Yes, it's absolutely wonderful to be back. And, it's been 6 months of maternity leave, but it's been 6 months of market volatility as well. So it's been a roller coaster ride that I've been watching from the sidelines, and it's great to be back to tracking the markets live and giving our viewers the updates that they need. But for today, it seems as though things are stable. Broader markets are outperforming. If you look at it on a month-to-date basis, the mid-caps are up around 6% But year-to-date, yes, there's still some way to go.
They're taking a bit of a cautious approach, right? Because we've recovered significantly from the lows as well, from levels of around about 22,000, and now we have come to almost 24,300. But again, that Friday's high continues to remain the pain point for the market, and it is the index that is facing that trouble, right? 24,365 was the high that it made last Friday, and since then it has not managed to cross that. For the last 4 days, the index continues to remain in that 24,340, 360 range, making highs. Today we did cross that level, but again, we've come off those highs, and geopolitical tensions are the ones that continue to hog the limelight, and as a result of which sentiments are slightly subdued. What's the sentiment which is not subdued though is in the defense space, and all of these defense names, be it Garden Reach, Masgaon Dock, Data Patterns, Cochin Shipyard, continuing to gain from where they left off in yesterday's trading session. The defense index is up 4%, and all of these stocks, Masgaon Dock now at the highest point of the day, 7.5% higher, Data Patterns 7%, and of course the others like Cochin Shipyard and Garden Reach too. And of course, what's keeping the Nifty afloat, Ekta, is Reliance Industries.
Yes, absolutely. As you can see, it's the best level that we've seen in 6 months for Reliance Industries at this point in time. So that stock is higher. That's Reliance for you. That's currently up around 2.5% at around 1,400 odd rupees. But separately, we do have a lot of these IT stocks which are buzzing around today. So Tech M is up around 1.6%. LTI Mindtree is up around 1.5% at this point in time. We have bigger stocks such as Lastnet 2Pro also, which are doing well today. So up around 0.7% currently for L&T. On the downside, you'd have to say there's some pressure coming in a couple of these pharmaceutical stocks. So Dr. Reddy's, for example, is down around 2%. It's the top loser on the Nifty. In fact, it's had quite a terrible year. It's down around 15% on a year-to-date basis. Ultratech Cement post the conference call takeaways is a bit subdued, so that stock is down around 2% at this point. So overall, you'd have to say it's more about the broader markets. It's more about the mid-caps at this point, with the mid-cap index up around 0.3%. Advanced decline ratio currently just about even keel. But we'll take a short break on that note. As we do that, here's a small programming note for our viewers. CNBC-TV18 and HSBC India are back with Season 2 of SME Champion Awards. This prestigious platform celebrates SMEs that are pushing boundaries, making an impact and shaping the future. Nominations are now open. Scan the QR code now and submit your entry for the SME Champion Awards Season 2. Welcome back. You're still tuned into Halftime Report on CNBC-TV18. Let's get to the first stock that we're talking about today. In fact, RPG Life Sciences is doing quite well. That stock is up around 4 to 5 odd percent. It's cooled off to a gain of around 2 odd percent, but it had a solid start with an 8% increase at one point in time on an intraday basis. To talk more about the company, which showed a year-on-year growth but was a bit sluggish sequentially, we have with us Yugal Sekhri, who's the MD at the company, joining in now. Mr. Sekhri, thanks very much for joining in. If you could just start by talking a little bit about the margin pressure that you've seen Q on Q. I agree that you've seen, an increase on a year-on-year basis, but if you look at your numbers on a sequential basis, there's been a little bit of a sluggishness. Take us through the reason for that. Is there a seasonality element here?
Thank you so much, Ekta, for getting me on your channel. I think you yourself answered. Actually, that is precisely the answer. The quarter four, for us as well as generally in the industry, is much lower than quarter one, quarter two, quarter three. This is what you would see in the last many years, 3, 4, 5 years. And I think it is simply that. Else, on YOY basis, quarter, annual, I think the numbers are on upward trajectory.
Mr. Sekhri, good afternoon. Thank you for joining in. So what does this do to your projections? Because for the full year in FY25, you came up with margins of 24.5. So would you expect the number to be as is for FY26 as well? You've earlier maintained that you want to have your margins somewhere around that 26-27% range. Do we see that number going back to that level in FY26?
Yeah, my answer to this question had been very consistent. The upward EBITDA margin trajectory, which we have had in RPG Life Sciences, has been very structural. And it is not happening just 1 year, 2 years. It has been happening for the last 6 years. If I just give you the dimension, it was 10.4, it has moved to 26.4, not even a single year blip, recording about 1,600 basis points increase. And similar reflections are in PBT, 1,840 basis points increase, PAT, 1,380 basis points increase. Therefore, the upward trajectory which has happened is a function of strong cost optimization measures, both at cost of goods level as well as at the OPEX level. And those measures being structural continue, and therefore I don't expect the margin trajectory to be any way different than what we are seeing so far. Of course, the kind of the curve which has been, the slope of the curve has been, will be a slightly flattish, but the structural measures will continue to drive the EBITDA margin.
Okay. All right. So give us a ballpark guidance that you have for the next fiscal in terms of margins.
Yeah, Ekta, you know that we generally don't give the guidance going forward. I just indicate that the past is the proof. Upward trajectory will continue. We are, of course, pursuing 1,000 crore turnover going forward. That's the most logical next step. And with the improvement in revenue, I think the margin should also improve. At this stage, I must share with you that we have 3 business segments in our company. One is domestic, second is international formulation, and third is the API. We had so far the domestic formulation driving the growth. The international formulations and API, we have taken now 2 solid measures. One is the plant infrastructure modernization, make it approvable by the regulators. In fact, we have got the approval of the TGA and PMDA already for the API plant. And similarly, for the formulation plant, modernization has helped us to get the EU approvals. And we have invested close to 140 crore in the 2 plants. Now, with the 3 segments, all domestic formulation, international formulation, API, all the 3 firing, vis-a-vis only domestic formulation firing, I think revenue must accelerate.
Sure.
And the margin should also show the impact in margins.
So, Mr. Sekhri, if you could share a breakup of your 3 segments. Now you mentioned that you are focused domestically, but now with all your 3 engines firing, as you just said, What does that do to your mix? How will the revenue distribution be among the three segments?
Yeah. We have currently 66% coming from the domestic formulation, 20% coming from the international formulation, and the remaining coming from the API. Now, as we go along, the domestic formulation will continue to grow ahead of the market, which has been happening consistently for the last 6 years. International formulation will start contributing more than what it has been contributing today. So therefore, the contribution of the international formulation business is expected to grow better than what it was earlier. And the API also should grow because of the measures which you have taken. As I described, we have modernized the plant, we've got the approvals, we have got the R&D pipeline also under development. Somewhere in late FY26, we should see the new products also coming out in the market. Currently, they are in the various stages of the development. That will add to the margin, the sales improvement and the margin improvement. Plus, I also want to point out to you that we were in debt, we have paid the debt, we have spent 140 crore in modernization of the plant. Today, we are sitting on a healthy cash surplus, which has further got increased. You would have seen the cash surplus is currently 266 crore. And with this, we are actively pursuing the acquisition, inorganic opportunity, and that, depending upon the inorganic opportunity, the contribution of three business segments would finally pan out.
So that's exactly what we wanted to narrow down on, Mr. Sikri. This particular acquisition that you're looking at, you have 266 crores of cash. Can you tell us how much of it do you want to deploy in terms of an acquisition, and which segment are you looking at, domestic, API, or the international space?
Yeah, I think again, an important question for us. We are now open to both API and formulation, because we see very strong growth trajectory in both formulations and API. So we are actively scouting the M&A opportunities. As I mentioned earlier, we have actually evaluated, I personally evaluated close to 25 such proposals. But the valuations being crazy, we have not been able to finally succeed. But I think we have now expanded our target from formulations to API as well. And therefore, that should help us to deploy the cash surplus we have generated ourselves. And plus, we have put on the leverage possible. That also gives us the opportunity to target bigger targets.
Right. Thank you, Mr. Sikri, for sparing time and joining us today. Wish you good luck for the rest of the year as well. That is the management of RPG Life. Moving on then, Max Healthcare has formally inaugurated its super specialty hospital in Dwarka, which will have a capacity of 300 beds. And our colleague Parikshit caught up with Max Healthcare CMD Abhay Soy and began by asking about this facility and their expansion plans. Listen in.
With this bed capacity expansion of 300 beds at present, we will be touching 5,100 beds across the country. This is our 25th year for Max Healthcare, and we've decided to celebrate it with 4 commissionings this year. First of which was yesterday, was the Max Dwarka Hospital. And we look forward to the 3 other commissionings which are on our way. One will be at Max Saket, which is right in the center heart of our hub, which is in Delhi. Another is going to be in Nanavati, Mumbai, where we're expanding later in the year, as well as Mohali, Punjab. So exciting year for us. We are increasing capacity by close to 30%.
Right. As you said, this is your 25th year. Could you also outline some other growth plans for us, your own vision for the company over the next 5 years?
So I think there is tremendous amount of asset creation which is required. As our country is sort of progressing, we are going towards being a $5 trillion economy. The aspirations of people, the desire for quality healthcare, on one side is increasing. On the other hand, the population, the baby boomer population is becoming a year older, is likely to be a little more sicker as years go along. And we require quality healthcare. So I think really for us, it is, we are focusing on building quality healthcare assets. We have added 30% capacity last year, largely through acquisitions, but in the current year, we're expanding it by another 30%. and getting to 5,100. And, by the end of 2028, we should have another 3,000, close to 3,000 beds established. And this is what we're constructing at present. So, we should be close to 8,000 beds. And, the idea is really to keep reinvesting the capital that we are generating in order to create the quality healthcare assets that are so required in the country.
Right. I would also like to ask you about your capex plans. Last year in November, you had announced, you had said that you would be investing about 6,000 crores over the next 3 to 4 years. Could you give us the capex plans, the expansion plans for FY26 and overall till 2028?
So like I mentioned, we will be adding 30% more capacity, which is close to about 1,500 beds in the current year itself. Up till 2028, it was going to be another close to 2,000 beds. So that makes it about 3,500 beds total. This will be at a cost of about 6 to 6,500 crores and almost entirely through internal accruals. We will be at the same time be focusing on inorganic growth through acquisitions as well. I mean, we have a very low amount of gearing in our balance sheet of about 0.5 or 0.6 times debt to EBITDA. So that gives us enough headroom to acquire as well as build more.
Right. Are there more acquisitions, strategic acquisitions on the cards for this year?
Absolutely, and we're looking forward to some.
Okay. And could you give us a sense of the kind of cities where you would like to acquire such hospitals?
So we've been very clear about two things, that we have two requirements. One is we don't like to go into uncharted territories. We prefer territories where at least one or two of our peers have proven viability over a period of time. So these become uncharted territories for us. And the second is we seek a 20 to 25% ROCE over a period of time. We are currently operating at ROCE of about 35, 36%. We seek a ROCE of about 20 to 25%. So long as any acquisition or a new build, both these conditions suffice, we're happy to sort of go in there.
Right. Also, if we were to ask you about where is the highest growth for Max Healthcare coming from at this juncture and for FY26, could you give us a sense of the geographies, the cities which would be contributing to the highest growth?
Well, we have a massive amount of capacity in metro cities, about more than 80% of our total capacity is in metros, but we are seeing significant growth in non-metros as well. Places that we've recently done acquisitions such as Lucknow, Nagpur. We've seen almost a 4x increase in our profitability over there. Some amount of it may be to do with the latent demand and the cities being underserviced, but another part is perhaps to do with the efficiencies that we've been able to sort of lend to these assets.
Okay. If we were also to ask you about other healthcare segments, you're of course talking about the bed capacity expansion, the strategic acquisitions in the hospital sector, but within healthcare, in terms of digital delivery of services, digitization, more digital apps, increasing your digital offerings. Are there some plans on the cards in terms of focusing on other segments in healthcare?
So we already have the digital app part aids our delivery system, and in sort of services and supports us our present patients. And, we've had that app now. Close to 24 to 25% of our total business is through digital sources. What I mean is you don't deliver healthcare through it, but your bookings and so on and so forth are done through digital sources. So, the world is moving towards that. Secondly, I think there are other very exciting verticals as well in terms of home care. That's a business which we have the largest sort of home care business in the country, perhaps the only profitable one. It's been growing at 25% CAGR. Our diagnostic business, again, has been growing at a 25% CAGR for many years. Although it's a small percentage of our total overall revenues, but we see a lot of excitement in both these sort of verticals as well.
Right. Mr. Soy, we have been reading reports how almost 600 private hospitals, according to the IMA, have stopped treating patients under the Ayushman Bharat Health Insurance Scheme. We also see that many private hospitals have not yet come on board with the scheme. Could you give us a sense of what are some of the issues or hurdles that you see with the scheme right now and how it could be made better?
I think, with respect to private hospitals, particularly in the larger cities, the cost of, in metros, the cost of, manpower, our cost of fuel, our cost of land resources, and so on and so forth, are significantly higher than non-metro cities. So it's not necessarily viable for players like us to sort of participate in Ayushman Bharat from that standpoint. But I think, we have been working with the government how to sort of come up with more features in the policy, perhaps, which would be, then we will be able to accommodate those.
Right. Could you give us a sense of the features some suggestions that you've made?
I think one is to do with pricing. Second is to do with, our ability to use certain medicines versus, more generic medicines versus branded medicines and so on and so forth. So you'll have to reverse engineer the costs because I think effectively what is happening, the cost structure doesn't sort of work out for even from a standpoint of any contribution towards fixed costs. We are unable to cover variable costs. So that's where the problem lies.
Okay, so that's the management of Max Healthcare talking about their new hospital that they've opened in Dwarka and separately providing guidance with regards to how they are seeing growth pan out in a lot of their verticals. We'll take a short break on that note, but Sachidanand Uttikar of Trade Bulls will join in with some trading strategies. Stay tuned. Welcome back. Well, a couple of stocks are buzzing around. So Prestige Estates is up around 4.5%. We have India Mart, UCO Bank, Popular Vehicles, Northern Arc, a lot of these stocks which are showing good traction, anywhere up anywhere between 3 to 4.5% at this point. But let's talk about the technicals now. We have Sachidanand Uttikar of Trade Bulls joining in to discuss what he's tracking on the markets today. Sachidanand, hi, welcome to the show. Well, if you could start by giving us a sense in terms of the overall strategy, considering that the Nifty is just about consolidating at this point.
Good afternoon, Ekta. I think the market is consolidating well. In fact, it has been holding above its 5-day exponential moving average support for the last 11 trading sessions. And if you look at the constituents, today, despite of the consolidation, a stock like Reliance is already making, fresh highs. If you look at the overall structure, I think from a momentum perspective, we may see Nifty again, showing that momentum once we see a breakout about that 24,450 mark. But as of now, I think the structure is a bit consolidative for the day. It's a good time wherein some long positions should be considered, especially if you look at the Nifty Bank, movement. We have seen some profit booking there, but even here, it has been holding above its 5-day exponential moving average support very well. So I think it's a good opportunity to, deploy some long positions when it comes to Nifty Bank. The reward to risk opportunity looks better than Nifty. As of now, we don't expect the Nifty Bank to display a closing below that 55,000 mark. So this particular pullback towards 55,100, 200 is a good opportunity wherein some fresh long positions can be considered. One can keep a stop loss at 55,080 on a closing basis. Eventually, we are seeing a probable target close to around 57,265 on the weekly scale. So we are expecting that the markets may, again see some momentum in the days forward. But as of now, today is a day of consolidation and where some long positions can be considered. The setup is more, fruitful when it comes to Nifty Bank, wherein some long positions can be deployed at this particular level itself.
Sachidanand, good afternoon. Thank you for joining in. Before I ask you about specific stocks, what are your recommendations for the afternoon?
Good afternoon, Harmos. Clearly, I think the structure of ICICI Bank has been very clear. It is a bullish flag formation. Today we have seen some profit booking, but the pullback is, looks very healthy. As of now, we are expecting that this particular rally in ICICI Bank should continue towards 1485 on a positional perspective. So keeping a stop loss at 1418, one can still deploy fresh long positions in ICICI Bank for a positional target of around 1485. The other stock on our radar is Voltas. Now, if you look at the overall sequence, it has been correcting, and we have seen a strong base somewhere close to around 1240, 1250 kind of a zone. We are expecting this particular double bottom, formation on the daily scale, and we may see a quick move towards 1360 going forward. Hence, we are recommending, building long positions in Voltas. One can keep a stop loss somewhere close to around 1245 on a closing basis. Eventually, we see this particular move getting unfolded towards 1360.
All right, Sachidanand, thank you so much for sparing time and joining us today with your views on the index and on specific stocks as well. By the way, Reliance Industries is now continuing to keep the Nifty afloat as of now, 2.5% higher at the highest point of the day. Take a short break. The management of UCO Bank joins us on the other side to discuss the road ahead and the quarter gone by. Stay tuned.
for investing.
Welcome back. UCO Bank is the next management that's joining us on the show now. After a good fourth quarter, deposits were healthy. The asset quality also improved on a sequential basis. To discuss this and more, we are being joined by Ashwini Kumar, the MD and CEO at UCO Bank. Mr. Kumar, good afternoon. Thank you for joining in. You know, your deposit momentum was fairly healthy during the fourth quarter. Advances were also up almost 18% from last year. Does this momentum sustain going into FY26? What are the targets that you have set in terms of both loan growth and deposit growth for the new financial year?
Thank you for having me on your show. If you see our performance during this current last financial year vis-a-vis the previous financial year, our deposit growth was around 5.5%. This financial year, our deposit growth is 11.5%. So we have already started building the momentum on the deposit front. There were two reasons previous year, and that deposit growth was not so good because we were not concentrating on deposit because our CD ratio was very low. So we had targeted a CD ratio of 74 to 75% in this financial year, which we achieved with a deposit growth of 11.6%. Now going forward, we have kept a deposit growth guidance of 10 to 12% and CD ratio to 75 to 77%. Along with that, the credit growth during the last financial year was around 17%. We'll continue the momentum which we have built in this last financial year. If you see my credit growth, that was spread across segments. You take RAM, within RAM, retail grew at around 35%, MSME grew at around 18%, and agriculture grew at around 20%. So the momentum has been built within the entire banking system of the branch network. We have also implemented retail hubs and MSME hubs last financial year. So I believe that the momentum will continue in this financial year as well.
Okay, when you say the momentum will continue, any kind of specific guidance that we can expect when it comes to credit and deposit growth going into the entire fiscal?
See, this year we have, last year we achieved around 11.5%. So our guidance for the current year is 10 to 12% of deposit growth and 12 to 14% of our credit growth. That is the conservative guidance we have kept for ourselves, and given a opportunity where we have a bankable proposals and where our margins or our pricing is matched, we'll take further exposures as well. So on a conservative basis, 12 to 14% is our guidance.
What about asset quality, Mr. Kumar? It's improved on a sequential basis. Your gross NPAs are trending downwards. Slippages were marginally higher compared to the previous quarter. What would you attribute that to? And will the slippages number trend down as well as the quarters go by?
If you look at the slippages on an annual basis, our slippage ratio in the last 22-23 was 1.75%. Next year, we brought it down to 1.2%. This year, our slippage ratio is on a yearly basis is 0.92%. Our guidance for the slippage ratio is 1 to 1.25 in the current financial year. Absolute number may look a little higher, but if you look at the base, because the base has also increased now. So absolute number, but on a percentage terms, it will trend in the same range. Our guidance is 1 to 1.25%. So whereas the gross NPA and net NPA will continue our journey to bring them further down by concentrating more on recovery and containing slippages in the current quarter and the remaining quarters of the current financial year.
Okay, all right. Let's just get a little bit of color on the net interest margins. Can you just give us a sense in terms of what the cost of funds were this quarter? What are you guiding for going into the fiscal?
See, if you look at my net interest margin, last year net interest margin was in the range of 2.9 to 2.92, and we have given a guidance of net interest margin of 3 to 3.10. And if you look at the net interest margin, it is in this range only 3.09%. So with the reduction in the repo rate, there will be some impact on the net interest margin. And going forward, I believe that the team is working on raising deposit, containing cost of deposit, improving CASA, because we have already launched many new products to converse new quality CASA customers account. I believe that we should be in the range of 3 to 3.1 also in this current financial year.
So 3 to 3.1% in the current financial year as well, Mr. Kumar. But there is so much competition, right? Almost all of your peers are vying for deposits. And so what are the steps that you are taking to boost your deposit growth and to lure customers towards your bank?
See, there are 3-4 things we have done in the last financial year for the first time in our bank. First, we started with the resource vertical at the head office level and zonal resource team at the ground level at zonal offices level. 43 zones we have across the country. Now, to strengthen the zonal structure, we are opening 6 more zonal offices and 6 more ZRT teams will be there. Second, we have done the tap banking. Earlier, it was we started last year with the 500 branches, then 700. Now, in March quarter, we have given tap to all the branches across the country. And now our entire branch network, our people, our staff can go to the office, to the workplace, to the home with the tab to open quality CASA customers account. So third thing we have done is we have revamped the entire product structure. We have now products for each walk of life. For a student, catch them young is our tagline for a student. And then we have for the female, we have a pink basket we have launched with additional benefits for the female customers. And then for salaried customers, we have a Suvidha salary product where we have for a different salary structure, a different combination of offers. And then for the normal customers which are not covered under these categories, there also we have revamped our product. Plus we have launched special deposit scheme also, plus green deposit scheme also. So a lot of effort is going on within the bank to see that we continue our march towards garnering the good deposits.
Okay. Just before we wrap up, you did speak briefly about the asset quality, but Mr. Kumar, just wanted to get a sense that, you know, your slippages were around 588 crores this quarter. What is the quarterly run rate that we can expect, and what is your guidance on recoveries as well?
See, our slippage during the quarter was 488 crore, not 588 crore. It is 488 crore. And slippages should be in this range only in this coming quarters. And overall slippage ratio, we have kept that in 1 to 1.25. And last year also, overall, our slippage ratio on a yearly basis is 0.92 only. So we'll continue to monitor our profile products, revamp those products also in the times to come. So the guidance for the slippage is 1 to 1.25 only. Second thing on recovery front, we have already done around more than 4,000 crore of recovery in the last financial year. We have given a guidance of around 3,000 crore of recovery. And in December, since there were certain additional recoveries had come, we have revised our guidance to 3,250 crore. We surpassed that guidance also because there was one particular account which we was expected to get resolved in June quarter. Right. It got in the last quarter itself. So last year our recovery was much more than the guidance. This year we have kept a guidance of 2,700.
One final question, Mr. Kumar, very quickly. You've raised 2,000 crore rupees through this QIP. Now, is there any further mandate to bring has the government communicated to you any further to bring the stake down? Because it's still at 90%, right? So to bring it down to 75%, has there been a timeline shared?
See, we have taken a board approval for a capital raising plan in our board, and we'll be taking up this for this approval to the AGM, the next AGM which we will be conducting, and then we'll approach the government for their approval, for giving us approval to raise the equity through QIP in this current financial.
All right, Mr. Kumar, thank you so much for sparing time and joining us today, and wish you good luck for the new financial year as well. The management of UCO Bank, the stock consistent at around 4% higher at around 32 rupees. Take a short break, but before we do that, here's some good news. Network 18 is the leader in the news information category on the platform leadership network level with 183.2 million unique views, beating Times Internet as per ComScore MMX report of March 2025 at the Social Plus on platform leadership network level. Network 18 is the runaway leader as per the Social Plus MMX ComScore report for March 2025 with 315 million unique views, which is 55% higher than the nearest competitor Times Internet at 202 million. News 18 also races ahead of the Times of India in terms of social plus MMX cumulative reach. News18.com overall clocked 251 million unique views to beat the Times of India overall with 183 million unique views as per the ComScore report for March of 2025. Now, as per the ComScore social media matrix report, Network 18 is 2 times bigger than the nearest competitor with a 54% reach within the 389 million overall social population. And speaking about Indian languages, in terms of social plus MMX cumulative reach, News 18 Indian languages is the leader in the category with 182 million unique views as per the ComScore report for March of 2025.
Welcome back. Well, let's get to another story now. Sources tell CNBC-TV18 that SEBI is looking into the veracity of disclosures made by OLA Electric. Yash is here with more details on this. Yash.
That's correct. So what we've been given to understand from our sources is that market regulator SEBI is looking into the veracity of disclosures made by OLA Electric. Now, SEBI's move of actually looking at the disclosures made by the company is particularly with respect to the instance of the February 28th disclosure, where OLA Electric had spoken about sales of 25,000 units, the monthly sales for February 2025, as against the government portal, which showed only 8,600 registrations. Now, OLA, of course, had sort of replied or clarified on that alleged discrepancy, saying that it's a straightforward case of a temporary registration backlog, and they are working towards streamlining this or sorting this out. Market regulator SEBI wants to see if there was more to it than just that. Why was there a discrepancy in the two numbers? SEBI is also looking at the stock price movement which came about on the day the initial disclosure was made, which is February 28th, about the two numbers. And of course, when the company clarified as the reason behind this particular discrepancy, SEBI is looking at the stock price movement on that day, and particularly looking into the fact that if investors of the company were shortchanged because of this alleged wrongful disclosure. Not just that, what I've also been given to understand from my sources is that SEBI is also looking at the previous disclosures, all the previous disclosures made by OLA Electric on the exchanges, and cross-verifying them with the actual data that arrived much later to find out if there was any instances of possible discrepancy before as well. Of course, this is SEBI's process which they've initiated against OLA Electric. We've written to the company OLA Electric on this one, but we're yet to receive a reply from the company.
All right, Yash, thank you so much for that exclusive details on Ola Electric. The stock now trading below 50 rupees. Take a short break. On the other side, Manisha Gupta joins in with Kunal Shah, the head of commodities and currencies at Nirmal Bang. Stay tuned. We'll be right back. Welcome back. Flat as flat can be for the Nifty, still at that 24,350 mark, continuing to swing between the gains and the losses. By the way, Garden Reach Shipbuilders is now up 13%, and all of these defense stocks are continuing to build on to their gains from yesterday. It's 13% higher for Garden Reach, 11.5% higher for Data Patterns, 10% higher now for Cochin Shipyard, and 8% higher for Masgaon Dock as well. Of course, not to take away Hindustan Aeronautics, that's up 5%. BEL is up another 5%. BEML is up 4%. Bharat Dynamics too trading with gains of 4%. So it is defense stocks across the board that are leading the gains in the broader markets. Over to Manisha Gupta now for Commodity Corner.
Well, thank you so much for that. And I have a guest with me, Kunal Shah, Head of Commodities and Currencies Research at Nirmal Bang, now joins us. Kunal, hi. A day prior to Akshaya Tritiya, and we've seen some profit taking continuing when it comes to gold and silver both. What would you, advise investors to do on this day now?
So as far as the next move by US and China, nobody knows what's going to happen. But I just get a feeler that somewhere, maybe in 10 days, I don't know the timing, but I'm pretty hopeful that there is likely to be at least talk between US and China regarding the tariff negotiations, because US has been talking to India, US has been talking to all the countries. So I think that should happen. It's just a matter of time. And I think we have seen the peak. Gold prices have made the high $3,500, whatever we have seen. Seems in a short term, I don't expect gold prices to go above that. And either it is going to consolidate or it is likely to go down gradually, because the demand side has been weakening. And we have not seen central bank buying gold at these levels aggressively. So I am of the view that the upside is very limited. In a near term, sell gold on rallies. It is likely to test 91,000, 90,000 on Indian bourses. And I'm not very optimistic in near term as far as the outlook of gold is concerned.
By the end of this year, though, Kunal, where do you see prices closing?
So nobody knows what's going to happen as far as the US economy is slowing down, but I believe at $3,500, everything is priced in. Okay, so I have been maintaining this view from last one and a half month, and I continue to have that same view. I think all the positive, because of which gold prices should have been going up, is already discounted in the prices. So you consider the rate cuts, you consider the US-China tariff situation, everything is in the price. So if there is a rate cut, there will be a bounce and again it will go down. So $3,500 for me this year is top. It can go up to again 3450, 3480, but I'm not expecting any fireworks until there is a major black swan event taking place in the world. Otherwise, the upside is very limited. We are not going to make money in going long in next 6 months. So not very optimistic.
And how would you look at silver then? Would you start looking at that one? Because the gold-silver ratio seems supporting of silver. And if you are bullish on base metals, then silver perhaps fits that bill.
Yeah, so this is the 5th year of deficit. We've seen our Silver Institute coming up with this forecast a couple of days back. So 5th consecutive year of deficit in silver. That's put a very strong case for silver to move up in next 6 to 8 months. The only reason right now silver is not able to shoot up is because in a near term, the Chinese demand seems to be in a doldrums because of this tariff. So China is taking a hit on the demand because of the ongoing tariff war between US and China. Nobody is able to figure out how much loss of demand is expected if this tariff war continues. So if there is a moderation in US and China's trade war, I think silver will shoot up immediately. So the downside is very limited considering the deficit, 5th consecutive year of deficit. $30 seems to be the bottom to me. And 93,000 on India, good buying levels. It is poised to test 1,05,000, 1,10,000 on MCX and $37 to $38 on COMEX by the end of the year. So the gold silver ratio, which is right now trading at 101, roughly around 101, it should go back gradually towards 90. So I'm pretty optimistic on the outlook of silver.
Kunal, what is your sense also on metals? Because in the day today, we're looking at some pressure continuing in case of copper. Also, when you look at the month of April, we seem to be closing this month in the negative. Are these levels good to buy yet again?
So in case of base metals, I'm quietly optimistic because Chinese government has already made a statement that in an event where the metal prices goes down, China State Reserve Bureau will be the buyer in that. So instead of buying gold or silver, why not buy copper? So the copper is the metals which is going to do very well in next 5 to 10 years period. So if that is the case, then if the prices are going down, it is really a great strategic move to add it into your strategic reserve. So that is one reason. Second is, if the tariff war continues for a longer period of time, then China is expected to come up with some or the other measures which will lead to like stimulus package or the rate cuts, which will support the domestic industry, which will support the mining industry over there. So that is also likely to be positive. And if there is a solution if there is a way out in China-US trade war, then I think obviously metal will go up. So I'm pretty optimistic about the outlook on metals, even though the Chinese growth outlook have been downgraded by World Bank and IMF. But I'm of the view that the downside is very limited. 840, 835 again levels to do bargain hunting in copper, and copper can move up to 870, 880.
Kunal, a final word on the crude oil prices, because after 2% of decline in the overnight markets, it's not anything else that the crude seems to be doing right now. It seems under pressure right now, especially ahead of the OPEC and allies production increase and also their meeting on 5th of May.
Yeah, so you must have the major thing to watch out for is how much oil US is adding in their strategic petroleum reserve at this point. Because we've already seen announcement coming from US that at these levels, they want to store as much as they can to fill up their strategic reserve. So now below $60, the profitability of a lot of shale oil players in US will again start to deplete. So I believe that any commodity going below its cost of production is an alarm for the producers, and producers eventually may act. So it can go down below 60 and stay there for a while, but eventually it just pulls back. So oil from here, it much depends on the top two economies of the world, the way they are fighting right now. If there is any positive talks, I think oil will shoot up. So if you are optimistic about the outcome of US and China talk may take place and there may be some positive outcome, then I think this is the great level to buy oil, because we are talking about both these economies having downgraded by World Bank. Suddenly, if there is a talk, it will all demand side scenario outlook will change. So at $60, nothing to lose in WTI. I will start to recommend to go long in oil, slightly for the positional point of view. And I'm expecting, at these levels, oil prices should stabilize and should not crash from here. And not expecting a big upside, but 8 to 10% upside can be possible in next 2 months, 3 months time.
Oh.
All right, Kunal, thank you so much for sparing time and joining us today with your views. Manisha, thank you for joining in as well. With that, we call time on this edition of Halftime Report. We leave you with the Nifty above the 24,350 mark, closing in on Friday's high. Business lunch for the next 30 minutes.
Stocks swing up and down amid tariff uncertainties, capital goods and energy eke out gains, while healthcare and FMCG drags. Midcaps fare better. Arun Khurana, Deputy CEO and Executive Director of IndusInd Bank, resigned yesterday, taking responsibility for deviations in derivatives accounting. This confirms CNBC-TV18's Newsbreak, where we said that the revelation will lead to 3 senior exits. KPIT Tech holds back from giving guidance and expects a soft first half in FY26 on tariff uncertainties, but is confident of delivering 18 to 20% growth annually sans externalities. Hexaware too sees growth perking up as the year progresses. RBI announces mega liquidity infusion of 1.25 trillion rupees via open market bond purchase from 6th May to 19th May. Bond yields fall 7 basis points to 6.33%, while NBFCs and banks share rise. Citi's economists say liquidity infusion may be intended for faster transmission of rate cuts. I guess India would be one of the first trade deals we would sign, U.S. Treasury Secretary Scott Bessent tells CNBC in an exclusive interview. He adds that the ounce of reaching a trade agreement with U.S. is on China. Hello, good afternoon and welcome to Business Lunch, coming live from the CNBC-TV18 Motilal Oswal studios. I'm Vinny Motiwala and thank you so much as always for tuning in. Let's look at the market, very muted day of trading session coming in, flip-flopping between the red and the green. Nifty 24,350, as of now it's managing to hold on to that level. Sensex 0.2% of gain is what we're seeing coming in, and broader end of the market also is something that is muted in terms of a performance. Not much of an excitement that we're seeing coming in for the broader end of the market as well. 0.4% of gain is what Midcap is holding on to, and 0.5% of gain for the small cap. So not too much of an excitement that's coming on the D Street. Nonetheless, we'll keep an eye out on the market. Bank that went into the red recovered, now just managing to hold on to some bit of a gain on that front. 0.2% of gain. Let's look at Nifty Pharma. It is among the top sectoral losers today and down 0.8% in today's trading session. After opening in the green, it just saw a fall coming in and recovered from the day's lowest point. IT, that's the one that's managing to hold on to some bit of a green and is as of now at the day's highest point is what the Nifty's IT is trading at. So yes, 1% of gain for more than 1% of gain for the Nifty IT. So that's the roundup coming in for the markets. Next couple of hours will be important to see where the market is headed. But let's get started. An RBI on Monday unexpectedly announced that it will buy an eye-popping 1.25 lakh crores of bonds over the next 4 weeks. Lata is here to explain us what may have prodded the RBI and the impact of this.
Yes, that's right. Reserve Bank is going to buy 1.25 lakh crore of bonds in 4 tranches from May 6 to May 19. Announcement came late on Monday, surprised the market because already the interbank market has excess liquidity of over 1 lakh crore, and which is why the one-day money, what you call the call rate, is trading below the repo rate because there's excess money. The market has 2 sets of guesses why the Reserve Bank would put more money when there is already money in the system. One is it could be because of the FX positions of the Reserve Bank. They had entered into a lot of buy-sell swaps. The sell leg would be maturing now. The data we have is that as of February, they had $80 billion of sell positions. Maybe 30 to 40 billion is maturing now in April and May. And that's why they're standing prepared with extra liquidity, because when the RBI sells the dollars for the maturity, it pulls back rupees and it may take away rupees. The other guess is that no, there is enough dollars coming in from FPI bond and equity funds to meet that RBI sell. This is because the Reserve Bank is calculating for the year as a whole, the shortfall or the liquidity withdrawal would be to the tune of 4 lakh crore. This is how the math is being worked. Cash withdrawal is always there by you and me during festival season. That is about 2 lakh crore over the year. And another 1 lakh crore is set aside by banks for cash reserve ratio. You know, what is cash reserve ratio? Every time you make a deposit, 4% should be kept as cash. That would take away 1 lakh crore. The other 1 lakh crore is Reserve Bank owns bonds which mature this year. When the bonds mature, the bonds are returned and money comes from the government to the Reserve Bank. So that is liquidity withdrawal. To replenish that, part of this is coming as 1.25 lakh crore. Whatever be the prodding, the impact is that bond yields have fallen by about 7 to 8 basis points today, from 6.4 plus to 6.3334. And banks and bond NBFCs are having a very good day. And that's because the rate cut transmission is expected to happen very quickly when there is good liquidity.
Thank you so much for that, Lata. But let's move on. An IndusInd Bank that announced that its deputy CEO, Arun Khurana, has resigned with immediate effect weeks after the private lender disclosed accounting lapses in its derivative portfolio. Ritu is here to give us more details in this front.
Well, thanks for that. And what is clearly a fallout of the accounting discrepancies in IndusInd Bank's derivatives portfolio, Deputy CEO Arun Khurana has resigned with immediate effect as of yesterday. As we reported a couple of weeks ago, this was likely because Khurana was overseeing the Treasury Front Office, which is the division responsible for the derivatives portfolio, where incorrect accounting had led to a near 2,000 crore rupee hit on the bank's P&L. In his resignation letter as well, Arun Khurana has cited the recent unfortunate developments linked to the discrepancies and this P&L hit as the key reason for his decision. Now, this resignation comes just a day after the bank disclosed that an independent investigation had identified the key individuals who were responsible, and the bank had stated that the board will determine changes and realign senior management responsibilities based on the report's findings. Now, we understand that this independent investigation was conducted by Grant Thornton, which has pegged the adverse financial impact at about 1960 crore rupees, which is very close to the 1979 crore rupee hit, which was determined by external auditor PwC earlier. The bank will now account for this loss in its fourth quarter earnings. Meanwhile, the Reserve Bank of India has already shortened CEO Sumant Katpalia's tenure to March next year, and as we had reported, asked the board to submit the potential CEO candidate names by October. So the accounting fallout is triggering top-level exits, and this may not be the last one.
Absolutely, Ritu. Thank you so much for that. But in yet another setback for Castrol Engineering and Blue Smart, the Delhi High Court has appointed a receiver to take charge of the 95 electric vehicles leased to it by Climb Finance. The receiver will now be responsible for maintaining the vehicles. The fresh trouble comes after Climb Finance told the High Court that it had not received lease payments since March 2025. And let's move on. And US Treasury Secretary Scott Bessent says that India could be one of the first countries to link a trade deal. Speaking to CNBC, Bessent said many countries have come forward with some very good proposals. Let's listen in to his comments on the trade deals and what he had to say on China as well.
There are 15 to 18 important trading relationships. As you said earlier, we'll put China to the side. That's a more complex negotiation. And with the other 17, especially with the other Asian countries, we've had many countries come forward and present some very good proposals, and we're evaluating those. But I tell you, Joe, when I look at these proposals, and some of them are really willing to lower their tariffs, lower their non-tariff barriers. But I look at what they're proposing and I just think, how did we get here? How did we get here? Right. And I agree with President Trump. I don't blame it on these countries. I blame it on the past administrations. And it's going to be a big victory when we make progress in getting these tariffs, non-tariff trade barriers, currency manipulation, state subsidies of labor and industry off. The negotiations with our Asian trading partners are going very well. Vice President Vance was in India last week, talked about substantial progress. I would guess that India would be one of the first trade deals we would sign, so watch this space. In terms of trade negotiations, we'll see where this goes. But as I've repeatedly said, that I believe that it's up to China to de-escalate because they sell 5 times more to us than we sell to them. And so these 125, 145% tariffs are unsustainable.
Okay, on that note, we're going to slip into a very short break. On the other side, we will get you the latest updates on the fallout from the Pahalgam attack. Welcome back to Business Lunch on CNBC TV18. Now let's shift focus to the fallout from the Pahalgam terror attack. Law enforcement and defense agencies remain in the hunt for the Pahalgam attackers, while policymakers mull further economic measures against Pakistan. Parikshit is here to give us more details on this one. Good afternoon, Parikshit. What are you picking up on this front now?
Well, currently in Jammu and Kashmir, we're looking at intense security operations that are being carried out by our armed forces. That is the army, the local police and the CRPF. They're carrying out anti-terror operations to find the terrorists who were involved in the Pahalgam attack that took place. At the same time, we're looking at least 5 instances over the last few days where Pakistan has violated ceasefire across the line of control. What they've done is indulged in small arms firing. The most recent ceasefire violation took place in areas such as Kupwara, also in Baramulla and Akhnur, where firing took place, and the Indian Army has also retaliated effectively. Now, this continues to go on. We're also looking at military drills and exercises that are being conducted by the 3 armed forces continuously, be it the Army, be it the Air Force, Navy. All of them are indicating a high level of preparedness, a high level of alert as a result of what has happened in Pahalgam. Now, India is definitely mulling more economic measures to bring pain to the Pakistani economy, and one of the measures is to restrict Indian airspace to any Pakistani carriers for that matter. So we could see more diplomatic steps. Tomorrow is an important cabinet meeting. There will be a meeting of the Cabinet Committee on Security as well, where the security situation and India's response may come up for discussion.
Okay, Parikshit, thank you so much for that. Also, the government has shut down a number of tourist spots in Jammu and Kashmir as security concerns rise. Shivani is joining in with us to give us an update on that front. Shivani, over to you.
Well, yes. Now, security concerns are casting shadow over Kashmir's tourism season this time as well. Now, sources have confirmed to CNBC TV18 that the government has shut down 48 of the 87 officially recognized tourist destinations across the valley. Now, this is a significant move. Remember that it comes amid heightened security operations following the recent terror attack in Pahalgam. Popular destinations like Usmarg, Doodh Patri, Harbal, Sinthan Top and Verinag Garden, all of which usually see very high footfall in the summer season, are now completely off limits for tourists. Even iconic locations like Astanmarg and part of Dachigam National Park have been partially shut down. Official sources say that this is a temporary and precautionary step as forces continue to conduct searches and maintain tight security across vulnerable zones. Now, security has been beefed up around the remaining open destinations, but it remains unclear when normal tourist activity will resume across the affected sites. Back to you.
Okay, thank you so much for that update there. But on that note, we're actually going to slip into a very short break. And when we come back, we get you a whole host of global updates, including news from Canada, where election results have been announced. Welcome back to Business Lunch on CNBC TV18. Now moving on to some global updates. Russia has announced a 3-day ceasefire in May in the war with Ukraine. But US President Donald Trump says he's very disappointed by the recent Russian bombings and wants to see a permanent ceasefire. Take a look at this report.
Russian President Vladimir Putin on Monday declared a 3-day ceasefire from May 8th to the 10th in its war with Ukraine. The 72-hour truce would coincide with Putin hosting international leaders for lavish celebrations to commemorate the 80th anniversary of the victory over Nazi Germany in World War II. Putin's move appeared aimed at signaling to the world that Russia is still interested in peace, something that Ukraine and its European allies dispute. On Monday, White House Press Secretary Caroline Leavitt said U.S. President Donald Trump wants more than just a 3-day truce.
He wants to see a permanent ceasefire. I understand Vladimir Putin this morning offered a temporary ceasefire.
Speaking to reporters in New Jersey on Sunday, Trump said he was disappointed that Russia has continued to attack Ukraine.
I want to see what happens with respect to Russia, because Russia had been surprised and disappointed, very disappointed that they did the bombing of those places after discussions.
U.S. proposals on ending the 3-year war in Ukraine have called for Washington's recognition of Moscow's control over Crimea, as well as de facto recognition of Russia's hold on other parts of Ukraine. European and Ukrainian counterproposals, however, defer detailed discussion about territory until after a ceasefire is concluded.
What do you want Vladimir Putin to do? Well, I want him to stop shooting, sit down, and sign a deal. And we have the confines of a deal, I believe, and I want him to sign it and be done with it and just go back to life.
Trump and Ukrainian President Volodymyr Zelensky, in Rome for the funeral of Pope Francis, met in a Vatican basilica on Saturday to try to revive faltering efforts to end the war in Ukraine. After which, Trump suggested Zelensky was ready to give up Crimea, which Russia seized from it in 2014, as the price of a peace deal. But U.S. Secretary of State Marco Rubio said on Sunday that the Trump administration might abandon its attempts to broker a deal if Russia and Ukraine do not make headway.
And moving on to Canada, where the Liberal Party under Prime Minister Mark Carney has won the federal election. This is also the 4th consecutive win for the party, which was previously led by the former Prime Minister Justin Trudeau. The victory comes in the backdrop of US President Donald Trump's tariff war with Canada and his threat to annex the North American country. The leader of the opposition has conceded defeat, while Carney, who previously headed the Canadian and the British central banks, vowed to win the trade war with US. Power begins to return to Spain and Portugal after unprecedented blackout that is being blamed on extreme temperature variations. The two countries were without trains, metros, traffic lights, ATMs, phone connections and internet access. Take a look at this report.
Power started returning to parts of Spain and Portugal on Monday after a huge outage grounded planes, halted public transport, and forced some hospitals to suspend routine operations. In Madrid, these international students were relieved when the lights started coming back on.
It shows how dependent we are on it. But we were actually most afraid of walking back home when it's dark, without the streetlights when it was dark.
Spanish Prime Minister Pedro Sanchez said Spain's grid operator had restored electricity supplies to about half of the country, and the rest should be restored by Tuesday. He added that authorities were yet to establish what had caused the blackout and were not ruling anything out. Various municipalities in Portugal, including the capital Lisbon, also saw power come back on Monday night. Portuguese electricity distributor REN said it had restored production at a hydroelectric and thermoelectric plant and was prioritizing supply resumptions to hospitals and transport. Such widespread outages are unusual in Europe.
And let's move on. Siddharth Roy Kapoor's production house, Roy Kapoor Films, has secured the coveted TV rights to William Dalrymple's The Anarchy. Acclaimed director Stephen Frears will bring the best-selling book to the screen, delving into the rise of the East India Company and its enduring impact on India. To dive deeper into this ambitious project, Shireen Bhan sat down with Siddharth Roy Kapoor for an exclusive conversation there. Listen in and take a look.
So let's start with the big reveal. What have you got up your sleeves?
Well, we've got The Anarchy, which is a TV series adaptation of William Dalrymple's epic saga on the history of the East India Company. It's one of those books that you just can't put down.
Yeah.
And when I first heard that William was working on this, book, I actually found out about it a few months before it was going to be published. So I reached out to him immediately. He was kind enough to give me a manuscript, and I read through it just chugged through it in one sitting, and realized
Are you a
that this
history
was.
buff?
I am a huge history buff. I am, and it's
Because
just.
William Dalrymple cannot be done in a day.
Well, it was one of those things which just sucks you in, because I've always been very interested by the history of colonialism and of course the Mughal rule, sort of before that, and the way William writes, he writes with such drama, and the way he treats his characters, he just makes them live and breathe. And so I reached out to him instantly after that and told him I'd love to take on the rights. And, after a bit of back and forth, because he wanted to know what the vision was.
Yeah.
And we realized that we had exactly the same vision.
So
which
what
is
was the
about,
vision that you painted for him?
Well, the vision really is about how contemporary the subject really is. I mean, we talk about these global corporations which are larger than most nation states, being in multiple countries and having the ability to actually influence the world. Here's where it actually happened 500 years ago, where you had a global corporation with its own private army coming and taking over a subcontinent that was 25% of the GDP of the world at that time. And, you've got delicious characters in there, from Robert Clive to the Mughals, to the Dutch, to the French, to the Portuguese, to the Jagat Seths, the moneylenders. So it really is a story that has to be told with that epic scope and scale, the way that the Game of Thrones or The Crown have been told. And I think I've always had the ambition of being able to take our content and reach out to the world with it. And this is a story that we should be telling ourselves.
So this is going to be mounted for a global audience.
This is going to be mounted for a global audience.
And you've managed to bag a big name to do that for you.
So we've got Stephen Frears coming on board. I used to watch films like High Fidelity and Dangerous Liaison when I was, in college. And to imagine that the director of those epics is now going to be actually helming The Anarchy is just...
And how did that come about?
Well, our partners Whip, actually, which is a US production company, they've made shows like Mayor of Easttown and Dickinson. Paul Lee, who runs Whip, was running ABC when I was at Disney and running India. And we stayed in touch for a long time. And then he started Whip and I started Roy Kapoor Films. And we were chatting about what we could do together. And when I told him about these rights, he said, wow, that's something I'd love to collaborate on.
Right.
So we got together, and through Paul and through Whip, we were able to reach out to Stephen. And he knows William, incidentally.
Okay.
And that helped. And he'd heard of the book, he read it and loved it, and that's how we came on board.
So when do we finally see this being converted into reality on screen?
Well, we're ready with our materials now. We're ready with the writing, and I think the next stage really is to figure out the right home for it, so the right platform. That's a process that's ongoing right now.
So how do you pick the right home for something that you're producing? I mean, give us an example in the context of this with The Anarchy. How do you find the right home?
I think the platform that can actually give you the resources to tell the story in the way it should be told, and that gives you the global reach to be able to reach out to everyone who you believe the story will resonate with, would be the right platform. And I think, you can literally count them on one hand, maybe two. There are 5 or 6 platforms around the world that have the resources and have the ability to be able to give you that reach.
So have talks begun with the Netflixes and the HBOs of the world?
Talks have just begun. A little too early to sort of get into details around that, but it is exciting.
Now let's get you some updates from the world of cricket. The 14-year-old Vaibhav Suryavanshi became the youngest ever to score a century in the T20 cricket as he helped Rajasthan Royals chase down a 210-run target with 4 overs to spare. The 35-ball 100 is also the fastest in this season's IPL. The youngster's feat was also met with celebration in his native village in Bihar, where people gathered to celebrate the achievement by the youngster. And as we wrap up the show, here's some good news. Network 18 is the leader in news information category in the on-platform leadership network level with 183.2 million unique views, beating Times Internet as per Comscore MMX report of March 2025. At the Social Plus on-platform leadership network level, Network 18 is runaway leader as per the Social Plus MMX Comscore report for March 2025 with 315 million unique views, which is 55% more than the nearest competitor, that is Times Internet, at 202 million. News 18 also races ahead of Times of India in terms of Social Plus MMX cumulative reach. News18.com overall clocked 251 million unique views to beat the Times of India overall with 183 million unique views as per the Comscore report for March 2025. Now, as per Comscore social media metrics report, Network 18 is 2 times bigger than the nearest competitor with a 54% reach within the 389 million overall social population. And speaking about Indian languages, in terms of Social Plus MMX cumulative reach, News 18 India languages is the leader in the category with 182 million unique views as per Comscore report in March 2025.
Good afternoon. Welcome to Midcap Radar. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. I am Reema Tendulkar. With me is Hormus Fatakia. And these are the top stories that we're tracking this Tuesday afternoon, 1:30 p.m. Stocks swing up and down amid tariff uncertainties. Capital goods, energy eke out gains, while healthcare, FMCG drag. Midcaps fare better. Tata Tech slips more than 5% after nearly 4% equity worth 1,094 crore rupees change hands, while Sami Hotel surges 5%, post a large trade of 87 lakh shares. Defense stocks extend their gains for the second day in a row as the India-Pakistan border tensions persist. Stocks like Cochin Shipyard, Garden Reach, Data Patterns all up between 10 to 13%. PNB Housing Finance rallies 8% after posting Q4 numbers. Net interest margins at a 6-quarter high. Gross NPA ratio at a 22-quarter low. Oberoi Realty, on the other hand, falls nearly 4% on weak numbers. Today's a quiet session after the more than 1% rally that we had yesterday. Today, markets are consolidating, but consolidating with a positive bias. We're up 37 points on the Nifty. Sensex up 186 points. Reliance, that's the big mover yet again. Reliance Industries has added 2.5% at a 4-month high. And in the last 2 days, Reliance Industries has added more than 8%. And IT has made a comeback too. Yesterday, IT was dragging, and today IT is positively contributing. Tech Mahindra 2.5% up. Infosys, HCL Tech, TCS up more than 1%. But that's the large cap action. This is Midcap Radar, so we need to find out the midcap movers, and Hormus is now at the big wall with all the midcaps that are moving around.
We just spoke about defense names, and we can't not talk about them because they are continuing from where they left off on Monday. Almost every single defense name is trading with gains of anywhere between 4% to as high as 13%. You look at Garden Reach is up 13, Data Patterns is up 13, Cochin Shipyard has moved into double digits as well, 10% higher there. Be it Masgaon Dog, be it Paras Defense, be it HAL, all of them are trading with very healthy gains in today's trading session. Earnings reactions, of course, we are counting down to a lot of major earnings, but there are stocks that are reacting to those. UCO Bank is off the highs but still holding on to gains of around 4%, but not so good earnings reactions for stocks like AWL Agri, Oberoi Realty, TVS Motors, all of them at the lowest point of the day, down between 3 to 5%. The newsmakers of the day include the likes of Aurobindo Pharma, of the production stopping at its Andhra Pradesh facility, and that has had an impact on the stock. But the two other names that are in focus are Sami Hotels and Tata Technologies, both of them that had a block deal earlier in the day and are reacting to that. Volumes, stocks that are doing well on volumes. PNB Housing at one point was up 10% but has cooled off. Whirlpool continues to gain and it's up 30% this month on very strong volumes. India Cement is at the day's high, as is Shipping Corporation of India on very strong volumes. And some of the other gainers in the broader markets in today's trading session include the likes of TBO Tech, Sai Life Sciences is doing well, and Honasa Consumers finds its name at the list of gainers, 5.5% higher among the top movers in the broader markets, Reema.
Okay, that's a pretty exhaustive list. Lots of action in the broader markets today. Let's get into a break. As we do that, here is some good news. Network 18 is the #1 digital network in news and the information category as per Comscore report of March 2025. News18.com has 38% more users on native and social platforms, more than Times of India. As per, again, the Coms report of March 2025, Network 18 is way ahead of Times Internet with 55% more internet users on native and social platforms.
investing.
Welcome back, and on to corporate conversations. Then KPIT Technologies is the next management on our radar. It was a weak quarter, but to discuss this and more, Vivek Mathur, the Chief Financial Officer of the company, is joining in on the show now. Vivek, good afternoon. Thank you for joining in. You know, you reported a 30% top line growth in FY25, a 44% around about margins in FY25. So what are the targets that you have set for FY26? Because FY25 was a very different year. Markets were good, at least for the first half, but you're going to a completely different, volatile, uncertain market for FY26. So what are the targets that you have set for the new year?
Thanks for hosting me on this. We believe that we will continue to grow at a pace of 18 to 20% on top line because we are a diversified company. We are not solely dependent on domestic mutual fund business. About 64% of our revenue comes from domestic mutual fund. And as you said, market was quite supportive in FY25. And we believe that, the support will continue in coming quarters as well. But having said that, the other businesses have been outgrowing the growth in, the domestic mutual fund business. If you look at alternates or, which has grown at 76%. If you look at international business, that will continue to grow at 25-30%. And, the new businesses that we are acquiring, which is the global fund administration business, up till now, the international business was just about 5-6% of our total revenue. We believe it will grow to 15% of total revenue in the coming year. And, we believe that margins will be in the range of 40 to 45%. And, whatever we are doing in terms of acquisition is all through internal accruals. We are a zero debt company, so there is no interest on the books. And we believe we'll continue to do well in terms of generating free cash flow out of EBITDA, which will help us in terms of not only improving the operating leverage, but also maintaining our guidance of 40 to 45%.
So you're maintaining margins of 40-45%, but on the top line, you're talking about 18 to 22%. And that's a marked slowdown compared to what you did. Is this a conservative guidance? And FY26, X of the acquisition on an organic basis should be similar to FY25. It's just that you're being conservative right now. Or are you worried about the domestic, mutual fund business, which is still 2/3 of your revenues?
So, Riva, it has always been our guidance that we will go at 18 to 20% top line growth, while the mark-to-market gains is something which has helped us in FY25. And that is something which we believe will be range bound as the retail investors continue to remain invested. And we see, our SIP market share is still healthy at 39%. So we believe that, it is not a conservative estimate, but a realistic estimate of what we have been maintaining quarter after quarter. Whatever flows into the mark-to-market gains and that flows into the bottom line, we reinvest that to create future moats or to invest in future products or future geographies. And that's how the guidance remains at 18 to 20%.
But Vivek, even after this, your domestic mutual fund business, you mentioned that you are a diversified company. Yes, but still a majority of your business, almost 2/3 of it still comes from the domestic mutual fund business, right? And a lot of these asset management companies in their earnings call have mentioned that their SIP book has started to flatten off. Considering the market volatility, it might start to taper down further as well if the markets turn awry. So what does that do to your domestic business? And even as it still remains a core component of your top line?
So as I mentioned, 64% of our revenue is based on domestic mutual fund fee-based revenue. And if you look at within that, about 60% of revenue comes from equity AUM. So, if you can say about 40% of our revenue is dependent on how the market moves. So if there is a 10% reduction in the market movement, about 4% of the revenue will get impacted. So that is the, about 3.5 to 4% impact on revenue is the only impact that we will have. And other businesses like, issuer solutions, which is per folio per annum, and value-added services within mutual fund, which, almost 6% of the revenue, which comes from that. For the year gone past, overall VAS revenue has been 7%. If you look at alternate, that has been growing tremendously, about 70% plus. So, global fund services, which is based out of Southeast Asia, we have started winning large contracts. So, linked to market, the impact will not be huge. It will be range bound between 3.5% to 4%. And that's why our guidance that, we will continue to maintain good margins, a healthy yield, and top line growth, which will be in the range of 18 to 20%. We believe that domestic mutual fund should grow at a pace of about 14 to 15% organically without looking at mark-to-market abnormal gains. And that is what our guidance has always been, that if there are mark-to-market gains, our EBITDA margin will be in the upper range of 45%, and that you have seen in the last quarter. But for the M&A spend of 12 crores, it would have been 46%. But if the markets are not so good, we maintain a guidance of 40%.
Got that. What was the market share gain last year in the SIP business? It now stands at 39%, but did you gain market share?
No, we haven't gained market share. It is in the same range as it was. So we haven't lost market share, but we have been steady.
What about international business margins? While on the whole, you're looking to maintain your blended margins, your international business margins are lower than the rest.
Yeah.
The reason for that, or do you have levers to improve it, especially now that you've got an acquisition of Ascent?
It's more to do with scale. International business is not at a scale at which the Indian businesses are. Indian businesses are at a gross EBITDA margin of about 55-60%, while the the international GFS business is in the range of about 30%. So we believe that as we started winning new contracts backed by platform sale through Hexagram, or winning TA and FA clients, as we get into leveraging Ascent, the margins and the scale will improve. If you look at absolute yield in that business, it's more than 5 bips, vis-a-vis 3.6 bips in the domestic mutual fund in India. So yields are healthy. It's a matter of getting scale, which we are now started winning clients. It takes anywhere between 18 to 24 months in the RTA business in Southeast Asia to win a client, because it is captive business to outsourcing. We don't have competition in Southeast Asia, unlike what we have in India. It's easy to win against competition than to convince client to outsource. And that's why it takes time. But once you get it, you get a ready-made AMC with ready-made AUM. While if you win a new client in India, it takes anywhere between 5 to 7 years to have a meaningful corpus and start getting better yields, which will contribute to the overall margin.
All right, Vivek, thank you so much for sparing time and joining us today. Wish you good luck for the rest of the year as well. The management there of KPIT Technologies, the stock doing well for itself, 2.5% higher at 1271. Take a short break. On the other side, Samiran Chakrabarti of Citi joins us to discuss the latest RBI open market purchase announced last evening. Stay tuned.
Welcome back. I'm interrupting Midcap Radar because we want to understand the Reserve Bank's unexpected announcement of a massive OMO purchase of bonds, or rather open market operations purchase of bonds, which they announced late Monday evening. The Reserve Bank said it will buy 1.25 lakh crore of bonds between May 6th and May 19th. That is, when they buy bonds, they put in that kind of money into the interbank market. The interbank market already has surplus liquidity, so this surprised a lot of market people to understand what the Reserve Bank is trying to achieve. I have with me Samiran Chakrabarti, Chief Economist at Citi India. Samiran, good morning and thank you very much for joining in at short notice. Well, first of all, were you surprised by the announcement?
So, Lata, as things go, these OMO announcements have been much higher than where the market expectations have been. And I guess the primary reason behind this is that in earlier instances, the market was looking at different kinds of overnight rates and spreads of 3-month CD over overnight rates to understand whether there is liquidity stress in the system, or in other words, was looking at the price of liquidity to decide whether further liquidity infusion would be done by RBI or not. But now what appears to us is that the RBI has a certain quantum of liquidity target in their mind, and they are gradually building up through these OMO purchases towards that liquidity target, regardless of where the price indicators of liquidity in the market is. The overnight rates are already lower than the repo rate. The 3-month CD spread has collapsed almost 100 basis points from the highs about a month or so back. So that's not the primary reason for the OMO. The RBI is building towards that 1% of NDTL type of liquidity surplus as they move forward.
Okay, I take your point. Just to tell my lay viewers, the thrust of the Reserve Bank, according to Samiran, is that they're not anymore looking at the yield levels. Initially, bond guys used to look at the yield levels, and if it went higher than the repo rate or something in the call market, then you would expect Reserve Bank to intervene. Now the Reserve Bank is intervening, although the yield is below the repo rate. And as he sees it, that's because they want to keep the total amount of excess liquidity at 1% of total deposits, which is what NDTL means. But Samiran, therefore, what is their aim? Why would they want to keep that 1% NDTL? Is it for faster transmission of deposit rate cuts?
So it could be a mix of quite a few things. One possibility simply is that despite the significant OMOs that RBI has already done, the durable liquidity surplus still is lower than that 1% of NDTL. We think that number is somewhere close to the 2 trillion rupee mark rather than the 2.5 trillion rupee where probably that 1% of NDTL is. And the banking system liquidity surplus, the frictional liquidity, is also not that big a surplus as yet. Now, the interesting thing is that in the month of May, the RBI is going to give a very large amount of dividends to the government, budgeted to be at least INR 2 trillion. That adds on to the durable liquidity, and at that point of time, the durable liquidity surplus would definitely cross that 1% of NDTL mark. Now, to what extent that injection of durable liquidity will be compensated by other types of absorptions of liquidity, whether in the form of higher currency in circulation, higher FX intervention, or for that matter, there's a large amount of FX forwards which are coming up for maturity. To what extent rollovers would happen or not happen on that front, everything will determine where the final durable liquidity is going to end up with. Our sense is that if the forwards, it's very difficult for us to estimate the forwards part, but without that, the durable liquidity surplus could end up closer to 5 trillion rupees is what our sense is. However, the banking system liquidity will not improve as quickly because it takes some time for government to use or spend this dividend that they will get from the RBI. But once the banking system liquidity improves, that's the time we will probably see more reaction on the deposit rate and the lending rate side. And there, I guess the main issue is that if the bond yields come down, then we have seen that with about a 6-month lag, the weighted average lending rate also comes down. given how the bond yields have behaved in the past, our sense is that within the next few months, we should see the weighted average lending rate at below 9%.
Okay. Can you give us some idea, therefore, of where you expect the 10-year and the rupee to range over, say, the next 2 quarters?
So our sense is that right now there is a possibility that the 10-year comes below 630 also, which was our initial target taken long back. That's because the rate action as well as the liquidity action has been more than what we had anticipated at that point of time. However, we have to also be cognizant of the fact that in all earlier cycles, in the rate cutting cycle, typically the term spread, the spread between the 10-year bond yield and the policy rate, that widens further. So that's why the bulk of the reaction from future rate cuts, we think that at least 50 basis points of more rate cuts could be there. That could be more at the short end of the curve rather than at the long end of the curve. Although we have to see which particular segments the OMOs are happening to some extent, that might also impact the yields. But overall, not expecting a major action at the long end, more action at the shorter end is what our sense is. And on rupee, I think it's a tussle between where the dollar is going versus where the CNY is going. But our sense is that at this point of time, the bias is towards a very marginal depreciation, but a more range-bound rupee movement, because inflation differential is collapsing quite significantly for India. And the fact that we have now built up substantial reserves as well, our ability to keep the rupee in a relatively narrow range is much better now.
Okay, a very quick last question, and it's more academic really. There is one part of the bankers who feel that because they have RBI has $80 billion of forward sell positions, buy sell positions, and maybe a large part of it is maturing. That is why this money. And there is the other one who was saying what you are saying, that there will be cash withdrawal and there will be CRR money going away. What do you think is the reason? Is it more the FX reason, or is it more cash withdrawal, CIC and other reasons?
So obviously, as I was saying, that without the forwards position, the durable liquidity would end up close to 5 trillion rupees by end of the quarter. So it's possible that the actual increase will not be that much because of some forward positions being also extinguished. But it's very difficult to take a call that how much RBI will go on this front. But there is room for RBI to take this approach, because the overall durable liquidity surplus is going to be so much that they would not be too concerned on that front. But I must say that it appears that the liquidity situation is being kept in line with the accommodative stance of the RBI's current monetary policy, which will make sure that the transmission of rate cuts are much faster.
Okay. Thank you very much, Samiran, for this unscheduled stop and explaining the policy to us. So there you are. It looks like the main thrust, as far as you and I are concerned, is that deposit rates should also fall as quickly as the repo rate is cut, which is obviously good news for banks and NBFCs.
Which shows the kind of moves that we've seen over the last couple of days as well, right? Lata, thanks a lot for that update. By the way, the more updates on your screen. The second day of Ather's IPO subscribed around about 24% of the full issue. The retail portion is fully subscribed. The NII portion subscribed around 20%. The employee portion, though, subscribed almost 3 times the shares on offer. By the way, 24,350 is where the Nifty still continues to remain at, still struggling to cross last Friday's high. So meandering in a range as there is a tinge of caution that continues to persist on the street. But the defense stocks continues to move higher. Tata Technologies is at the lows of the day. Oberoi Realty 2 at the lows of the day. But with that, we call time on this edition of Midcap Radar. From Reemami and the team that put this show together, thank you so much for watching. MF Corner on the other side.
you. Good afternoon. Welcome to MF Corner on CNBC-TV18. I'm Vinny Motiwala, and thank you so much for tuning in. Today on MF Corner, we're going to be discussing some important changes that have come in and why banks have started slashing their deposit rates. This has come in after the RBI repo rate was cut recently. And what is happening to savers? Now, what are they finding? Their returns are actually shrinking. Whether you look at saving account, fixed deposits, that will start shrinking in. Now, as interest rates on traditional bank deposits head lower, many investors seem to be now looking for better short-term alternatives, more liquid alternatives as well. So what are those alternatives for you all? What is driving this shift mainly coming in towards the liquid funds? What does it mean for your portfolio in the coming quarters? To discuss and help us decode all of that, the outlook for liquid as well as overnight funds, we are joined by Kaustav Gupta, co-head of fixed income at Aditya Birla Sun Life AMC, to talk to us about all of that. Kaustav, good afternoon, and thank you so much for joining in with us as always, because this is a topic that is piquing the interest of investors right now. Everyone wants to know, what should I be doing? Now, let's just start with the basics. With RBI adopting an accommodative stance and banks lowering deposit rates right now that we've seen coming in, and these are big banks, right, which we've seen in recent times reduce this deposit rate. What is the outlook for liquid funds as well as overnight funds in the coming quarters? What do you see the trajectory of this?
Yeah, as you said, that rightly said, that the RBI has adopted the accommodative stance, and as the name of these funds suggests, that these funds, they broadly track whatever is the RBI operative rate and their stance on the liquidity. So the blend of both do impact these funds as well. If usually these funds, they do track between 50 to 100 basis point over the operating rate, depending on the stance, given that the stance is liquidity. And the RBI is very aggressive in adding the liquidity to the banking system. We do expect these funds broadly to track the operative rate plus 50 basis points in terms of investor experience incrementally.
You know, Kaustav, if someone has those savings account, right, HDFC Bank, Axis Bank right now, these are the ones which I'm just naming, have reduced their rates, okay, to as low as much as 2.75% is what one would be getting on that savings account. What are the key reasons, or positives that you should tell an investor to consider shifting maybe that excess fund that they have to something like a liquid or an overnight mutual fund instead of just keeping them in the saving account? What sort of trajectory is there in terms of returns also?
You need to understand that banks are usually driven by their NIMS margin target, and that's the key focus for equity investors in these banking and generally the management of the bank. And as RBI is pushing for rate transmission to be happening faster and more effective, the asset side of the banking book are getting reset or they are being forced to reset much faster. You also need to be noted that for the first time, the external link benchmark loans are highest and are as closer as 40% of their asset book, which means that every time RBI is easing rates, the rate easing trajectory is being passed on faster. To accommodate this reset in asset book, banks need to lower their deposit rate in equal quantum and much faster as the asset book is being pressurized due to cut in interest rates. And which is why all these banks that you spoke about, they are cutting their savings rates and deposit rates in order to save this net interest margin. Now, unlike this, the liquid funds, the operative rate, as I told you, is the RBI operative rate plus 50 to 100 basis point, depending on the liquidity instance. And which is why in current backdrop, when the liquidity is accommodative and RBI is aggressive in making sure that this transmission happens faster, the experience most likely of these funds should be much more better compared to the traditional deposits on the ultra short term space, or you can say the CASA savings. And which is why in order to optimize the short term investments, the investor need to look upon beyond these traditional deposits, and which is where these funds, they make a lot more sense.
Absolutely. And what is a typical return, for liquid or overnight funds compared to current savings? How much better could they be making on, these funds?
Look, being the market participant, we can't guarantee the returns. But as a matter of fact, if you look at the historical perspective, over the large banks, the CASA rates, these funds have generally given between 250 to 300 basis points lower compared to the CASA rates. So this moves again in line with the liquidity. In the current accumulative liquidity, one should expect on the lower end of this range.
Kaustubh, just a general question. Where are these investments which are there in liquid funds? Where do they invest the money, liquid funds or overnight funds? It's equity markets only, or is there some other format that they follow for these funds?
So these funds, they don't invest at all in equity. Overnight funds, by mandate, they are supposed to invest only in overnight instruments, which is most of it is in TREPS, which is guaranteed by RBI. So practically, it's a sovereign exposure. Against that, liquid funds, they run duration anywhere between average 30 to 75 days. And they do invest in money market instruments having maximum maturity of 90 days, which is why at a portfolio level, the average maturity is between 30 to 75 days, depending on the month of the seasonality of the quarter. And because they are investing beyond overnight instruments, the term spreads of 30 to 90 days, which you typically move between, I would say, 50 to 100 basis points, that kind of spreads is what we offer to these sets of investors.
Okay. And Kaustubh, for what sort of investors, when should one go for actually a liquid fund, which is more suitable? And what scenario would you say one should go in for an overnight fund instead?
So investors with up to 7 day of horizon, they can look at overnight funds. Anything beyond 7 days to 30 days, what we advise investors to look liquid fund as a substitute to their fixed income investments.
Okay. And is there a difference in terms of maybe some expense that they would be spending on liquid fund and overnight fund?
Usually, most of these funds, they charge between 10 basis point to 20 basis points as a management fees or expense.
Okay. Okay. Thanks so much for that. But, so what are the factors that one should actually jot down, right? Other than if I know if it's 7 days or above 7 days, then pick and liquid and overnight fund on the basis of that. Are there any other factors that one should be considering while looking at a liquid and an overnight fund? And how important is also emergency compass at such a time that you need to maintain? What should they be doing here?
Well, again, in all these funds, the redemptions, or as far as the liquidity is concerned, that is available to the investor on a T+1 basis, which means that you give a redemption request today, the money will be credited to your bank account by tomorrow, first half. In fact, for the short-term requirement, which is up to 50,000 rupees requirement, the money is available at an instant redemption basis. So from that perspective, this fund is as good as like a bank deposits up to 50,000 rupees each scheme, which is liquid and overnight at a fund house level, and at an industry level also you can have many more such investments. Now, as far as I would say in terms of consideration, clearly beyond liquidity, what one should invest, they should think for is that this clear timeline that up to 7 day money should ideally go to overnight, and beyond 7 day money should go to liquid fund. One should be cognizant of the fact that liquid funds, because they invest between 30 days to 90 days paper, they do carry a little bit of, I would say, duration, or you can say a credit risk. But most of these investments are made in highest rated short-term paper, which is A1 plus. So these rates are negligible, but they do have these kind of risk, and which is why the duration of or average maturity or holding of these funds, they take care of these risks as well.
Okay, surely that is interesting to watch out for there, and how everything is managed for the funds as well. Short term is mainly the bet that comes in for these kinds of funds, and they are quite liquid is what Kaustubh was highlighting. So not much of a worry how you have your normal deposits. That's how you can work around this as well. Not much in terms of a time period that will take to liquidate the funds as well. But on that note, we're going to sip into a very short break, and we'll continue with this discussion on the other side with Kaustubh Gupta on bank saving, interest rates, mutual funds. So don't go anywhere. Stay tuned in. Welcome back to MF Corner on CNBC-TV18. We still have with us Kaustav Gupta of Aditya Birla Sun Life AMC on bank savings interest account, as well as your liquid and overnight mutual funds. Kaustav, how safe are liquid and overnight funds versus something when you say a savings account, right? Because what are the factors that they should consider could be risk for this side of the funds that we have?
I told you that any fixed income instruments on the mutual fund platform, they typically carry three kinds of risk. One is liquidity, second is duration, and third is credit. Now, because these funds, they do invest in up to 90 days paper, so there is a little bit of mark-to-market risk which is being exposed to in terms of interest rate movements. But by having a duration ability, or you can say clarity in terms of holding period of 7 days or more, most of the scenarios, these MTM risk in terms of interest rate movements is being taken care of. The second bigger risk is on the credit side, but again, because we do invest in A1 plus papers, which are highest in short-term rating, and most of these investments are made in well-known companies by adequate credit research by in-house and being done by most of the, I would say, the capital market entities. The perceived risk or the liquidity risk is again is marginal. The third, in terms of overall liquidity of the portfolio, so because on an average about 15 to 20% of the funds get matured every week, so per se fund doesn't carry any large liquidity risk. On top of it, these investments are liquid, so there are banks and other corporates which are always available to buy these up to 1 to 2 months papers in order to maintain their LCR ratios. So that liquidity risk is also taken care of. So in a sense, I would say that yes, there is little bit of mark-to-market risk on account of interest rate movement or on account of the credit move. But all mutual funds, they do take care that enough guardrails are in place so as to make sure that these risks are adequately taken care of.
Now, Kaustav, when I'm looking at just March 2025, you saw a significant outflow from liquid funds. Largely, what it was attributed to was seasonal corporate withdrawals. Should retail investors be concerned about such a volatility in terms of the fund flows, or is it normal market phenomena? How should one be reading that as well?
So these are seasonal factors. Every year in run-up to March, the demand for money goes up on account of the accounting closures, and that's when large amount of redemption happens. And we have been meeting these redemptions adequately within the regulatory framework since ages. So it's a normal phenomenon. Investors should not be worried for it. If you look within a week of March crossing, again, these funds, they do come back to these category of funds as a part of their normal investments.
Okay. And, what is the best way in terms of an investor combining saving accounts, mutual fund categories to balance and get better returns? Any tips and suggestions that you have how they could maximize the returns from liquid and overnight funds?
Again, it's a little bit unfortunate, but irrespective of monetary policy bias, funds like liquid and overnight, they have generally deliver good returns compared to the traditional very short-term or ultra-short-term deposits. Just because of the lack of awareness, or you can say the ease, and to some extent the laziness attitude, some portion of your money, or I will say significant portion of your money, do end up parking in bank deposits. So it is, especially in the current scenario when the RBI is in rate easing cycle and the accommodation stance is in place, which means that enough liquidity is being assured by central bankers. These funds, from a return expectation or experience perspective, they make even more sense. So from taking these into account, my takeaway is that investor, at least some portion of their deposit, they should look to diversify away from keeping in CASA or in a very ultra short-term deposits to these category of funds. And as their experience matures, I think they will be knowing themselves by running on the treadmill that it makes sense that they become part of their investment allocation.
Okay, Kaustav, what role do these funds actually play in terms of your overall portfolio? Not specific time, but overall my portfolio. How important are liquid as well as overnight funds for an investor And especially if you have a low risk appetite, how much should your investment actually come in here, even though it's short term?
So all your emergency funds, the funds that you think that you need for maybe meeting your expenses for next 1 month, they should find the way to this category of funds.
Okay. And in terms of someone who's just starting out, right, what are the options that are there in this liquid fund or overnight funds? Like normal funds, you do have SIPs, lump sum, systematic transfer plan. Is that something that we have here as well?
Again, these funds, because as I told you that they run very negligible risk, my advice to investors is that you start incremental investments, whatever you are doing as part of your fixed income allocation to these funds. And as your experience turns out to be, you can increase allocation over a period of time.
Are there any sort of tax advantages that one could have because of liquid funds as well?
No, they are treated at par or parity with the traditional deposits.
So there is no sort of tax benefit that one can watch out for here as well. Okay. And, just in terms of overall, what is it that one should watch out for in terms of what is the right time for me to start a liquid fund? Is it always whenever I have any cash in my saving accounts makes sense to move it here? Or is there a particular time when you could do better by investing in a liquid fund for a short period of time?
So it's like, because it's a temporary surplus that we advise investors to come into these funds. Anytime when you are having a surplus, you can come and invest in these funds. In terms of experience, of course, once you are crossing your quarter or your particular month end, because at that time the money market rates in the ultra short term, they do tend to go up, and then again they tend to go down. So those kind of small capital gains, they do accrue to this category of funds. But those are more tactical calls. From a all-season perspective, my advice is that, especially in a rate easing scenario, and especially in a scenario when central bankers are pushing for a rate transmission faster to the banking system, these funds, they do make a lot more sense for your very short-term deposits in order to optimize return on them.
Kaustubh, have you already started seeing a sentiment shift or an investor shift coming towards liquid flows and liquid inflows, liquidity as well as overnight funds?
Yes, so there has been some traction from the retail investors over the course of last, I would say, 2 to 3 months, where we have seen there is a clear shift on the short-term investments to these category of funds.
Okay, and are there any scenarios that an investor may actually face in terms of delays or restrictions from withdrawing funds? Are there any such cases or scenarios in these funds where we could face some problem?
By regulation, we are supposed to give liquidity on a T+1 basis, except for, as I told you, 50,000 rupees, which is available on the Insta redemption request. So whatever the redemption request, we get it. We need to honor that payment. And as I told you, that the portfolio is adequately liquid at all point of time because of variety of regulatory needs, and because of the construct of the portfolios are fairly liquid. So we don't envisage that kind of scenario playing out in these category of funds.
Kaustubh, if you could just help us understand that is there a specific, because now the RBI is also focusing a lot more in terms of liquidity so that the transmission happens quicker, right? That's how we started the conversation. So if there are more cuts that come in, then does that indicate that, these funds would do much better in the near term as of now, or historically, how have they moved when we are seeing changes in rates?
So, these funds, as I told you a while back, that these funds, they very closely track what is the headline repo rate or the operative rate in the country by the central banker. And second is what is the liquidity stance. Historically, the spreads or the YTM of these funds, they have tended to move between 50 to 100 basis points, depending on the liquidity stance. Given that the stance is positive or accommodative and the liquidity is abundant, we do expect that the YTM of these funds, they will be tracking closely about 50 basis above repo. The point is, compared to the traditional deposits, where most of these deposits, they are tracking sub-repo, so compared to them, it become a compelling case, especially in current macro backdrop.
And what is your advice to an investor who sometimes still feels hesitant to actually look at liquidity funds and overnight funds versus bank deposit, because they sometimes just think like, okay, if I've put it in an FD or if I've just put in my savings bank account, it's okay. They don't want to take the risk, or they find this risky. Could you just advise our viewers?
So the point one, as far as overnight fund is concerned, there is no risk at all whatsoever, because in that category of funds, the underlying investment is mostly the TREPS, which has been guaranteed, or the settlement of that is being guaranteed by one of the RBI entity, which is CCIL. So it is practically the sovereign risk. One can argue that even better than banks. Those category of funds is clearly, from a risk perspective, are clearly out and most likely better than the very short-term deposits. As far as liquid fund is concerned, my advice to the investor is that the history has suggested that as an industry we have been able to manage across cycles, irrespective of whether it is 2008, 2012, 2018 or 2020. But more important is that if you are still reluctant to it, I would advise that some portion of your these short-term deposits you start parking with these category of funds, experience yourself, and then make the I would say more rational judgment.
Okay, and while picking out a fund, maybe if I have to pick out in terms of different options that you have for liquidity and overnight fund, what are the best points that one should look at, or a checklist that one should have while picking the funds?
So first of all is your average maturity. That is how long is your money available. If it is less than 7 days, go to the overnight funds. If it is more than 7 days, come to liquid fund. That's the first checklist, which is what is the expected duration of your investment is likely to be. The second thing is that within the liquid fund category, you can look for average maturity. If rates are easing or liquidity is abundant, probably the longer maturity, average maturity fund is likely to give you better experience. Then there are portfolio cuts that you can look through in terms of credit profile, in terms of the maturity profile, week wise, month wise, and then you can take a more informed call for the investors who understand these capital market nuances.
Okay, Kaustubh, thank you so much for joining in with us, reassuring our viewers what liquid funds mean, overnight funds mean, and why are they so risk-free. There is no risk coming in there, so you should not worry while investing in these funds as well. They are a short-term bet for your savings which are lying idle, and a better way to park your money, which is just there in your savings account. So thank you so much, Kaustubh, for joining in with us. And with that, we'll wind down this edition of MF Corner on CNBC TV18. Thank you so much for tuning in. Up next, we're closing well.
Go beyond market headlines to understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC-TV18 Motilal Oswal studio.
The Hang Seng is up around 0.5%. The Taiwanese index absolutely flat.
Supports come in at 23,847.
The past few weeks, when there was liquidity crunch, they didn't do such a huge purchase of bond.
24,330 is the open and 60 points in the green.
There is no positive surprise from the major earnings which have been declared so far.
A steady reduction of interest rates, I think, is needed at this point in time.
Today, markets are consolidating, at least in the morning. Midcap action is intact. The Midcap index is up 0.5%.
India is definitely mulling more economic measures to bring pain to the Pakistani economy.
After the more than 1% rally that we had yesterday, today markets are consolidating.
Good afternoon, hello and welcome to Closing Bell. We are here in the last hour and it's been a quiet session after charging ahead for the last several days. The market has chosen to take a bit of a pause, take a bit of a breather. And we have been around this zone. I mean, the morning opened with a big flourish, but then we corrected almost around 10 o'clock. And since then, the market has only consolidated. The good thing is that there are a lot of large cap names that are seeing consistent buyings. And that's preventing a wider fall, whether it's a Reliance, whether it's an Infosys, whether it's TCS. So they're keeping the green flag flying high, but let's see. Promises to be an interesting last 1 hour. I'm Surabhi Upadhyay. With me, as always, Reema Tendulkar and Nigel D'Souza. We'll have Prashant in a second as well. Hi, folks. Good afternoon to everybody.
Good afternoon. And once again, as you said, it's Reliance Industries, which is powering the index up. Reliance Industries share price has moved up 8% in the last 2 days, and the stock is now at a 4-month high. And IT has made a comeback. Yesterday, the Nifty IT index didn't participate when the benchmark indices gained 1%. It closed in the red. But today, IT is up 1.5%. You've got HCL Tech, Tech Mahindra, TCS shining in trade. Look at the mid-cap action. Hexaware is up nearly 4%. I think the last time I checked, the company is talking about good growth in Q2 and great growth in Q3. So that's got the street excited. India Mart is surging ahead of its numbers later today. And you've got other mid-cap IT names. So whether it's Zensar, LTI, Mindtree, Coforge, Birlasoft, across the board, pretty strong price action on the way up. Other gainers include BEL along with the rest of the defense pack. IndusInd Bank has been the big mover this month. And on the way down, TVS Motors, where the numbers were fine, but the commentary was a bit subdued. They're saying base effect will catch up in terms of the growth. So Q1 growth, could be impacted on account of the base effect. And plus, not to forget, as Jeffrey said, valuations are at 40 times. So that is a tad bit rich. So TVS Motors down 3.5. 90.
Well, that's right. I think Reliance Industries is leading the way. But what's taken a bit of a backseat is Nifty Bank. And in the last 6-7 trading sessions or so, the Nifty Bank has gone to that 56,000 odd mark numerous times. They've gone over there thrice, including today, very, very close to that mark. And that level is getting rejected. So, I think the next leg of rally will happen when the Nifty Bank can decisively conquer the 56,000 mark. Because Reliance Industries now is, finding its feet. That's leading the rally. The Nifty Bank needs to give some support. And IT stocks have already pulled back a goodish bit. So I think that 56,000 mark remains elusive. The bulls will want the Nifty Bank to go ahead and conquer that mark, guys.
Absolutely. And I just want to draw our viewers' attention to one more trade, and that's defense. I mean, it's huge. It's strong. So if you think it's a quiet session and no one's doing anything in the market, far from it. Because the mid-cap index is very even, Stephen. The advanced decline ratio is also 1:1. But peel beneath the surface, go beneath the surface, and then you'll see what's happening. The defense trade that I'm talking about, look at the shipbuilders. Look at Mazgaon, Garden Reach Shipbuilders. look at what's happening to some of the other names, Paras Defense, some of the private sector names on the defense side as well. It's a massive, massive move that we're seeing on these stocks. Cochin Shipyard as well, almost 10% higher. So big moves in some of the defense names for sure. Like I said, even Paras. And okay, so that's one big trade that's definitely playing out. But even otherwise, I mean, there's selective stock selection that's going on for sure. Honasa could be a case in point. Honasa is up almost 5%. At this juncture. Whirlpool is having a good session, 7% higher. Sona, BLW, some of the auto ancillaries have been smart from the morning. Sona would be an example of that. So at an individual stock level, beneath the surface, going beyond the index, there's a fair bit going on. And with that, I think, yeah, we've got Prashant also mic'd up. Prashant, not a bad afternoon. We were just discussing.
Not a bad afternoon, but it's a quieter one, right? And, you know, I always welcome quieter sessions when you don't have to respond to 200-point ups or 200-point downs because it's too dramatic, right? And so a few calmer sessions, at least at an index level, and then we can, I guess, take it forward. In terms of what the market wants to do. But you need those, and we've not had those ever since the 2nd of April. It's either been, you know, a market's selling off, gapping down, or it's basically been gapping up over the last 2.5 odd weeks or so. Let's actually quickly ask Mitesh Thakkar what he'd want you to do in terms of just trades and, you know, the setup overall. Mitesh, good afternoon. What does one do now?
Prashant, my idea is that, you know, at higher levels, I've been recommending to take profits, reduce your long exposure purely because of the fact that while we've had a good rally, the decline which happened on Friday, you know, I think kind of broke the momentum on the hourly and the 2-hourly chart. So I think there is some consolidation which is needed. The daily averages are also slightly left behind, and we are also overbought on the hourly chart. So good chance and higher probability that we'll see a consolidation between 24, 450, 500, give and take a few points, about 24,000, and in the worst case scenario, 23,850, 870. So I think that's the kind of market we are into. So right now, I think the idea is that, you know, avoid taking long on the index, wait for declines. It's a market which is when the setup says buy on declines. So I think wait for the decline to happen. If it happens, then I think, you know, look at exploring long position at lower levels. On the stock side, I have a buy on Tata Consumer with the stop at about 1154 for targets of around 1200. And a sell on Tata Technologies with a stop at about 680 for a target of around 630.
Mitesh, just a quick follow-up from my side on these defense stocks that are breaking out big time. I was just checking, Mazgaon Dock is back to its, you know, all-time high levels. BEL, Cochin Shipyard is still quite a distance from the peak. There are smaller names like Paras Defense, Astra Micro. The entire pack is moving up today with momentum. Do you see anything interesting? I mean, I'm not saying an intraday trade, but even from a positional standpoint, do any of these charts look interesting?
I haven't been tracking all of them. In fact, the one defense stock which is part of our portfolio is Mazgaon, it's HAL. But that about Mazgaon Dock has been on my radar. And I think, you know, the stock is now getting past its earlier highs of 28.50, which was the highest ever weekly closing, and around 29.20, which was the highest ever intraday level, which was in the July of 24. Now, all those levels have been cleared. So, you know, there's no pivot at the upper end left to be conquered. It's a blue sky territory. And if you look at the overall consolidation and the targets, and you try to work it out, a rough target which comes to my mind is around 3,600 over 3,700. So I think it's got a long way to go. It's a good buy to take at current levels. I mean, slowly accumulate because this week the stock is only at 12%. So you buy partly now, get a 70, 80 point kind of pullback, keep adding over there, and keep a stop below levels of around 25.85, 25.80. And I think this is a stock which is heading towards 3,700.
Okay, let's talk about the resurgence in Reliance Industries over the last 2 days. The stock has gained close to about 8%. It's now at a 4-month high. It's added 1.5 lakh crore into its market capitalization. The market cap now stands at 19 lakh crore. And even after the up move, the stock is still 12% below its 52-week high. So just trying to understand some factors which could be driving it. One, it's gone through a tepid period, a prolonged period of underperformance or consolidation. Now, in the last 3 years, the stock has given you a return of only 1%, which basically means 3 years, no return in terms of the stock price, and it's underperformed many of the key benchmarks and sector peers. So that's reason number one. Secondly, in terms of valuations, currently it's trading at 11 times EV/EBITDA. You don't have a direct peer because for Reliance Industries, you do an SOTP valuation given its varied businesses. But say for a retail, which is now seeing a recovery, it's still being valued at a discount to Trent or even another peer like an Avenue Supermart. On the Jio business, where its closest peer is a Bharti Airtel, Reliance Industries has underperformed Bharti's share price by nearly 40%. So some people believe that maybe there is value in the stock price after the long, prolonged period of consolidation or underperformance. And thirdly, the FI ownership in the stock price was consistently coming down. There you have it. Over the last 4 years, the FI holding in Reliance Industries was in excess of 25%. It dropped below 20%. And especially towards the end, as the FIs were selling, they sold perhaps their stake in Reliance Industries. But now FIs are making a comeback. So along with banks, is Reliance Industries a stock that they would be favoring? And plus, as analysts point out, there are multiple triggers ahead for Reliance Industries. One, they're excited about the acceleration seen in retail. Two, on Jio, there are the potential for future tariff hikes and an IPO. The new energy business, because remember in the quarter, the company announced that they've commissioned the first solar module plant. I mean, we don't know the way it's going to play out, but there is hope that maybe this will emerge as a growth driver. So the street is watching this very closely. And even free cash flow. After many, many years, Reliance Industries last year turned free cash flow positive. So that also is seen as a big positive. So put all of this together, and that perhaps explains the resurgence seen in Reliance Industries. The Deepak Shenoy, founder of Capital Mind, is now with us. Deepak, is Reliance a stock that you fancy?
In our portfolios, Rima, we've, I think, owned it for a while. I know that it's probably fallen quite a bit from where it used to be, but, you know, the main trigger for us is the potential demerger between the different units. There's the oil to consumer, there is the Jio telecom unit, there's a retail unit, and of course the rest of the businesses, which includes a bunch of energy, medical, and some other plays, including media. I think the sum of the parts is greater than the whole, but unless you see the parts, you're not going to get the valuation of the parts individually. So the trigger here lies in, I think, a demerger of some sort, which could involve an IPO or involve just shareholders of Reliance getting the individual businesses' shares. We hope this will happen in the next few years. It's been about 4 or 5 years since this has been on the cards, but it's not yet happened. However, the results themselves are okay. It's not like super exciting to me. It's been a rough year, I think, overall for retail and for telecom. And hopefully we'll see some kind of improvements from an operational perspective in future years. But like I said, the bigger trigger here is a demerger, not them showing great consolidated results per se.
Okay, all right. Well, we have got Ambuja Cement's numbers that are flashing for you on the screen. In unexpected lines on a sequential basis, there is a big improvement actually what we are seeing. So margins have improved. If you look at the consolidated numbers as well, from sub 10% margins, well, it's coming at around 18.5% or thereabouts. So the consolidated margins are good. Remember, these consolidated margins include part of what ACC has done as well as what Sanghi Industries has done. I'm looking at the standalone numbers actually. Even out there is some kind of an improvement that we're seeing on the margin performance. So that was on expected lines, and that's the way it's played out as well. So Ambuja Cements, there are plenty of one-offs because there's a government grant in there. There is a larger other income as well. But it appears, first look at it, it appears that the expectation was that we're looking at a good performance coming in on a sequential basis, and that's precisely what it is. Deepak, any view on Ambuja Cements? One of the stocks that saw a sharp correction from the top. The company raised money, promoter sold some stake as well, and the stock just went one way down. At these levels, would you be interested?
No, we're not interested in cement as a whole right now. I think it's very boring. What will you do with cement? It's just a commodity, and you're not even getting this company so cheap. It's a 30+ times earnings, not meaningful in terms of growth. So this quarter, I think the current number shows something, but overall, cement doesn't grow at a meaningfully large pace in India in general. So everybody tries to cartelize and try to keep their margins stable even though it is a commodity. So I find that, not a great long-term business to be in. So cement in general is not something that we like in the PMS.
All right, Deepak doesn't like it, but it appears, the sector itself could be in for better times because government spends have been picking up and also input costs have been going down. And after many, many quarters, we're seeing that price increases, they're sticking a little bit at least. So Ambuja Cements on a sequential basis has improved in terms of an operational performance, but we're waiting by once we get the volume number, maybe we could get a better sense. For the time being, the only point that we'll make is sequentially, there is some improvement with margins recovering from sub 10% to around that 18% odd. Guys, back to you all. I'll just have a closer look at the numbers.
Yeah, absolutely, Nigel. But I was just saying, Deepak, I think Nigel would not agree at all. You're saying cement is boring. Nigel is the most excited when we have a small improvement in the EBITDA per ton. And it's been a very interesting, this year, last 12 months actually has been very interesting. The maximum deal action in this space.
Surbi, just to be fair, on editors roundtable around, I think, 45 days or so ago, when everyone was focusing on Trump's tariffs, we had put out this piece that if you want to be saved from all these tariffs, you look inward. And what came on the radar was cement. The stocks had seen a sharp correction. Valuations are pretty okay at that point of time. And from there, they've done okay. So volumes are picking up, pricing is improving, and input costs are still down. So operationally, things will improve.
No, absolutely, absolutely. See, that's passion speaking, Deepak. On a lighter note, we'll let Nigel get back to the numbers. But okay, let's talk about other stuff in the market that's really capturing the eye. And Deepak, that has to be defense all over again. I mean, when the market was down 4-5 months of correction and then all these defense stocks were selling off big time, they came off 30-40% from the peak. But look at the recovery. Mazga is making new highs. I think HAL is maybe 25-30%, less than 30% away from those levels. And anything and everything, BEL itself, everything is rising. Now, how do you look at it? I don't know, man. Is this just a sentiment move because of what's happening in the country right now? Or is this some real long-term money getting back in? And what would your advice be?
So I think, have been very big on defense in general. We've probably reallocated some of the stocks very recently and possibly regret taking away some of the positions that we had. Primarily because I think, there's a landscape of this is a 10-year thing. It's not just the current skirmishes or the challenges that we face. They are real, of course, but I think defense as a sector is going to improve dramatically. Simply because the government is going to spend a lot more on domestic defense. Regardless of the contours of a US deal, India is very clear that it needs defense independence from having to buy equipment from foreign players. India is the number 1 or number 2 importer of arms in the world. We spend almost as much or more than Saudi Arabia as well, which is also very high. And to be fair, we should be, giving most of that stuff to domestic manufacturers. So the domestic manufacturers, the spectrum, I think we identified this in 2022 mid, and we started buying a lot of players at that time. And I think the scale of this is still 4x or 5x more in the next decade compared to what it is now. So yeah, I mean, you might find some of them are expensive, but if they have the capacity to grow and the hunger to grow, I think the defense players can get a substantially higher market share. Interestingly, some of them are even the defense companies owned by the government because they seem to get some of the larger orders as well. But I eventually think this will, translate into many other areas which are quasi-defense as well, including nuclear power, including some of the other defense-related industries like, BHEL also manufactures a bunch of stuff. M&M manufactures a bunch of stuff for defense as well. So this is also, this will create sub-industries in other areas. So yeah, very positive. Today's reaction may be a little, based on news, but I'm looking at the next 10 years. I think, very exciting times. We'll have a lot more. We'll have
okay, so in that case, Deepak, sorry, coming in over there for a little more nuance. In that case, what part of it? I mean, would it still be HAL? Would you look at these shipbuilders despite the kind of run-up? Would you look at some of the private sector names like Astra and Paras? A lot of smaller names which also have sizable perhaps growth opportunity. So what specifically?
Yeah, I think shipbuilding is actually quite good. If you see ThyssenKrupp in Germany, the stock price has actually doubled because in the last 2-3 months, because Germany is going to have to kind of build its own defense infrastructure. America has decided to stop funding the NATO part of that alliance. So there is going to be a lot more expenditure in Germany, and they're going to give it to German companies. Some of these German companies get a lot of equipment sub-manufactured by Indian shipyards. So you get a little bit of a transfer of that from a business perspective. There is also, of course, like you said, the private players, but the private players here are relatively small. And it isn't, in many of these cases, there may be some succession issues in terms of once the top brass has crossed 75 or 80, you're going to have issues in terms of who comes in next. That is a problem in some of these companies. But I generally feel that the space looks quite good. The only thing that I don't like in this area is something of the order of EPC, the equivalent of EPC, where you don't get repeated contracts. You only get one project-wise contracts, where I think it's not so interesting. If you have some IP in the final version of what's being built, I think that has more potential. But then again, every place has different opportunities. So I won't say any of these things are bad in general. So it's whether it is shipbuilding, whether it is arms, whether it is building parts for the howitzer or things like that. Each of these has different growth paths, and I think all of them will grow. The growth will come at different points. So but then I'm looking 10 years. So I don't care if the growth comes after 2 or after 4. As long as the space continues to be exciting. I mean, this is going to be, sadly, it is going to be a place where the stocks will perform primarily because we are scared or we are, trying to shore up our defenses.
Okay, let's talk about realty. They're in focus. So first up, it's Prestige Estates, because the share price is up nearly 3%. The company received the much-awaited RERA approval for a key project in Indirapuram. And the second one is Oberoi Realty, where the stock is down nearly 3% after a weak set of numbers. Ria is here to give us details on this.
Well, real estate stocks have been in focus today. On the positive side, we've got Prestige Estate in focus on the back of a RERA approval for a key project in Indirapuram. The project has a sales potential of more than rupees 10,000 crores, and it is the largest project in NCR outside of the Gurgaon region. CLSA has come out with a note on Prestige Estates on the back of this, saying that this launch will lay the foundation for the strong pre-sales in FY26, and it will also allay concerns over the miss in the FY25 pre-sales guidance. This approval was earlier expected in Q3 of FY25, and it was also the key reason for the miss in the FY25 pre-sales guidance. Remember, the company had only achieved about rupees 17,000 crores versus its guidance of 25,000 crores. CLSA has also said that they believe that the company can sell around 60 to 70% of this project in FY26 itself, and the company is likely to launch the project in the coming days. CLSA has maintained its outperform rating on the stock with a target price of rupees 2,380. On the flip side, we've got Oberoi Realty reacting to weak numbers for Q4 of FY25. The bookings in this quarter have gone down by around 52% on a year-on-year basis. And if you look at the number of units booked, those have come in at just 78 units versus 228 units booked that we saw in Q4 of FY25. Collections are also down around 29% over the previous year, although rental revenue has gone up by around 74% over the previous year. Q4 was largely driven by sustenance sales for Oberoi Realty, and MK has also come out with a note on the stock saying that the weak performance in this quarter was due to a sluggish sales velocity at almost all of its projects. Except for the Worli project, operational performance in the residential business has been weak, and they've also highlighted that in Thane, out of the total 65% inventory is yet to be sold for Oberoi Realty. So reacting to this, the stock has been trading with cuts of almost 4%.
Deepak, we've not had too many real estate numbers coming through, but we've got one, Oberoi Realty. Your thoughts on what real estate is likely to do now? There is an inward focus. Domestic companies are being preferred over export-oriented. Is real estate one of them? And do you have a preference in terms of geography companies?
It's quite interesting because I think, you've had realty go crazy in terms of numbers in the last one or 2 years. I think there's some kind of moderation in some areas. We're seeing some moderation, probably Mumbai. I was surprised that Prestige was not already able to sell all its projects in Ghaziabad in a market where everything is pre-sold like years in advance. But maybe there is a supply thing. A lot of supply will come and get available in terms of secondaries in the middle of 2025 and 2026 because a lot of these projects were launched just about immediately after COVID. They're going to come to a point where those houses are available and the investment part of those houses will then be maybe available for sale, and that might bring down some of the demand towards the end of next year. But right now, I still think, there's a lot of demand for real estate. Housing loan rates will come down soon as banks would or have linked it to repo anyhow. So you should see some kind of an uptick in household personal loans. Household still, we posted a note today, 52% of all bank loans to individuals are still towards housing. So I think housing remains a very attractive thing for people to desire and want. So I think at some point that remains a macro kind of a positive. But in general, we've seen this. While you might see housing sales grow, in general, and housing prices don't come down, the real estate companies generally don't seem to announce that much in terms of profitability. They have cash flow issues, like they take all the profits they generate and buy land somewhere that kind of does nothing for 10 years. So they're not very good capital allocators in that sense. So we don't have a major amount of investment in real estate, very small pocket here. But we find that, they should be better capital allocators and then they can earn much better ROEs as well longer term.
Okay. All right. Deepak, we'll leave it on that note for this afternoon. Thanks very much. Always good talking to you. Have a good rest of the day. Well, we have to take a quick break, but before we take one, here's some good news coming in. This is Network 18, which has beaten Times Internet to become the #1 news publisher on ComScore. News 18 races past the Times of India to be the #1 news brand in the country. That's not all. Network 18 is the #1 digital network in the news and information category. As per ComScore report of March 2025, News18.com has 38% more users on native and social platforms than of the Times of India. As per ComScore report of March 25, Network 18 is way ahead of the Times Internet with over 55% more internet users and on native and on social platforms.
Okay, welcome back. You got the market, which is doing just fine, 20 points higher, 24,350 is where we are at. Dinshaw Irani is with us of Helios Mutual Fund. Dinshaw, good to have you with us here. Thanks very much for your time. If you look at WhatsApp groups, the stock market kinds or otherwise, there is only one topic which is being discussed, which is the India-Pakistan situation. And it's just some of them really, going into what can happen, simulations, this, that. The market here is just happily chugging along. We're up 20 points. What's your sense? I mean, there are some reports which came through which indicated that there are some operations being conducted, but within our borders, security operations, etc. Is the market taking this a little lightly, or does it have one wary eye on these developments? What's your sense?
So basically, Prashant, by the way, good afternoon to you and your viewers, and thank you for having me on your show. The fact is that everybody is right now betting on sanity prevailing on both sides, right? I mean, there's always, I mean, what is the reaction to this? Whatever actions we take, there has to be some reaction, but how limited are they will be the way to look out. In fact, the perfect one would be if the way it happened in Balakot, I assume, because Pakistan denied that anything had happened, right? So I think that's what the market is looking at, and I won't spend too much time on this also anyways. But the fact is that a couple of overhangs are over. I mean, obviously the India and Pakistan tension is the one which is a big overhang today. But the other overhangs like the tariff wars, I think some sanity is prevailing in the US. They've taken a 90-day pause. Probably till 9th of July, I think things are still on pause. So let's see what happens after that. So that was a breather for the market. One good thing was that I think the US President, Mr. Donald Trump, he really bowed down to the markets. And that's what is helping us believe that he'll come back with some sensible solution whenever this 90-day pause goes away. So that was one big overhang which was over. I think now from here on, one has to look at what's happening in India, what's happening with our markets, what's the fundamentals looking like. And frankly, I mean, they are feeling, I mean, the feeling is that the March quarter will again be nothing to write home about. I mean, the Nifty components which are reported thus far, they've seen a low single-digit kind of growth on a consolidated basis. There've been fair bit of disappointments. If I was just reading up a report that of the total numbers which have been reported thus far, some 60-70% have been disappointments as such. So that's not helping, right? I mean, the big rally which came about, I think, came on the back of one, relief, and secondly, the way the FIs came back in big numbers. I think that's what's helped, and from here on, one has to look at pure numbers.
But it said, I think the pace of earnings downgrades is, so far at least, is less than what we had in the prior quarter. So although we have seen, a lot of, downgrades, but it just seems that the pace has come down a tad bit. By the way, you should keep your eye on Trent, because Trent numbers are expected and the stock is moving up a little positively. Remember, Trent is a stock which has fallen 37% from its 52-week high. We already have a cheat sheet. The company has indicated in the pre-quarter update that the top line growth will be 28%, which analysts point out will be the lowest in 16 quarters, and FY25 revenue growth should be 39%. Pull up that intraday chart of Trent, a little bit of a spike. So Dinshaw, hi, afternoon. So what have you been doing in the last 1 month through this volatility?
Just let me get back to you on that downgrade numbers being less than what they were last time around, last quarter around. The fact is the first of the block reportage is normally strong corporates, right? So that's why you're not seeing those. And the fact is that these strong corporates also have seen downgrades happening, which is fairly a worrisome factor. Having said that, I mean, what we've been doing, however, because we were very worried about this tariff war going out of hand, and as a result, what we did was we did conserve a bit. We said let's look at only the domestic facing stocks, those which are not impacted by these kind of uncertainties in the global market. And that's what we try to do. And once again, if I remember right, on your last show, I told you that these are places to hide at that point in time, because if this uncertainty goes on for a while, it's a matter of a few quarters before they also get impacted. But fortunately for now, I think that's worked out fine for us. We've I think 80-85% of our stocks are, I mean, rather the sectors that we are in are BFSI, hospitality, hospitals, consumers. These are the few that we're in today.
Got that. There is a EV IPO which is on as we speak, which is Ether. But the other one, which has been listed for a while, which is OLA, is something that we reported on. And now this is source-based information. Sources tell CNBC-TV18 that SEBI is looking into the veracity of disclosures made by OLA Electric. Yash is here to tell us what this is about. Yash, take it away.
Well, that's correct, Prashant. So market regulator SEBI, looking into, as you said, the veracity of the disclosures made by OLA Electric on the exchanges. Now, SEBI action is linked to complaints regarding disclosures that OLA Electric has made. And to be specific, one particular disclosure which caught the market regulator's eye after certain investor complaints which were received by SEBI, that was the February 28th disclosure, where OLA had announced sale of 25,000 units for the month of February 2025, but government's portal, that is Vahan data, showed only 8,600 registrations. Market regulator SEBI, of course, has taken in account the move that came in the stock also after OLA, announced the number of 25,000 units for February 2025. SEBI is also looking at the clarification which OLA had provided when it comes to this particular main disclosure, which comes to the sale of electric two-wheeler units for February 2025. OLA had, of course, said that it is a straightforward case of temporary registration block and they are working towards streamlining it. That day itself, the stock was up 6%. Now, market regulator SEBI is looking into whether the investors are shortchanged because of this alleged wrongful disclosure made by OLA Electric on the exchanges. Apart from that, since SEBI is looking into the matter, it is also looking at many previous disclosures made by the company and looking at how authentic they turned out to be moving ahead. We've written to OLA Electric on this particular query, but we're yet to receive a reply from the company on this.
Okay, all right, got that. Yash, thanks very much for the update there. So for OLA, the going has been rough and tough for a while right now. Dinshaw, good to have you on the show this afternoon. Great conversation as always. Let's talk about this, the automotive space. Not that there are too many big numbers that are firing up. I mean, growth has been missing. Barring Mahindra and Mahindra, most others have been struggling. But in auto, would you like anything and any interest in some of these pure play EV stories that are now coming to the market?
So yeah, I mean, I don't know how many of you have seen this, but we are anchors in one of the anchors in Ather. And the fact was that with a value share of more than 20% and a market cap, asking market cap of $1 billion or dollars, that didn't make sense to us, actually. I think that was a fairly appealing, though we don't see much of profits going forward in Ather also. I mean, the way the Ola is doing also. So the fact is, it's a much more, I think, premium bike as compared to what Ola offers. That's the kind of call we took. And that's why we felt that this was a good EV play to enter as such, and probably the only EV play that we have today. We also have a two-wheeler play, which is disclosed in our portfolio, which is Bajaj. Basically, the fact is the entry-level vehicles is two-wheelers is what we're looking at, given the kind of SOPs the previous budget gave on the income tax front. So these are a few auto plays that we have. Otherwise, we don't have much exposure. As you know, that we are quite negative on a disruption in the auto space brought on by EVs as such. And that's why we're staying away.
So, Dinshaw, you're saying that you don't see even Ather, and thanks for telling us that it offers good perspective on, why you would take that anchor position. You're saying that you like the business, but you're not looking at too much of a rise in profitability immediately. Did I get you right?
So basically what I'm saying, Subhi, is that for overall market, I mean, if you're giving it, as I said, the value market share for Ather is 20% plus odd, right? We can keep disputing. Let's even assume 20%. The fact is that we cannot assume that the overall India market is going to be just $5 billion. I mean, the market cap of all EV plays in India is going to be $5 billion. And that's why we said that, look, it's a matter of time before the market cap in India of EV players moves beyond, say, $10-20 billion or more, in fact. And that's why we said that, okay, looks like it's come at a very decent price. And as I said, EV itself, I mean, the break even itself will take a while for Ather to play out in. But I think the valuations are fairly appealing given the growth rates that we're expecting from the industry.
All right. Hi, Dinshaw. Good afternoon. Good to see you in. What about the quick commerce space? It's making our lives easier, but the competition is getting a little bit more intense in there. You all are quite positive. What's the view?
So basically what we did, Nigel, was we used to own both the quick commerce listed players, right? We got out of one because we didn't like their strategy of fighting discounts with discounts. We remained with the bigger player, if you will, which is eternal. I mean, the Zomato was well, Zomato as such, and we remained with that. Again, I mean, even if there is competition building in, the fact is you need to get the logistics right. You need to get the algos right in this business. It's not just about setting up dark stores. If that was the case, there would be a lot of all the big corporates in our country would have come and swarmed the place with these kind of logistics businesses as such. Doesn't work that way. I think it's a winner-take-all kind of a market. I mean, we've seen that in the case of say Meituan in China, or for that matter, DoorDash in US. So I think that's where we're coming from, and I believe that there's enough potential left in this industry to see healthy growth, even with some competition coming in.
All right, just one word. The state cabinet, Maharashtra state cabinet, has approved the EV policy, and the word that we have is passenger EVs will be given bigger subsidies, and that's why a couple of stocks are in focus, as our ticker team was telling us. Tata Motors as well as Mahindra & Mahindra, because they have exposure to passenger vehicle EVs. So just wanted to highlight that for our viewers as well. At the bottom of your screen, we'll try to get you further details. But for the time being, Tata Motors seems to be one, and Mahindra & Mahindra. Guys, back to the studio.
No, absolutely, and we'll keep an eye out on this one as we kind of parse through some of the details about what has really been approved. Then sure, we'll thank you here. Appreciate your time here on CNBC TV18, and look forward to the next conversation. So some more details. The new EV policy, passenger EV will be given bigger subsidies. And so on and so forth. By the way, our colleague Shireen caught up with the Maharashtra Chief Minister Devendra Fadnavis yesterday, and he did sort of allude to the Maharashtra EV policy, and we probably should be able to play out some sound bites on this a bit from now. But this is essentially what is coming through. Some categories of EVs will be waived from toll payments. So this is looking like, I mean, there is a bit of a boost which is coming through. EV manufacturing and consumption and charging infra will be boosted. So some of the stuff which is actually coming through at this point. We'll take a break. We're back. Some short-term trading ideas with our technical experts and more in terms of fundamentals and stocks on the other side.
It's actually been just 6 years that you started this company. You've been able to do what? More than $2 billion in revenue already?
We got a lot more no's around that time. And the no's were less about people not liking us or the idea. But they were just not comfortable around that there was no comparison.
Starting up wasn't an idea that the two of you talked about when you were in college together. I mean, it wasn't something that you considered doing, I would imagine, at IIT.
For me, the aha moment was just us deciding that we are going to do something together. And what exactly that is, that actually came second. If I had not started up with Srinath, I probably would not have started up.
So if he hadn't made the call, would you have thought about it?
I was pretty comfortable back in 2017-18. I was not giving this serious a thought. When he proposed, I couldn't say no.
Welcome back. You're tuned into Closing Bell. You're on CNBC TV18. Well, the markets are holding more or less flattish as we speak. And I think we can hop across actually to Prashant. I think he's got an interesting piece that he's going to be putting forth on gold prices and how they've evolved. Prashant, take it away.
Let's take you into a global financial story that's unfolding quietly but powerfully. A new gold rush 2.0, led not by consumers or investors, but by central banks. Why are the world's top and most powerful monetary authorities holding gold at record levels? Let's break it down. Let's look at the pace of the rise in gold prices to begin with. Now, the rise in gold prices is not new, but the tempo has shifted. After the US abandoned the gold standard in 1971, it took nearly 38 years for gold prices to hit a $1,000 mark, a milestone finally reached in March of 2008 during the global financial crisis. The next leap was quicker. Gold doubled to $2,000 in 2020, August 2020, fueled by the economic uncertainty of the COVID-19 pandemic. That took 12 years. But the pace has since accelerated dramatically. On March 14, 2025, this year, spot gold prices broke through the $3,000 barrier for the first time. The climb now for the last $500, $25 to $3,000, took just 210 days, a stark contrast to the previous $500 increments, which historically averaged more than 1,700 days. Now, gold's rise is no longer gradual, it's gathering speed. Now, the analysts at JP Morgan have divided the gold era, modern gold era, into three regimes, three periods. Let me put this out. First, as a pure inflation hedge from 1970s to 1990, then as a mirror against real US bond yields, 2000 to 2021, and now a geopolitical safe haven driven by central banks pivoting away from the US dollar. And of course, I mean, you could add a fourth one. There is Trump driving an American breakup from the rest of the world. Let's take it one by one. The first era, in the 1970s and 80s, gold was all about inflation. When inflation expectations surged, and they surged to 8% in the early 1980s, gold prices exploded eightfold. But once Paul Volcker, the then Fed chair, crushed inflation with aggressive rate increases, gold prices collapsed. Now, from 2000 to 2021, this is the second era, the second regime, survey-based 10-year inflation expectations remained largely anchored between 2 to 2.5%, while real gold prices increased significantly. Now, this was a new dynamic, a newer relationship. Now, the relationship between gold and US treasuries is rooted in the competition between two so-called risk-free assets. Gold, which offers no yield, becomes less attractive when real yields on longer-dated US treasuries rise because the opportunity cost of holding gold increases. Conversely, when real treasury yields fall, gold becomes more appealing, more valuable as a store of value. In the 2 decades starting 2000, gold consistently showed a strong opposite inverse relationship with a 10-year US real treasury yield. And this is the third stage then, the rupture. In 2022, US and its allies froze $300 billion of Russia's foreign reserves. This shocked the world. Suddenly, holding dollars or euros or other currencies, paper currency, wasn't just about economics. It carried geopolitical risk. Since then, central banks have turned into super buyers of gold. Price insensitive. Price matters little. Securities matters a whole lot more. Adding to this, the US under Trump 2.0 has moved towards isolation, America first foreign policy, pulling back from alliances like NATO, the United Nations, the World Trade Organization, and of course, as I described earlier, weaponizing sanctions as well. This has reinforced the instinct amongst many nations to diversify their reserves, and gold is the fallback. The result, a historic buying spree surge. Central banks used to buy around $400 tons of gold per year. In 2022, they bought more than 1,080 tons, the highest on record then, and they kept going. 1,051 tons in 2023, another 1,045 tons in 2024, and this year, 2025, has started no differently. Today, central banks collectively own around 36,000 tons of gold, nearly 18% of the total reserves. That's a sharp jump higher from 15% just a year ago. I mean, 3%, right? But it's happening at the highest levels of global finance. It's meaningful, it's chunky. Meanwhile, you can ask the question, is supply of gold keeping pace? The answer is no. Mining output has been flat since 2018, constrained by falling ore grades, rising extraction costs, and stricter environmental regulations as well. In short, you got demand which is strong, central banks are big buyers, supply is constrained as well. I mean, just a factoid, right? I mean, interesting factoid, just to remind us that gold is rare and that scarcity drives value as well. If you look at all the gold which has been mined through human history, it's about 2 lakh tons. It's enough to cover a soccer field, but only to a depth of 1 meter. And most of that gold is with us right now. To conclude, what we are witnessing is a true gold rush 2.0, not fueled by just inflation, fiscal deficits, paper currency debasement, etc., but by geopolitics, trust and fear. In a world where financial assets can be frozen overnight, gold once again is the ultimate fallback.
Okay, very, very interesting analysis. The gold rush is on, and by some estimates, this is only the beginning of it. When these moves start, they last for a long, long time. And by some technical estimates, this is probably just the first phase of the gold rush. All right, after that really interesting take from Prashant, let's quickly move on back to the markets, equities that is. It's been a quiet afternoon. Let's take stock of where things are. Absolutely flat. Nifty is just about 12 points down. Midcap index, 0.25% up. Mitesh, final advice now, any trades, index, stocks, what would you do?
I think the index is slightly coming off, so maybe, we'll take one HTVT call, that's Apollo Hospital. Keep a stop just about levels of 70.20 and 69.30, 69.40 kind of a target to look at. And the other hand, TI India is buy on VTSC kind of a trade. Keep a stop at 27.79 and a target of 28.30, 40 for tomorrow.
Okay, all right. Thanks a lot for that, Mitesh. Well, let's welcome Jay Bala of Cash the Chaos on the show. Hi, Jay. Good afternoon. How are you feeling about the markets? We're talking about geopolitical risk on the borders. We have Trump's tariffs as well. The bulls are having none of it. And who's come out to bat? The big boy, Reliance Industries. That's the one that's doing heavy lifting. We're good for more? Or do you think this is the pop that you would like to short into?
Hi, Nigel. As I pointed out last week, the markets have bullish potential. And although the bear case hasn't been eliminated, but I'm leaning more towards the bullish potential for the markets. The fact that Reliance was a problem pocket until a week or 10 days ago, and Reliance is firing, is a very good positive for the bulls. And the nearest resistance for Reliance comes about 14.21. If it does manage to take out that, it'll probably coincide with the Nifty level of 24,858. And if Nifty clears 24,858, the hedges we have been advocating for the bullish case or the bearish case, hedges can be taken off. The market's where to clear 24,858 on the Nifty, because that, for me, will be all clear for the bulls.
Okay, Trent's numbers are up for you on your screen. The company's reported a profit of 354 crore. I have what they did in Q3, which is 496. So quarter on quarter, there is a drop, but typically Q3 is your seasonally strong quarter and you see better numbers. So 300 and I think 54 is what the company's reported in terms of the bottom line. But in the revenue, the company's done well, and on margins, the company has beaten street expectations. So the company's top line growth has come in at 28.8%, which is in line with the cheat sheet. They had indicated that it would be a 28% kind of a top line growth, but margins have come in ahead of expectations. The company's EBITDA is at 16%, ahead of the CNBC-TV18 poll of 13%, an expansion compared to the 14.2% that it clocked in the prior quarter, though lower compared to it on a Q3. But quarter on quarter, you will see a drop. But Trent's numbers have beaten street expectations, and considering the fall that we've seen in the stock price, 37% off from its 52-week high, you are seeing some buying emerge. So Trent stock share price is up close to about 3%. Jack, quick word on the technicals of Trent.
Yeah, if Trent manages to take out 5,400 on an intraday basis or 5,376 on a closing basis, that will probably signal a potential for a bottoms for the stock. It's had a deep correction from 8,200 to 4,500. So I think slightly positive for the moment, but right now it's a no man's land.
Out of these, Jay, out of these Mazgaon, Garden Reach, HAL, Cochin, BEL, Paras Defense, BDL, anything strikes out? All defense.
Yeah, if you recall from our conversations in November, Prashant, I had said Cochin Shipyard has completed a top, whereas when it comes to Masgowan and I think it was Garden Reach, I had mentioned that those two are due for fresh record highs. Those are the Masgowan's pre-split support level is about 3,800 to 4,000. So now it's bottoming from the post-split price, and it's come to record highs. So very close to record highs, and possibly has taken it out on an intraday basis. So I'm bullish on Masgo Dock, but it's a bit late now. And I've remained bullish since November, even during the correction. So, at that point, it was a bit surprising what Masgo was doing. But right now, it's interesting for a lot of people. So bullish on these different names, but not overly bullish because it's a bit late. We should have been bullish in November, December.
Okay, all right. We'll take a quick commercial break here. Just stay with us. 8 minutes to go for close. But before we slip into that break, here's some good news. Network 18 has beaten Times Internet to become the #1 news publisher on ComScore. News 18 has raced past the Times of India to be the #1 news brand in the country at the Social Plus on Platform Leadership Network level. And yet, Network 18 is the runaway leader as per the Social Plus MMX ComScore report for March 2025 with 315 million unique views, which is 55% more than the nearest competitor, which is the Times Internet at 202 million. News 18 also races ahead of Times of India in terms of Social Plus MMX cumulative reach. News18.com overall clocked 251 million unique views to beat the Times of India overall, which had 183 million unique views as per the ComScore report for March 2025. And this is per ComScore social media metrics report. Network 18 is 2 times bigger than the nearest competitor with a 50% reach within the 389 million overall social population. And speaking about Indian languages in terms of Social Plus MMX cumulative reach, News 18 Indian languages is the leader in the category with the 182 million unique views as per the ComScore report for March 2025.
Just a few minutes left before we close for the day. It's going to be a quiet session of consolidation. In conversation with Jay Bala. Jay, U.S. markets have, it seems that the worst may be behind. The storm has settled down. What is the price action telling you, and what are the implications? Or has India completely decoupled?
Decoupling is a theory that exists only in theory. I would rather not comment about it. The market's evidence have never provided proof that decoupling is a sound concept. So when it comes to the U.S. markets, the April 7th low, there's a possibility that completed a deep correction for the U.S. equity markets. 4661 on the Dow Jones Industrial Average is very crucial. If that were to get printed, we can conclude that the U.S. markets have had a deep correction. Until that point, there is still possibilities that the markets could see one more low below April 7th. But if this is the bull case, the markets needs to do some more work on the higher side. So slightly bullish, but is neutral to bullish on the U.S. equity markets.
Jay, any thoughts on gold from here?
Yeah, I have against the grain opinion on gold. The trailing stops for me is 32.60 on gold. Until that point, the longs sustain, but the sentiment is quite high. Very similar to the 2011 sentiment extremes that we saw when the markets were heading higher. If we see gold, the London bullion drop below 31.53, not futures, London bullion drop below 31.53, that will mark a significant top and or indicate that it's registered a significant top at recent highs of 3,500 and possibly signal a deep correction to 2,600, if not deeper.
You've got some stock ideas, Optimus, Infracom and Sun Pharma.
Sun Pharma broke out of an inverse head and shoulders pattern yesterday, Rima. And so I'm bullish on it with a stop loss of 1618, probably headed to all-time highs, somewhere about 2,200. It's a rough estimate. And when it comes to Optimus Infracom, the stock has had a sizable correction from its 2024 peak. And the move on a weekly time frame seems to be a corrective decline. So if the stock can hold 377, once again, this stock has a medium-term bullish potential. The resistance comes at about 700 immediately. Later on, if 700 gets taken out, probably look at all-time highs for the stock.
Just stay on. We'll come back to you in just a bit. Let me just quickly wrap out things here. The Nifty's got nothing on it, absolutely unchanged. So blinking red and green, 24,326. So nothing on it from yesterday's close. The Nifty Bank also slightly lower. I mean, actually down about 0.25%. So that's about 150 points lower on the Nifty Bank. Mid and small caps, much better. You got some green on both those indices. And market breadth, actually, at least from my screen, it's almost 1:1, slightly tilted in terms of what was down, just the number of stocks up and down today. So that's the overall picture. But of course, Rima, the sector of the day really, defense.
Indeed, BL up nearly 4%, but Trent overtook it in the end after the margin beat. Q4 margins at 16% ahead of expectations, and the stock surged 5.5%. So Trent goes home as the top gainer of the day. Reliance Industries had a big move, 2% up. This is on top of the near 4% gain that we had yesterday, 5% gain on Reliance Industries yesterday. So Reliance Industries was a big mover. IT made a comeback. TCS, HCL Tech, Infosys in the green. On the way down, TVS Motors was under pressure. Some softness visible in pharmaceutical names like Sun Pharma, Dr. Reddy's, both these stocks ending with a cut of about 2%. And UltraTech Cement, where the numbers were in line, but the commentary in the conference call was a bit subdued. UltraTech came in for profit booking. That brings us to a close and closing bell, but don't go anywhere. Markets Forward comes up next.
Market ends in the green in range-bound session. The Nifty fails to hold on to the open level gains of around 24,450. We end around the 24,300 mark. Sensex closes at around 80,200. The Nifty IT holds ground while metals as well as pharma slide in trade.
Defense stocks perk up in trade amidst hope that India might increase the defense spending due to the ongoing India-Pakistan tensions. Paris defense data patterns surge over 12% each.
Reliance Industries extends gains for the second day in a row after the Q4 numbers. The stock hits a 4-month high in trade. Meanwhile, PNB Housing was up close to around 4%, posted solid showing in Q4 numbers and positive commentary from brokerage. Oberoi Realty, though, was another stock in focus after it dipped close to around 4% owing to its weak showing in Q4. Hello and welcome to a fresh edition of Markets Forward, your go-to show where we get you up to speed with today's trading action and set you up for tomorrow as well. I'm Nigel, with me is Rima. Well, Rima, another flattish trading session, but plenty of stocks did a thing of their own.
Oh, indeed. Flat on the benchmark indices. The Nifty held on to 24,300. But look at the way Trent rallied in the dying moments of trade post the Q4 numbers. Margin beat, stock up 5.5%. Reliance Industries strong for the second day in a row. The two-day rally on Reliance Industries is now about 7.5%. On the way down, you had TVS Motors, Ultratech Cement correcting post the conference call. So the screen was buzzing. Even though the index was very flat.
Well, that's right, Rima. But I think the problem is that the Nifty Bank is unable to conquer that 56,000 odd mark. Even in today's trading session, the Nifty Bank started off strong, but it's unable to get past that 56,000 odd mark, which is the important level the bulls will be tracking. Since Reliance has taken over the leadership, you'll want the Nifty Bank at least to consolidate, with a bit of a positive bias. But in today's trade, for the third time in the last 7 trading sessions, the Nifty Bank rejected that 56,000 mark.
Okay, that was a relative underperformer today. Here's a lineup of what we have for you on our show today. Top movers and shakers always. Hormus will be joining in. Defense stocks buzzing in trade. Big moves. Trent reported a good set of numbers. Stocks surged. And Reliance Industries continues to outperform. We'll break down what fueled these up moves. And as always, we'll leave you with the market events to watch in tomorrow's trade. So you're all prepped up for tomorrow.
All right, well, to our first segment then, Hormus is standing by on the big wall to tell us all the movers and shakers of the day. Hormus, over to you.
Plenty of earnings reactions, right? But before we get to that, it is one sector that continues from where it left off yesterday was the defense space. And take a look at these moves. Paras Defense, a 20% move. Garden Reach up 12. Masgaon Dock hitting an all-time high in today's session. A sharp recovery from its 52-week lows, another 9% in today's session. So defense continuing to pack a punch in today's session as well. Now we move to the earnings reactions, and of course can't not talk of Trent just a few minutes before market close and 5.5% higher after a very strong operational beat that came in for the quarter. Earnings reactions also coming in from India Cements and not so good reactions from Go Digit down 6%, and of course TVS Motors on some cautious management commentary. A lot of block deals took place today at the start of the trade. Tata Tech was down 6% after those deals, and Sami Hotels, though, on the flip side gained 4% after the block deal that took place there. Prestige Estates on the back of a positive brokerage note. CLSA seeing an almost 80% upside on the stock, and Whirlpool continuing to move higher, up almost 30% now this month. IT was one sector that kept the gains afloat as well, barring Reliance Industries as well, and Tech Mahindra, LTI, Mindtree, almost large cap, mid cap, all of them saw healthy gains in today's session. And lastly, of course, I just spoke of Reliance Industries. That continues to build on to yesterday's gains and has added almost 1.5 lakh crore in market cap in 2 trading sessions. So great going for the big boy, ensured that the Nifty downside was capped in today's session. Back to you.
Okay, all right, Hormus, thanks for that. Well, those are all the top stock movers. Let's go across to our guests. We have Jay Bala of CashTheChaos.com who joins us on the show, and Sudeep Bandyopadhyay, the group chairman at IndiTrade. Hi, gentlemen. Thanks a lot for joining in. Well, Jay, you go first. Tell us about the Nifty Bank first. That was the one that actually led the markets higher. Then in the past week or so, it's seen some resistance at around that 56,000 odd mark. However, it held on to the 54,000 mark, the one time that it went ahead and tested it earlier this week. Your take?
Yeah, see, I've been pointing out new highs potential for ICICI Bank and HDFC Bank, but the problem, the reason why Nifty Bank is struggling at around the 56,000 mark is because of the long-term trend line that connects from the 2004 highs that runs through the GFC highs of 2008 is coming around this level of 56,000. So the markets can either back off a little bit and then go to a little bit higher. The projections for the Nifty Bank is about 58,500. And for that, HDFC Bank should not drop into the previous range of about 18,800. If it does that, the banking index can face a bit of a problem. So even for the bull case that I have for the market, so the market could be heading for 29,000 on the Nifty from a, say, 12 months perspective. That will also be put under pressure if HDFC Bank were to drop into the previous range of 18,800. So banking index holds the key at this point of at this juncture in the market, and HDFC Bank and ICICI Bank are the keys within that.
Okay, let's talk about the big macro development, because RBI announced a mega liquidity infusion of 1.25 lakh crore rupees through the open market bond purchases. Experts feel this liquidity infusion may be intended for faster transmission of rate cuts. Lata is here to decode this. Lata.
The Reserve Bank is going to buy 1.25 lakh crore of bonds in 4 tranches from May 6 to May 19. Announcement came late on Monday, surprised the market because already the interbank market has excess liquidity of over 1 lakh crore, and which is why the one-day money, what you call the call rate, is trading below the repo rate because there's excess money. The market has 2 sets of guesses why the Reserve Bank would put more money when there is already money in the system. One is it could be because of the FX positions of the Reserve Bank. They had entered into a lot of buy-sell swaps. The sell leg would be maturing now. The data we have is that as of February, they had $80 billion of sell positions. Maybe 30 to 40 billion is maturing now in April and May. And that's why they're standing prepared with extra liquidity, because when the RBI sells the dollars for the maturity, it pulls back rupees and it may take away rupees. The other guess is that no, there is enough dollars coming in from FPI bond and equity funds to meet that RBI sell. This is because the Reserve Bank is calculating for the year as a whole, the shortfall or the liquidity withdrawal would be to the tune of 4 lakh crore. This is how the math is being worked. Cash withdrawal is always there by you and me during festival season. That is about 2 lakh crore over the year. And another 1 lakh crore is set aside by banks for cash reserve ratio. You know, what is cash reserve ratio? Every time you make a deposit, 4% should be kept as cash. That would take away 1 lakh crore. The other 1 lakh crore is Reserve Bank owns bonds which mature this year. When the bonds mature, the bonds are returned and money comes from the government to the Reserve Bank. So that is liquidity withdrawal. To replenish that, part of this is coming as 1.25 lakh crore. Whatever be the prodding, the impact is that bond yields have fallen by about 7 to 8 basis points today, from 6.4 plus to 6.3334. And banks and bond NBFCs are having a very good day. And that's because the rate cut transmission is expected to happen very quickly when there is good liquidity.
Okay, all right. Got that, Lata. Thanks a lot for that. Well, Jay, coming back to you, we'll get in Vinny now to help us out with the Trent's numbers. And the stock did perk up towards the end of trade. But on the charts, how's it looking? This was a stock that was at around 8,500. It corrected around 4,500 odd, and now it's hovering in that 5,500 odd band. Your take?
Yeah, I had commented just before the stock spiked up that if it were to cross 5,400 on the intraday basis, I think it's put in a bottom. So the fact that it closed at 54.95 pre-adjusted price, I think some sort of bottom is in for the stock. And although it's put in a bottom, a pullback would be healthier from here on. But I think the correction it saw from 82.50 to 4,500 is possibly a medium term correction. And the nearest resistance for the stock is about 57.80. I think once that's taken out, I think we are looking at a resumption of the uptrend for the stock.
Okay, the first level to watch is 57.80. But let's talk about the numbers, the Q4 numbers, the margin beat. Vinny's here to take us through it.
Hi Rima, so yes, absolutely, we are seeing a good set of numbers that's coming from the company. Q4 update surely was given, so we knew that there was going to be around a 28% revenue growth, and that is what came in this time as well. 28% revenue growth, revenues at around 4,106 crores. Now margins of the company, that's where we are seeing a beat coming in, a strong operational beat on that front as well. So margins came in at 16% versus the CNBC-TV18 poll that was at around 13%, and overall comparing on a year-on-year basis as well, it's a 100 basis point expansion in terms of margins. The other income, that's seen a growth of around 32-33% as well, coming in at 97 crores. And overall profitability of the company, that has also seen an improvement. But when you compare it, but though you cannot compare profits YOY because last time there was a one-off that was there. So yes, profits are seeing an improvement or supported by the other income is what we're highlighting. And so good numbers that have come in from Trent this time. Do not forget that, Trent was down almost 37% odd from its 52-week high, and then just after the numbers, we've seen the spike up coming in for the stock, up almost 5% at the end of the day.
Thank you very much for that. Sudeep, a quick word on, Trent. Is this a stock that you like? It's corrected a lot.
I do like the stock, but I probably will still not buy at current levels because, when it corrected, there were a lot of challenges and people were pointing out that Zudio is getting more and more competition. And one has to see whether the kind of charm Zudio had around it will be maintained or not. We have to understand when the commentary comes as far as same-store sales growth and things like that, and their plan for store growth for the next fiscal. I will wait and watch those figures before I take a call on whether to buy at current levels or not. Look, valuation wise, it is not cheap. So one has to be a little careful. And if you compare with, let's say, Aditya Birla Fashions and some other peer, not very exactly, but peer group companies, I think it is an expensive stock. While the performance is fabulous, I'll wait and watch.
Let's talk about Reliance Industries. Clearly, the stock of the day resurgence seen in the stock up 8%. In the last two trading sessions, it's added 1.5 lakh crore to its market cap, and the market cap now stands at 19 lakh crore rupees. That said, the stock is still down 12% from its 52-week high. Some factors: one, the stock hadn't moved in the last 3 years. In the last 3 years, the gain in the stock price was just 1%. So a prolonged period of, consolidation seen. Two, in terms of valuation, you look at it on an SOTP basis, but individually. Now, retail, which did well, is priced at a discount to peers like Trent, Avenue Supermart. If you look at the Geo business, Reliance Industries share price has underperformed Bharti by nearly 40%. So many believe the sum of parts is much greater than the current value. Also, the stock was under pressure as the FIs were selling stake in India, selling their holdings in India. Now that the FIs are making a comeback, will Reliance Industries be a beneficiary of that? And there are lots of triggers. The big one, of course, is monetization, demerger of their individual business, eventual listing of, say, Geo, the retail business, which is now a behemoth. But then there are others. So, for instance, the retail business is accelerating. New energy, can it be a growth driver? The company's, plans are unfolding in new energy. It's turned free cash flow positive for the first time in many years. So the big trigger will be monetization and eventual IPO. But that said, analysts did like the numbers a lot. They said it was a fantastic set of numbers, and the stock is seeing buying after a prolonged period of consolidation.
Okay, all right. Thanks a lot for that, Rima. Well, that's clearly been the one that's been leading the market over the last few sessions. Defense stocks, they as well were in focus. They surged in trade amidst the ongoing India-Pakistan tensions. Paras Defense as well as Data Patterns, both of them were up more than 10% in trade. Ria joins us to turn us through the key triggers out here. Ria?
Well, yes, both defense and shipbuilding stocks have been in focus today. So let's take a look at the positive triggers for these sectors. First up, the rising geopolitical tensions and higher budgetary allocations in countries like Europe are indicating higher defense spends going ahead. A possible escalation in India between India and Pakistan can also spell higher defense spends going ahead. As per reports, the Expenditure Finance Committee has cleared the rupees 25,000 crore Maritime Development Fund, and they've also cleared the shipbuilding financial assistance policy, which is leading adding to the buzz in shipbuilding stocks today. Now, overall, India aims to increase its defense spends to 4% of GDP by 2047 from the current 1.9% of GDP. Remember, yesterday, India also inked a rupees 63,000 crore deal with France for the procurement of 26 Rafale marine aircrafts. And India also plans to construct 3 Scorpion-class submarines under Project 75, which will be in collaboration with Mazagon Dock and France's naval group. As of 2024, India is also the 4th largest defense spender in the world, and it aims to become the 3rd largest defense spender globally by 2047, following the US and China. And India is also going to boost its defense exports to rupees 1.5 trillion by 2047 from the current rupees 23,600 odd crores. In terms of valuations, most of these defense stocks are still trading between 15 to 45% lower than their 52-week highs, despite the recent rally that we've seen in some of these defense names. And the only exceptions include Mazagon Dock and BEL, which are trading near their respective 52-week highs. In terms of valuations, 10 stocks out of the defense pack that we've taken a look at, 10 stocks are still trading above their 3-year average PE, and only 3 are trading below their 3-year average PE. Today, we've seen stocks like Mazagon Dock, GRSE and Cochin Ship trading between 7 to 14% higher. Paras Defense and Data Patterns are also trading 12 to 13% up, and other defense stocks are also trading 2 to 5% higher in today's session.
All right, thanks for that, Riya. Well, Sudeep, what are you making of this entire defense stock melt up? Some of these stocks, they saw a sharp correction. Everyone's ruled them out, but look at the comeback. Defense stocks on the offense. Tell us more.
Well, of course, I think the geopolitical situation did help quite a bit. The way things have shaped up all around us, including the India-Pakistan geopolitical tension, I think defense stocks are rejoicing. Of course, there were definitely merit in the kind of valuations after the meltdown. And even at this stage, I've been liking the defense electronics space quite a bit. And I still believe that BEL at current level, in spite of the upward movement which we have seen in the recent past, merits consideration from a portfolio point of view. I also like the shipyard stocks because globally there is a significant demand for shipyards, and I think the shipbuilding will get a lot of emphasis going forward. Valuation is definitely not cheap, but somebody looking from a long-term perspective, I think even the shipyards do merit attention.
Sudeep, I think you like Reliance Industries, right? That's a stock. Yeah. Do you think it can outperform at least in 2025? It's still down 13% from its 52-week high.
Rima, absolutely. I think, you were mentioning 3 years it has underperformed. And now the time has come for it to outperform. The numbers were fantastic. Of course, there is significant scope for ARPU growth in the geo business. Retail, I think a lot of restructuring, a lot of cutting the flap they have done. And we definitely expect the margins to improve significantly, because if you consider the other competitors, the margins are significantly higher. Reliance is now focusing on margin in retail, and that's definitely good news. New energy, there are a lot of interesting things happening. And of course, the value unlocking story is definitely going to unfold sooner than later.
Okay, all right. Well, let's get Jay into this discussion. Jay, give us a couple of levels. Dollar index continues to break down, and that's a big macro factor that we're tracking. Also, if you look at Brent crude prices, it's holding around $65, $66 per barrel mark, which is not too bad. What's the outlook on both these two?
Yeah, dollar index, the medium-term target is about 96, 95.5, and I'm anticipating a short-term bump up to about 104. 103 to 104, and then pull back to 96, 95.5, and complete a medium to long-term move for the dollar index. When it comes to Brent, there are two possibilities. Either it's already bottomed at the recent low that registered in April, or we have a sequence of one more lower low pending for Brent to come through. That takes it to 48 and clocks a medium to a long-term bottom for Brent. So the jury is still out there which way Brent is heading, but but whereas when it comes to the dollar index, again a little more downsides after a very short-term upsides to work with.
Gentlemen, thank you very much for joining us on this show. It's time for a short break. We'll come back with the top corporate voices and the key market events to watch. Welcome back. IT had a good day today and we spoke with a lot of IT management. So in the corporate voices, let me start with Hexaware. Now, Hexaware decided not to give an annual guidance, but they did say that they expect Q2 to be a good quarter, Q3 to be a great quarter, and they're projecting growth even in Q4. While the banking vertical saw a sharp decline in Q4, they said it's on account of one-offs. The outlook for banking remains strong. The company, in fact, said it's even possible that they will see a double-digit sequential growth in the banking vertical in the next quarter, with the vertical likely to outperform the company growth average for the full year. KPIT Tech also had a good day today. Again, KPIT Tech too refrained from issuing an annual guiding, citing the ongoing uncertainty, but they did say that H1 is likely to remain soft and they will reconsider reinstating the guidance once the uncertainty stabilizes or settles down. So while they're not offering any official guidance, they did indicate that the business is perhaps geared for a medium-term revenue growth of around 20%, excluding any global disruptions. They're also placing long-term bets on China, calling it a key strategic market where they plan to build a strong organizational presence. And last but not the least, CSB Bank expects growth in the range of 20 to 25% for FY26. NIMs are expected to bounce back to 4%, following a decline in the fourth quarter due to higher costs from foreign borrowing.
All right, and before we wrap, let's get you all the key market events that you need to track. Upasana is joining in to run us through that list. Upasana?
Well, tomorrow marks an important event in terms of global macros. First up, let me start with US. US will be reporting its Q1 GDP numbers, also ADP non-farm employment change data. Europe will be also reporting its Q1 GDP numbers, and China will be reporting its Caixin manufacturing PMI data. Coming to Japan now, Bank of Japan will be holding a meeting from 30th April to 1st of May and even releasing its industrial output data for the month of March. Now let us look at a few stocks that will be in focus on the back of corporate action. Indus Tower will be in focus as board meeting is scheduled to consider viable option and strategies for enhancing shareholder returns, that is via buyback, bonus or dividend. Also, let us look at the important list of results tomorrow, that is Adani Power, Bandhan Bank, Coromandel International, Equitas Small Finance Bank, Exide Industries, Federal Bank, and the most important, that is IOC and Vedanta. These two companies will be reporting their numbers. Now, Ather Energy IPO also closes for subscription tomorrow. And now, let us look at the other events. PM Modi to chair second Cabinet Committee on Security meeting tomorrow after the Pahalgam attack. And also, Ministry of Statistics and Program Implementation will be releasing its private corporate sector capex data tomorrow. So all in all, looks like quite an eventful day tomorrow.
Indeed, action-packed before we get into the holiday on 1st of May. Thank you very much for that. That brings us to a close in this edition of Markets Forward. We'll be back with more news and updates. Don't go anywhere.
Hello and welcome to Business 360. I'm Shireen Bhan. The headlines that we're tracking for you this evening. The Sensex and the Nifty end a range-bound session with marginal gains. The rupee weakens by 23 paise against the dollar after briefly hitting its highest level in 2025 so far. China's foreign minister calls on nations to stand up to President Trump's tariff, says compromise will make the bully want to push his luck more. Reports suggest the Trump administration could provide some relief for US automakers from the impact of tariffs. Europe's largest lender, HSBC, beats estimates with quarterly profits of over $9 billion. Deutsche Bank also beats estimates with profits topping $2 billion. The deputy CEO at IndusInd Bank, Arun Khurana, steps down, takes responsibility for the lapses in derivatives accounting, which led to a loss of nearly 2,000 crore rupees. CNBC-TV18 reported last week the bank is likely to see the exit of senior leaders. Market regulator SEBI is looking at whether investors were shortchanged due to alleged wrongful disclosures by OLA Electric. OLA announced sales of 25,000 units in February, but the government portal showed only 8,600 registrations. OLA called it a straightforward case of temporary registration backlog. Pakistan violates ceasefire for the fifth straight day, says the Indian Army. Counter-terror operations underway across the valley as the hunt for Pahalgam attack suspects continue. India shuts down 48 tourist destinations in J&K to tighten security. The Supreme Court asks what is wrong if the government uses a spyware in the Pegasus case. Asserts national security cannot be compromised. The apex court agrees to examine if private citizens were hacked and if the final findings of a court-appointed expert committee should be disclosed.
President Trump is trying to break us so that America can own us. That will never, ever happen.
Canada's Liberal Party, led by Mark Carney, secures a historic election victory. The former central bank governor calls for unity in the face of threats by US President Donald Trump. Let's go straight to the day's market action. The Lal Street closing the day flat. It was a range-bound session today, but the Nifty did hold on to the 24,300 mark. Reliance continued to be the big contributor to the Nifty's upside for the second day in a row. Reliance added a market cap of 1.5 lakh crore rupees in two sessions, posting its biggest two-day gain in 4 years. The Nifty Bank ended in the red, while mid-caps outperformed the blue chips. Prashant is standing by with the trading action. Prashant, closing in the green for our markets broadly. What are the cues you're picking up on?
Not a bad day. The market, of course, closing absolutely flat. But we've had very strong days. Monday, for example, which is yesterday, it was a complete reversal of Friday's sell-off. And this morning, we woke up to flatter Wall Street cues as well. So neither here nor there. Market breadth overall, if you look at the advance decline ratio, pretty mixed as well. Actually, almost on an even keel. Nifty Bank will come up on your screen. Again, very, very strong performance recently. Mid-cap and small-cap indices up on your screen as well. I'll start with what was up on the Nifty first. Tech Mahindra, Reliance Industries has woken up back to about 1,400 plus. HCL Tech, Tata Communications were some of the other large Nifty names which did well. On the downside, Sun Pharma, ONGC and Dr. Reddy's were stocks which lost out. Defense was the space which really charged ahead. The Nifty Defense Index ending 5% plus higher. And just look at the number of stocks which did well, right? A Nifty name out of this pack, BEL, really top of the board. Mazgaon Dog, Garden Reach Shipbuilders, Cochin Shipyard, the shipbuilders doing very well. HAL, related to Air Force and planes, data patterns, Paras Defense, Bharat Dynamics, BEML, even something like a Shipping Corporation of India charging up. PNB Housing saw a breakout, strong move today. Whirlpool, Indian Cements and TBO Tech, which has been completely bombed out, saw some volume-led activity. On the downside, Tata Technologies was the big volume-led loser, 6% lost on it. The erstwhile Adani Wilmar stock was down. Go Digit, PCBL and Vadilal also saw some momentum getting out. Overall, not a bad day after the kind of very strong run that we've had. Back to you.
All right, Prashant, many thanks for joining us. China, meanwhile, has called on nations to stand up to President Trump's tariffs. Speaking at a BRICS meeting in Brazil, China's Foreign Minister Wang Yi called the U.S. leader a bully who will only be emboldened further by appeasement and compromise. Now, the remarks come even after U.S. Treasury Secretary Scott Bessent suggested that Washington could ban certain exports to China to gain leverage. Remember, Beijing has repeatedly warned other governments against striking deals with the U.S. at the expense of China. And the Trump administration could provide some relief for U.S. automakers from the impact of the tariffs. According to a report by the Wall Street Journal, President Trump may prevent duties on foreign-made cars from stacking on top of other tariffs that he's already imposed. A White House official also said that some levies on foreign parts used to manufacture cars in the U.S. may be eased. The move will be retroactive, meaning automakers could be reimbursed for such tariffs that have already been paid. Now, this has been a big pain point as far as U.S. automakers are concerned. They have, of course, been petitioning the Trump administration to provide relief on tariffs. In the commodities market, global crude oil prices easing as investors lowered their demand growth expectations due to the lack of clarity and visibility amidst this tariff war. Gold prices, meanwhile, also eased from record lows as the U.S. dollar index strengthened. In the money market, the rupee has seen a volatile session. It opened higher, even hit its highest intraday level seen in 2025 so far by falling below the 85 mark against the dollar. However, it weakened in late trade by 23 paise. Bond prices rallied and the yield dropped by almost 1% after the RBI announced it will buy government securities worth 1.25 lakh crore rupees through open market operations. And staying with the RBI, the Monetary Policy Committee voted only on the rate decision in April and February policies and not on the stance. Saugata Bhattacharya, member of the MPC, revealed this to CNBC-TV18. The RBI governor has the right to put any issue to vote at the committee's meetings. The MPC, under former Governor Shaktikanta Das, voted on both the rate decision as well as the stance. But under the former Governor Urjit Patel, the MPC did not vote on the policy stance and votes were cast only on the rate decision, and we seem now to be back to that era.
There is no mention of a vote for a stance. There is no mention of a stance. There is that phrase that the chairman of the MPC, which is the governor, the RBI governor, has the right to put in. I'm just paraphrasing. I don't remember the exact wording of the act. That the chairman of the MPC has the right to pull in anything that he or she might deem important at that point in time.
So a vote now only on the rate, not on the stance. CNBC-TV18's Newsbreak has confirmed IndusInd Bank's Deputy CEO and ED, Arun Khurana, has resigned with immediate effect. Now, this comes only weeks after the private lender disclosed accounting lapses in its derivatives portfolio. Remember, Khurana headed the global markets division of the bank, which included the derivatives portfolio. Now, CNBC-TV18 had reported just last week that the bank was likely to see the exit of senior leaders. Ritu's here with more details. Ritu, this was expected, at least that is what you had reported. Arun Khurana is out. What can we expect from here now for IndusInd Bank?
Thanks for that. And what is clearly a fallout of the accounting discrepancies in IndusInd Bank's derivatives portfolio, Deputy CEO Arun Khurana has resigned with immediate effect as of yesterday. As we reported a couple of weeks ago, this was likely because Khurana was overseeing the Treasury Front Office, which is the division responsible for the derivatives portfolio, where incorrect accounting had led to a near 2,000 crore rupee hit on the bank's P&L. In his resignation letter as well, Arun Khurana has cited the recent unfortunate developments linked to the discrepancies and this P&L hit as the key reason for his decision. Now, this resignation comes just a day after the bank disclosed that an independent investigation had identified the key individuals who were responsible, and the bank had stated that the board will determine changes and realign senior management responsibilities based on the report's findings. Now, we understand that this independent investigation was conducted by Grant Thornton, which has pegged the adverse financial impact at about 1960 crore rupees, which is very close to the 1979 crore rupee hit, which was determined by external auditor PwC earlier. The bank will now account for this loss in its fourth quarter earnings. Meanwhile, the Reserve Bank of India has already shortened CEO Sumant Katpalia's tenure to March next year, and as we had reported, asked the board to submit the potential CEO candidate names by October. So the accounting fallout is triggering top-level exits, and this may not be the last one.
Ritu, many thanks for joining us. Aether Energy's IPO subscribed 27% on day 2 of the public bidding. The retail investor segment continues to be the largest subscription segment on day 2. The segment is now fully subscribed. Non-institutional investors subscribed to 26%, while qualified institutional buyers have not subscribed to the public issue as of yet. Remember, the company plans to raise over 2,900 crore rupees via this IPO. Well, another setback for Castrol Engineering. The Delhi High Court has appointed a receiver to take charge of the 95 EVs leased to Blue Smart by Climb Finance. The receiver will now be responsible for maintaining the vehicles. However, the court said the appointed receiver is not allowed to move the vehicles where they are parked. This came after Climb Finance told the High Court that it had not received lease payments since March of 2025. SEBI has barred Castrol's promoters from the market over allegations of misuse of funds. And the regulator SEBI, we understand, is looking at whether investors were shortchanged due to alleged wrongful disclosures by OLA Electric. OLA announced sales of 25,000 units in February, but the government portal showed only 8,600 registrations. Yash is here with more. Yash, what exactly is SEBI likely to take cognizance of?
Well, as you rightly pointed out, market regulator SEBI at this point of time, what we understand from sources, is looking at the veracity of disclosures made by OLA Electric. SEBI action has come after it received certain complaints from investors of OLA Electric with respect to an alleged wrongful disclosure made by the company on the exchanges. What is that alleged wrongful disclosure? Well, on February 28th, as you rightly pointed out, OLA had announced sales of 25,000 units for the month of February 2025 as against government's portal Vahan, which showed only 8,600 units were actually registered. Market regulator SEBI, after, as I said, certain investor complaints, took cognizance of it, and right now is looking into the disclosure made by the company on the exchanges versus what really transpired in terms of actual sales. OLA, after, of course, this particular disclosure, also clarified, saying that this case of the alleged discrepancy in the sale of units was a straightforward case of temporary registration backlog. Market regulator SEBI is taking, acknowledgement of the stock price also on the day when the alleged wrongful disclosure was made and on the day when the clarification was posted by the company to see whether investors of the company were shortchanged in this process of an alleged wrongful disclosure. We've written to OLA Electric on this particular query. A response from the company still remains awaited, though.
All right, Yash, many thanks for joining us. That's the latest there as far as OLA Electric is concerned. On to earnings now. Tata Group's retail unit Trent reported Q4 numbers ahead of estimates. Shares rallying in trade after revenue grew by nearly 29%. EBITDA was up more than 37%. Margins expanded by 100 basis points annually, hitting 16%. Trent has also recommended a dividend of 5 rupees a share. Adani Group's Ambuja Cement reported a 55% drop in Q4 profits when compared sequentially. Revenue was up 6% at nearly 10,000 crore rupees. Margins were almost at 19% with an expansion of 50 basis points. Ambuja's numbers are not comparable year on year after the mergers of Sanghi and Penna Cements were completed in December of last year. Max Healthcare Managing Director Abhay Soy has said that the current version of the government's flagship health insurance scheme, the Ayushman Bharat, is not viable for private hospitals. Speaking to CNBC-TV18, Soy also said that huge operational expenses make it difficult for private hospitals to participate in such schemes. Take a look.
Private hospitals, particularly in the larger cities, the cost of, in metros, our cost of, manpower, our cost of fuel, our cost of land resources, and so on and so forth, are significantly higher than non-metro cities. So it's not necessarily viable for players like us to sort of participate in Ayushman Bharat from that standpoint. But I think, we have been working with the government how to sort of come up with more features in the policy, perhaps, which would be, then we will be able to accommodate those.
All right, that is Abhay Soy there of Max Healthcare. It's been a week since the terror attack in Jammu and Kashmir's Pahalgam claimed the lives of 26 civilians. Geopolitical tensions between India and Pakistan on the rise. Pakistan has violated ceasefire along the line of control in Jammu and Kashmir for the 5th day. The Indian Army responded in a measured and effective manner to the provocation near Kupwara and Baramulla districts. Reports suggest that intense counter-terror operations are underway in Jammu and Kashmir in the aftermath of the attack. The perpetrators of the attack are still on the run. Remember, preliminary investigations identified 2 of the attackers as Pakistani nationals. Prime Minister Modi will chair a crucial meeting of the Cabinet Committee on Security tomorrow to review the security preparations. This will be the second such meeting since the attack. Congress leaders Rahul Gandhi and Mallikarjun Kharge have written to Prime Minister Modi seeking a special session of both houses of Parliament in the wake of the terror attack. The RJD and the CPI have also made similar requests. Meanwhile, India has called out Pakistan as a rogue state fueling global terrorism at the UN. This after Pakistani Defence Minister Khwaja Asif admitted in a television interview that the country trained and funded terrorist organisations. In a separate interview, Asif claimed that a military incursion by India appeared imminent.
This forum to indulge in propaganda and make baseless allegations against India. The whole world has heard Pakistan's Defence Minister Khwaja Asif admitting and confessing Pakistan's history of supporting, training and funding terrorist organizations in a recent television interview. This open confession surprises no one and exposes Pakistan as a rogue state fueling global terrorism and destabilizing the region. The world can no longer turn a blind eye.
And 48 tourist destinations have been shut across Jammu and Kashmir to tighten security. Shivani standing by with the details. Shivani, take us through that.
Well, yes. Now, security concerns are casting shadow over Kashmir's tourism season this time as well. Now, sources have confirmed to CNBC-TV18 that the government has shut down 48 of the 87 officially recognized tourist destinations across the valley. Now, this is a significant move. Remember that it comes amid heightened security operations following the recent terror attack in Pahalgam. Popular destinations like Usmarg, Doodh Patri, Aharbal, Sinthan Top and Verinag Garden, all of which usually see very high footfall in the summer season, are now completely off limits for tourists. Even iconic locations like Astanmarg and part of Dachigam National Park have been partially shut down. Official sources say that this is a temporary and precautionary step as forces continue to conduct searches and maintain tight security across vulnerable zones. Now, security has been beefed up around the remaining open destinations, but it remains unclear when normal tourist activity will resume across the affected sites. Back to you.
Shivani, many thanks. Meanwhile, India is considering curbs on the exports of electronics and e-commerce goods to Pakistan. We learned from sources that the government is preparing for the possibility of Pakistan shutting down the air cargo corridor. Abhimanyu standing by with more. Abhimanyu, what are you picking up? What could be the backup plan? And what further curbs could India impose on exports to Pakistan?
Sources have indicated that after Indus Water, Indian electronics and e-commerce goods may face curbs for Pakistan because after passenger traffic, there is a likelihood that air cargo route over Pakistan may get severely impacted. Sources have indicated that the government is collating data from the Customs Department and several other departments to understand the logistics cost for exporters in case of any further disruptions. Also, plans are underway to assess the impact of trade to UAE and Europe as part of multifaceted preparations for a possible disruption which may happen for trade. Also, sources explained that direct trade between India and Pakistan is minuscule as most Indian goods are re-exported via third countries to Pakistan, and the third countries include nations like the UAE, Sri Lanka and Singapore, and it's primarily items like gold, gems and jewelry, electronics and e-commerce goods which are re-exported to Pakistan via these countries. Now, as per GTRI, Indian goods worth over $10 billion per year reach Pakistan from these third countries, which may face fresh curbs based on the assessment which is underway. It remains to be seen what happens with respect to the assessment and based on the stakeholder consultation, based on the information which reaches the government from various departments, any further action would be initiated.
Abhimanyu, many thanks. In global earnings, Germany's largest lender, Deutsche Bank, posted higher than expected profits in the first quarter on robust investment banking performance. However, the bank upped its credit provisions as Europe's economy navigates turbulence amidst Trump's tariffs. Net profit up 39% on a yearly basis, revenue up 10%. Meanwhile, Europe's largest lender also beat estimates in Q1. However, on a yearly basis, profit after tax fell 25%, while revenue fell 15%. The bank warned that there could be a fallout in loan demand due to Trump's global trade war. The bank also announced a share buyback of up to $3 billion, which it intends to complete before 2025 interim results are announced. Automaker General Motors ahead of expectations in Q1. The company is reassessing its 2025 financial guidance and suspending any additional buybacks amidst uncertainties. Due to Trump's tariffs, the firm's revenues have come in at $44 billion, up 2.3% compared to last year. We will head to a break, but up next, the Supreme Court asks what is wrong if the government chooses to use a spyware in the Pegasus matter. Such national security cannot be compromised. That and more when we return. Well, the big international story, Mark Carney's Liberal Party has won the Canadian elections. This marks a notable turnaround for the centre-left party. However, the Liberals have fallen short of securing a majority. According to preliminary results, the party was leading in at least 164 electoral districts, just 8 seats shy of the 172 required for a majority. In his victory speech, Carney took a tough stance against Washington, accusing President Trump of trying to break the country apart.
America wants our land, our resources, our water, our country. Never. But these are not idle threats. President Trump is trying to break us so that America can own us. That will never, ever happen.
Carney era there in Canada, and it starts now. On to court action back home. The Supreme Court has asked what's wrong with the government using spyware against anti-national elements. The court's observations came while it was hearing a petition seeking the release of the 2022 expert panel report on the use of the Pegasus spyware. The top court also said the spyware usage can be examined if it targeted civil society members. Now, Ashmit is standing by to take us through the arguments in court. Ashmit.
Well, interesting observations falling from the apex court, the Supreme Court expressing its prima facie view that what's wrong if the government is indeed using spyware, that the only question is who they're using it on, and then supplementing that by saying that if there is a case that is made out that members of civil society are being targeted, that is something that the apex court is willing to look at. But at a broader level, what the Supreme Court, the impression that it's trying to give right now is that there can be no case of compromising national security, especially given the sensitive times that we are in. Now, all of this began when the petitioners made a pitch before the highest court of the country for essentially disclosure of the expert committee findings that were placed in a sealed cover in 2022. Since then, there's been no disclosure of the findings of what really the expert committee had discovered when it took on the devices to investigate whether or not Pegasus had been used. In fact, what we do know, what the small detail that was made public, is that there were devices that were found to have malwares, but it could not be determined whether or not it was Pegasus. It is in this context context that the petitioners made a pitch by citing a US court judgment of 2024, saying that this is new evidence. It wasn't available before the expert committee, wasn't available before the Supreme Court, that this judgment very clearly says that it has upheld WhatsApp's allegations against NSO, the maker of Pegasus, for using WhatsApp servers for intercepting as many as 1,400 devices. This, the petitioner says, damning evidence of even Indian devices having been infected, and therefore is seeking a further hearing in this matter, seeking for disclosure of those findings. The centre's position, however, is quite clear. The centre is placing national security on a pedestal and saying that there can be no case of compromising national security and sovereignty. Therefore, no case is made out. However, the Supreme Court said it is willing to think about this and has posted the matter for further hearing on July 30th.
All right, we look forward to that. Thanks very much, Ashmit. Now, the International Air Travel Association, IATA, is, and I quote, surprised and deeply disappointed, end of quote, after the Mumbai airport informed cargo flight operators about discontinuing flights and potential withdrawal of slots from next season. Now, cargo operators have been protesting this proposed shift to the new airport in Navi Mumbai, which is set to be operationalized this year. Madiha is standing by with the details. Madiha, take us through IATA's statement and its objections on the likely change as far as cargo flight operations are concerned.
Well, it has been a very contentious issue. We know that Navi Mumbai International Airport is gearing up to start operations in the next few months. There's still no clarity on how many flights will be shifted to this new airport and whether all airlines, all operators are willing to move part of their operations there. Remember, both these airports are owned by one entity, the Adani Group. Apart from pure cargo players, several big players including Lufthansa, Emirates, Singapore Airlines and Cathay Pacific operate freighter flights to Mumbai. What IATA is concerned about is whether the airport operator is using this situation by suspending cargo flights and withdrawing the slots to pressure airlines to move their operations to their new airport, which is in Navi Mumbai. And if that is the case, then IATA warns that this is an example of airport capacity gaming, which will harm aviation throughout India and beyond. Now, we had also reported about Adani Group's plans to build taxiways and parking slots at the time when Mumbai Airport had submitted the tariff hike proposal to AERA. So it has been their plan to carry out infrastructure work at the airport. But the panic and concern in the cargo airlines community started when Mumbai Airport informed the operators that they will suspend cargo flight operations at the airport from 16th August 2025, which is just 3 months from now. And the reason for this could also be valid, the concern for this could also be valid, because when you're carrying cargo, you have a complete logistics ecosystem that's taking care of moving shipments out of the terminal to a warehouse and then for distribution. And there are shippers and buyers that are around the vicinity of the airport who may not want to travel to Navi Mumbai. So it could not only impact these airlines, but also disrupt the supply of goods in the city. That's the fear, and IATA says that such decisions of reducing capacity cannot be taken unilaterally and have to be done after consultation and advance notice to stakeholders. IATA claims that Mumbai Airport has failed to adhere to Civil Aviation Ministry's guidelines for slot allocation, including its direction to preserve historic rights for future seasons. IATA has urged the airport operator to immediately withdraw these capacity cuts and instead urgently engage with the airline industry in a meaningful consultation to minimize disruptions to airline operations, inconvenience to passengers and loss of air connectivity for Mumbai. IATA says there have been zero details on how Mumbai Airport will manage the capacity reduction and mitigate the impact. So this is what we have so far.
All right, Madhya, appreciate you joining us. And with that, it is time for us to wrap up this edition of Business 360. The news will continue right here on CNBC-TV18. Do stay tuned. We're back in a minute with more.
Hello and welcome to Commodity Champions. I'm Manisha Gupta. Well, the Indian ice cream market is expected to experience a strong double-digit growth as summer kicks in early this year. The classic flavors of vanilla and chocolate continue to rule the market. However, there's been a gradual shift in consumer preferences as they become health conscious and seek low-fat, high-protein and sugar-free variants. India is also witnessing a rising adoption of plant-based and dairy-free ice creams that cater to lactose-intolerant consumers and vegan lifestyles. Ice cream consisting dry fruits, superfoods and probiotics are also in demand, not just in metros but also in Tier 2 and Tier 3 cities. Well, how much sales do ice cream makers expect to scoop up this summer season? Let's start with Amul joining us on the show to discuss this is company's MD Jayant Mehta. Mr. Mehta, hi, thank you so much for joining in. Well, how are you looking at and what are your numbers anticipated for ice cream demand in this summer that started way early in the month of Feb this time?
It's been a fantastic season and ever since February, since we witnessed early summer this year, February, March, April and the coming 3 months also, we're seeing a very, very good growth, not just high double digit, something more than 35-40% also year on year, month on month is the kind of growth they are witnessing in the ice cream business.
Mr. Mehta, what is the annual sales expectation this time around? You're looking at an year-on-year growth, yes, but what is that you're looking at as annual number this time?
The overall numbers should be pretty good. It's just the beginning of this financial year. Last financial year, we closed at about 66,000 crores. So now we are officially the largest FMCG company in the country with a turnover which is 10% more than the closest multinational who was all this while leading this business. In the dairy business and the ice cream and the beverages business, thanks to a good summer and marriage season and the festive season coinciding, we expect a good quarter as far as the growth in the business is concerned overall, which is April to May, June quarter. And subsequently also considering the momentum that we have with the success of the launch of the new products, the expansion in our distribution, the efforts in brand building and advertising that's been happening, we expect to close this year at a turnover between 75 to 80,000 crores. And Amul brand definitely will cross a turnover of 1 lakh crore rupees by the end of fiscal 25-26.
Mr. Mehta, you've talked about various innovations in the sense of variety or taste and flavor. What is it new that the Amul is looking to launch this time around for its consumers?
Well, the consumers always expect something new in these categories, which are largely impulse. Now also consumed a lot at home, thanks to the Q-commerce and online delivery platforms. So we launch as many as 20-25 new products in ice creams, about 8 to 10 new categories and products in beverages with the 10 rupee True gaining a lot of traction. We are launching a 10 rupee buttermilk pack also to cash on the growth opportunities in the 10 rupee pricing segment of the beverages. Similarly, a new range of protein products being launched, multiple formats of ice creams being launched. We launched high protein ice cream kulfi also last week, and a variety of products across multiple categories that we operate in, be it organics or be it probiotics or be it even ghee, where we launched Deshi cow ghee variant in our entirely strong ghee range also. So obviously innovation is the name of the game. Consumers want products which meet their requirement. Sometimes they speak about it, sometimes they don't. But as a brand, it's our job to keep innovating.
Well, in addition of all of these 2025 new flavors that you're coming out with, you've also come out with ice cream lounges. You also are not just in India, but you've taken the brand India abroad with Amul. What kind of growth are you seeing in India, in all of these countries outside India? And are these Trump tariffs impacting you at all?
Yes, our launch in US, which happened exactly a year back on the 1st of May, has been pretty successful. We are perhaps the only brand of milk available across the length and breadth of the United States, right from California to New York and Chicago to Houston. So available in more than 35 states of the United States of America. We launched buttermilk also. We launched high protein milk. We launched dahi also in the US to add to our already strong portfolio of butter, cheese, ghee, chicken that we've been exporting for more than 25 years. So that is one foray which has been doing very well. We are looking at other geographies also to expand. The tariff war has actually given us a window of opportunity because there are several countries who are not very happy with the high tariffs imposed by the US, and US is the second largest exporter of dairy products in the world. So we sense a huge opportunity of their markets coming into our fold, and we've already started working in that direction.
You've talked about US, but any other geographies that you can share with us on the same, and where you are looking forward to also expanding now?
I think the entire neighborhood, be it the Middle East, be it Southeast Asia, be it Sub-Saharan Africa, all these regions are in close proximity to India and obviously India is the largest producer of milk in the world, and the growth in the dairy business in the country will give us this opportunity to be a dairy to the world. And the tariff war will be one additional opportunity which will give an impetus to these efforts.
Mr. Mehta, I want to come back to India and the Indian summer now. And apart from ice creams, there is also about flavored curd, milk, beverages, which also come in so many flavors now. What is, as a category, how is that growing? And what numbers are you seeing in terms of percentage there? How are you also innovating within this space?
The curd, the buttermilk market and the beverages market all have been growing at a very, very good growth. I mean, I can say about confidently 25 to 35% growth has been consistently happening year on year in each of these product categories. We are driving growth in newer markets, and the existing markets also are witnessing a huge growth. Again, as I mentioned, the early onset of summer and the fact that we converted our entire 3 million liters of day buttermilk into probiotic buttermilk at no extra cost to customers is giving us a huge growth as far as the volumes are concerned. Consistency in consumption, people are never dropping out of this category, and this is what is the advantage of Amul in helping build the immunity and health of our country. The beverage portfolio also is pretty strong with more than 100 SKUs. The protein beverage category is added on to the salience of this category and its traction amongst the youth and the protein conscious market of the country, and creating huge ripples thanks to innovative pricing, innovative product range, and of course our direct to consumer interaction with this channel. So we are witnessing a good growth, and we are actually increasing our capacity of protein beverages by 5x starting from May onwards. So this is the huge opportunity in the entire beverage space that we are witnessing and working on very hard.
Just coming back to protein and more health categories there, and would you say that fresh fruits, dry fruits, low fat, sugar-free, gluten-free, all of that is being incorporated as well?
Yeah, of course. I mean, wherever possible, we make the products fat-free, reduce the sugar content. Obviously, most of the offerings are lactose-free these days. And probiotics is what we're trying to include in as many things as possible. So the health indicators in genuine delivery format is what Amul's effort to grow the segment and reach out to a larger number of people in a very, very big way. So that's been our efforts in developing the yogurt portfolio, developing the beverages portfolio, developing the ice cream portfolio, and a whole host of products which people consume in their daily lives.
Mr. Mehta, apart from the ice creams and the beverages and the global expansions that you spoke about, what else is in the pipeline for Amul now? We do understand that organics clearly has been the latest addition here. What all is happening onto that one?
The efforts in building the organics market has been going on pretty well. We launched organic tea recently, organic sugar also, and a big range of entire organic spices also is coming up very shortly. So now today we have almost a very, very strong portfolio of everyday consumption items in our kitchen into Amul organic format. The backward linkage with the farmers is going on very well. And obviously the consumer interface is also going on very well. So this is one additional pillar to what we've been doing in the conventional categories, apart from the butter, cheese, ghee, shrikhand, ice creams, beverages, and so on and so forth. But this will give us a very good presence in the households. The trust which Amul has in giving quality products, and that too certified organic, lab tested organic, will add on to the consumption basket items in every single household of the country. And this will lead to overall growth, not just in the business, but also the well-being of the farmers who are associated with us.
Mr. Mehta, no conversation is complete without talking about milk prices. And we do understand that the prices have been volatile. There has been an increase as well when it comes to procurement. So what's next on that for Amul when it comes to milk prices? And of course, that going on for other products as well.
We've held on to the milk prices since last June. In fact, a few months back, we did reduce the price of the 1 liter pack also. So given the impact of the summer, there are quite a few states in which we have seen the increase in prices of the dairy products. And we have been holding on to this to see that the consumers are not affected by any increase in price of milk or milk products. But there is a pressure of inflation, the pressure on the feed, water and other resources. But we're keeping ourselves at the moment at a steady level.
All right. Mr. Mehta, as always, thank you so much for being with us. Well, that's Amul for you, saying that 35 to 40% of an increase in ice cream sales anticipated in this season. And they're, of course, coming out with various other products. And as he said, within the FMCG category, they are now the biggest company in the country. Well, from Amul, let's now shift focus to Hoko, joining on the company's MD Ankit Shona with us now. Ankit, hi, thank you so much for joining in. As Mr. Mehta said, that 35 to 40% of an increase in sales is what they're anticipating. Can that be expected across segment for the country?
So, first of all, a very good afternoon, Manisha, and thank you for having me. Yeah, so I think from whatever we are hearing from overall the consumers and from the trade and all, it is, I believe that high double-digit growth is what the industry is experiencing. We being just about, this is our second summer, so we're experiencing almost a 300% growth in our overall sales. So, because we just started out, last year was our first summer, and the only thing that is stopping us from growing further is our own capacity. So clearly there is a significant increase in demand for ice creams this summer.
Ankit, talk to us about on what the consumer really seems to be wanting right now. I mean, from fruits to superfruits to lactose-free to fat-free, there's just so many requirements right now coming in, so much that the consumer is wanting right now. Are you able to deliver it all?
So obviously the market is divided into various subcategories, and while health is a very important space to be in, it's still a very, very small part of the overall ice cream industry, according to us. So we are going to shift focuses there. Right now, we play more in the indulgent category, and that is probably about 95% of this category. Having said that, the health conscious category was non-existent about 10 years ago, and now it makes up about 5%. So it's clearly growing at a much faster pace, but it's still in the niche and niche segment right now. So we also have we have a sugar-free range, and we are in the process of developing a vegan and sugar-free range as well. That is the need of the hour, and that actually is growing very fast on the quick commerce platforms. Where there is a little more price elasticity, and and that's where the overall demand we are seeing a surge in the health conscious space.
Ankit, coming on the distribution part of it as well, because we've seen that also spread out quite strongly in the last 10 years, as you mentioned, because from supermarkets to ice cream parlors to convenience stores, now on website, on e-commerce and quick commerce, and there's just various ways of consuming ice creams. How are you spread out?
So, yeah, as I said, a few years ago, quick commerce was a non-existent category. Now, I would say for overall the ice cream industry, almost 20% of the revenue is coming from quick commerce. So it's a very important category for all of us. And more importantly, since it's a new category, I think the learning curve has been very steep. This summer, we are seeing that even all the companies, Zepto, Instamart, Blinkit, they all have upped their overall storage capacities and even their last mile delivery, which is very critical for ice creams. So I think that has been a big game changer this summer. So their volume growth has also helped us overall. As far as the general trade and modern trade is concerned, even that continues to see some growth. But overall, I think the game changer for the ice cream industry has been quick commerce in the last couple of years.
Talking about the organized and the unorganized market as well, the latest data shows that organized market now consists of 60% and seems to be growing more. So people do have a recall here and they go by brands, would you say? And that really helps the segment.
No, of course. I think in every category in India, I would say that there is a significant shift from unorganized to organized, and I think the COVID phase actually expedited that shift to the organized sector, and I think the organized sector of ice cream was also a beneficiary of that. What also happened is a lot of the unorganized players actually landed up upping their overall production capacities and moving to the organized sector. So I would say that the growth of the organized sector in ice cream is more than double of that of the unorganized sector, and it is actually led by a lot of automation. The overall economies of scale that really helps the cost, and so therefore there is not too much of a difference in cost between the two, and so obviously then the consumer would want to pick a branded product over an unbranded product.
Oh, absolutely. Ankit, how would you look at the demand growth? Because when you look at those numbers globally, India perhaps is one of the lowest consuming in sense of ice cream as a category. I mean, when you look at China and Japan and the US and New Zealand, the numbers are really huge.
I'm a third generation ice cream entrepreneur, and I've heard this all my life growing up that India is the lowest consumer of ice cream in the world. So obviously, that makes it even more exciting, and there is significant room for growth there. And I feel that, and therefore while India might be the lowest consumer of ice cream per capita, it is definitely the fastest growing ice cream country in the world. The consumption story here is very much here to stay for the next at least couple of decades. So we are all very excited about it. And I said this last time also, with the infrastructure really, keeping up with the growth of the economy, I think that's really helping the ice cream industry. Power was non-existent in a lot of tier 3, tier 4 cities and villages in India about a decade ago. And that all has changed drastically. Today, you get ice creams in every nook and corner of the country. And even with the road infrastructure improving, I think overall, that has really, really given a huge boost to the overall the frozen food industry in the country.
Oh, absolutely. Ankit, thank you so much for joining in and making sense of what really India seems to be doing. And I get your point, yes, while the numbers are the lowest, but as you said, the growth is quite strong, and we perhaps are looking at stronger numbers as we go on from here. Appreciate your time here. Well, on that note, it's time for a break, but don't go anywhere. We will discuss precious metals on the other side. Joining us would be Peter McQuarrie. Welcome back. You're watching Commodity Champions, and from sizzling summers and rising prices, let's move on to gold now, because it's Akshaya Tritiya week and the prices of precious metals have eased after hitting a record highs. What does it really mean for the global buying and especially in the Indian markets here? To get to that sense, we are now joined by Peter McQuarrie. He is CEO at trading.com. Peter, hi, thank you so much for joining in. First of all, on the gold prices itself, from 3,500 to around 3,300, and it's been holding around those levels. What's your sense on current prices?
Well, Manisha, good to see you. I think it's, 33.20. Yes, it was certainly sold off from that peak of 35, but let's put our mind back to, say, August of last year, where it was set at 2,500, and that massive, 40% blast off from August to April was just extraordinary, Manisha. So, yeah, the hot air. We had also a bouncing US dollar over the last probably week and a half, back up to nearly at 100, but it's been sold off since. You're running at around 99.20. So I feel as though that you've got to keep a close eye on what's happening with, naturally, the tariff situation. But I think gold's got more run up in Q2.
What is the new high and what are your targets for this year now, Peter, for gold?
Well, I think, I've listened to the best of the best. You listen to the likes of Goldman's, you listen to the big banks, they're saying 45. I think it's got to be, a 37.50, and if it hits that, Manisha, then possibly 4,000. It's so difficult to really forecast because there are so many moving parts. Does China play ball with America, or does America play ball with China? And that seems to be the #1 game at the moment. How that's going to play out and the impact that's going to have across the fabric of consumerism and, of course, central bank buying. So I think that, 37.50, but keep an eye on fall.
Peter, between gold and silver, with the gold and silver ratio as well, suggesting that the silver should see a higher side or gold perhaps should correct, would you bet more on silver going forward from here?
Absolutely. I mean, it's currently the best part, $33.50. And, that ratio, Manisha, would be close to 100 to 1. I'm just working that working that out of my mind. I feel as though, the long-term averages, I think there's far more upside. We've had that underinvestment in the silver market for the best part of 2 to 3 decades. So that storyline hasn't changed. And the overall, I think, attraction is going to be, one, ease of market, ease of buying physical, and, of course, far more, I think, I'm not saying it's far more affordable, but not everyone can go out and buy a kilo of gold. It's a huge amount of money. So many people are looking at that silver market, and I know it's very attractive across different age demographics and very popular with the young people, certainly in Australia. You just hear about it. My kids are in the late 20s, and their friends are starting to talk about it. Oh, should I buy silver or gold? And I'm going to buy silver. So it's got an attraction.
Since while you have gold targets at around 37.50 on the higher side, Peter, what's your sense on silver for this year?
You've got to keep $45 as a #1 target. I mean, I think that's US dollars, Manisha. It's got the capacity to get there. I don't know whether it'll be there by the end of Q3, but I wouldn't be surprised sometime, certainly by end of year. And, I remember the old bunker hunt days of 81 when they tried to corner the market. The all-time highs, I think it's going to be close to 50, takes it out. But, yeah, let's look at, that mid-40 range. I think it's very achievable.
Peter, you said that the silver will take support from gold if it goes up or down. And then if gold goes down, metals will go up and silver will take support from there. So either way, silver seems like in a sweet spot there. But what is also your sense for the base metal prices now? Because China has been saying some things which are supportive, but the market's still continuing to look at those tariff concerns.
Well, exactly. I mean, I have a look, start at tin. I mean, that was massively sold off from 37 to 32,000. And that's been, a massive downdraft over the last couple of weeks. Aluminium hasn't bounced. I mean, that's still at 2,400. Zinc's at 26. I've just made a note. You got copper. That gave off a lot of that hot steam. It hit 10,000, back to 9. Now it's at 94, just under 9,400, Manisha. Keep an eye on copper. You can't take... You've got to appreciate it because, it still is a barometer of global growth and global economic conditions. And I really feel as though that copper's probably got its best days ahead of it over certainly 2025 and leading into 26. I think it could take, 10,500 out quite easily.
You spoke about dollar index, which is holding around 99 right now. We did see prices or the index fall below that as well. How are you looking at dollar index now?
I want to see a couple of things come out this week. I mean, where's Fed Chair Powell going to be? If he drops rates, then it's only going to put further pressure to the downside for the US dollar. Is June going to be the call or is it going to be July? What happens as far as PCE this week? What happens as far as non-farm payrolls? Is it going to shoot the lights out like last month at 228,000? but analysts are saying it's going to be closer to 130,000. So it's too hard to speculate on NFP, Manisha. But I feel as though that if it was to get over 200,000, then it's going to change, I think, Fed Chair Powell's decision making, and he might push that back a little bit further. But very much in the hands of the Fed, and I think certainly softer from here for US dollar index.
Oh, well, absolutely. We've seen multi-year highs come in for euro and Australian dollar, and even Japanese yen seems to be getting some support there. So, Peter, if you had to make two main calls from here or two main trades from here, one in currencies and one in commodities, what would those be?
I think I'd have to short US dollar. So that'd be probably a run up again for euro and probably yen. And I wouldn't be surprised that yen there's about 16 basis points of hikes that I think will probably come into the market. So I think the yen's got more capacity upside, and certainly euro. I'm still a gold bug, Manisha. I mean, I still believe its best days are ahead of it for 2025. So, yep, I'm still there.
All right, so shorting US dollar and going long on gold is the trade coming in for Peter McGuire. Thank you as always for joining in here at CNBC India. Really appreciate your time. And with that, that's all the time that we have on Commodity Champions. Thank you for watching.
Hello and welcome to News Center. With me, Parikshit Luthra. India has signed a 63,000 crore rupee deal to buy 26 Rafale marine fighter jets from France. The agreement includes 22 single-seater Rafale jets and 4 twin-seater trainers. Deliveries will begin in a few years and are expected to be completed by 2031. The Rafale marine jets will operate from INS Vikrant and INS Vikramaditya, replacing the MiG-29K fleet. The deal comes at a time when India is facing increasing pressure from the Trump administration to purchase more military equipment from the US. The Defense Acquisition Committee has cleared proposals to acquire arms worth 54,000 crore rupees last month. To speak more about the marine Rafale deal and India's defense procurement roadmap, we are now joined by Union Defense Secretary Rajesh Kumar Singh. Mr. Singh, thank you very much for joining us. Straight off, how will the acquisition of 26 Rafale marine aircraft boost our maritime capability?
Parikshit, first of all, thank you, and I'm glad to join you today. Well, the Rafale marine aircraft will first and foremost ensure that our two carriers are fully operated or provided with adequate numbers of fighter aircraft. As you know, this particular aircraft was chosen after a process where other options were also looked at, evaluated, and thereafter the best of the lot was picked. We expect this to significantly add to our maritime power projection capabilities and ensure also that the number of fighter aircraft within the Indian Navy get augmented. So all in all, this is going to add significantly to our ability to project power through the Navy across the Indian Ocean region. And we hope that this is going to ensure that our carrier battle groups get fully operational and make it really create an impact in the entire Indian Ocean region.
Right. The next question that we would like to ask you, that how will the Indian defense supply chain benefit from a deal of this kind? Because this is not just for acquiring 26 aircraft, but also for maintenance, repair, overall facilities, and also a facility for making fuselage as well in future.
Yeah, so the IGA, the Intergovernmental Agreement, under this deal involves setting up of a MRO facility in India, which would be completed in 5 years and would enable our Navy and Air Force fleets to undertake depot-level maintenance of the Rafale aircraft within India. Also, the indigenization plan will include manufacturing and assembling of front section, middle section, and aft section of the Rafale aircraft fuselages, setting up of a fully qualified supply chain so as to enable maintenance and repair of major Rafale sub-assemblies of radar and EW systems, and also setting up an MRO facility for depot-level maintenance of the M88 engine modules. Now, this is particularly important because this will be the first facility outside France which will meet the requirements of M88 engines worldwide. And in addition, we will also be providing MRO and midlife overhaul of Mika missiles in India. So all in all, a significant ecosystem will develop as part of this deal.
Right. To ask you about the fact that a production facility for the fuselage for maintenance, long-term maintenance is being set up, can we assume that India is now significantly considering induction of more Rafale aircraft into our forces, not just as Navy, but in the Air Force as well, considering that this is a platform that we already have, and we would like to build complementarities between the Navy and the Air Force, and there is now going to be a long-term contract for maintenance and manufacturing. Does this mean that India will be seriously looking at acquiring more Rafale aircraft?
I don't want to anticipate what is going to happen in the future. So, yeah, I mean, obviously, when we do any such procurement in the future, we'll be looking at all options, including Rafale. But no, I can't. It's a nice try by you, but I can't give you any answer right now as to what that eventual procurement decision will be.
Okay. What about the importance of defense PSUs or the involvement of Indian defense PSUs, defense manufacturers in this deal in the next 5 to 10 years, once the entire agreement is in place, when this manufacturing setup is in place, how will Indian defense suppliers benefit?
I don't think we are looking at it as necessarily beneficial only for the public sector. We expect a large number of Indian private players and industry partners to be part of this ecosystem as these MRO facilities, the fuselage, some parts of the fuselage being constructed in India. In each of these cases, we expect private Indian partners to benefit, and that ecosystem hopefully will ultimately lead to a growth of a proper public and private aeronautics industrial complex in the country.
Right. Now, to speak about the offer that has also come in, Mr. Singh, from the United States, and J.D. Vance just last week in Jaipur made this point that they would like to offer cutting-edge stealth F-35s to India. This is now the second time that the US has made this proposal in the last 3 months. Is the Indian government considering this? Are there any talks going on with the US government?
Short answer is not as yet. I don't think there's a concrete written proposal as yet. As and when it happens, of course, it will be looked at by the Air Force, which will look at the capabilities and take, advise the government. But as of now, it's not reached a stage where we can say that it is, being actually discussed in detail. Once a concrete proposal comes, we'll see.
Right. But does it in any way meet our needs, considering that we have Sukhois in our setup already? We are inducting Rafale fighters. Does it make sense to acquire American fighter jets?
We'll evaluate those options. I think there is a generational difference to some extent, but yeah, we'll evaluate those options. We'll be guided by the Air Force. But as I said, it's too premature to discuss it right now.
Right. Also to speak about the Defense Acquisition Council's approvals for 54,000 crore worth of capital acquisitions for the Navy, Air Force, Army. This has happened just last month, Mr. Singh. How will this add to the order pipeline for our defense industry?
You'll find that the bulk of that particular DAC that you're mentioning, involving 54,000 odd crores, almost 90% of that AONs related to procurement from indigenous sources. So therefore, these will, of course, augment the existing order book of our major defense industry players and overall support the vision of Atmanirbhar Bharat. We are, on the whole, as you would have noticed, we've earmarked 70% of our capital modernization budget for the domestic industry. That the actual figure will probably be exceeding that figure. So yes, in the last 2 years, if you see the total AONs that have been accorded, about 6.6 lakh crores of them, about 83% of this has been directed at and will be earmarked for indigenous sources. So yeah, the journey towards Atmanirbharta is very much on and going well.
Rajnath Singh, the defense minister, had called 2025 the year of reforms. The government had recently approved guidelines for shorter defense procurement processes. What can we expect on this in the next few weeks, and what is the aim?
So we've identified that there are various sort of processes involved in our procurement, which includes everything from cost negotiations to field evaluation trials to preparation of RFPs. All of these had certain timelines that were often very, very elongated. We've, through the DAC, we've already taken a view that many of these timelines are going to be compressed. Essentially, what we are trying to do is ensure and accept higher accountability within our system for the various collegiates and groups which are, for example, doing the FATs or doing the RFPs. As part of that, the DAC has already taken a decision in terms of compressing many of those timelines so that we take several weeks out of this procurement process. At a broader level, as far as the DAP 20 is concerned, there could be some changes required in some of the procedures themselves. For that, we've set up a committee under the DG Acquisition. The intent is to finalize the updation and amendment of that DAP 2020 document in the next 6 months. So we are doing two things together. Short term, we are compressing timelines for some of the processes that are part of the procurement procedures to in terms of amending the procedures themselves, we are looking at a committee which will talk to all stakeholders, including the private sector, public sector, other stakeholders, and then take a call on modifying and amending that procedure to in tune with current requirements.
Right. Minister Rajnath Singh has said that manufacturing aero engines is going to be a priority area for the government. Could you give us a sense of what the government is going to do in this aspect?
Well, I think you will be aware that there are two sort of parallel tracks here. One is that the technology transfer for the General Electric 414 engine, that is a negotiation that is ongoing between the HAL from our side and GE on the other. That is making progress, and that will help us meet the requirement of a jet engine for the time being in the interim. In the long term, in order to obtain strategic autonomy, we need to have our own full IPR, Indian IPR-based jet engine. For that, we are in touch with certain engine houses. We will be taking a call on that also, and that will involve a national mission, but that is something that is further down the line. We are still working on some of the proposals that have come, and once we take a call, of course, the press will come to know.
Right. Just on the F414 engines, there have been talks on price negotiations which have been ongoing for some time now. Could you give us a status right now, Mr. Singh? Do you feel that those talks will conclude and we could possibly see a manufacturing line coming up this year?
This year, I hope so. This is being led by HAL. We don't get into the nitty-gritty of that negotiation, but on our part, we've been asking both players, GE as well as HAL, to try and expedite this so that our production schedule for the future Tejas, I think it's Mark II, doesn't get affected. So yes, that is something that we are nudging from our side, but the nitty-gritty of the negotiations we are leaving to these two agencies.
Right. On integration and facilitation of integrated theatre commands, that was also one of the reform areas mentioned by the Defence Minister. Any announcement that we can expect on this?
I would not be able to tell you. This is something led by the Chief of Defence Staff, but I do know that they are working closely on creating greater jointness in terms of various elements of the work that the services do that overlap with each other, whether it is logistics, whether it is procurements. On all of that, he's been working on a process of improving the jointness among the three services. I'm sure that is making good progress. Whether any announcements are on the anvil, that I wouldn't be able to tell you.
Right. Could you give us a sense of the push of the government in terms of more acquisitions, more orders this year? We recently also saw the government clearing a deal for the acquisition of P-75 submarines, and this is going to be given to Mazgaon Dock Limited and Thyssen Group. Could you give us a sense of what will be the major push areas for the government this year in terms of further acquisitions and indigenization?
I think the case that you mentioned is still not final yet. That's still sort of in the works only. But and I don't want to talk again about specific procurement so much, but I do want to give you a sense that of the speed at which we are working. You'll find that in the last financial year, we signed up contracts of about 2,09,000 crores. That was almost double the maximum that we've ever done before that. I think in 23-24, we hit about 1 lakh crores. So the speed is, should be obvious that we are moving fast in terms of ensuring that contracts get finalized quickly. Visibility is created across the defense ecosystem about the kind of orders that are available so that the vendors down the line, the tier 2, tier 1 vendors, all of them are aware of what are the procurements happening. They start working accordingly. So in that sense, a lot is being done in terms of ensuring that, one, we utilize the fiscal envelope that the government makes available to us through budgetary outlays. We don't allow surrenders to happen, particularly from our capex budget. And two, we ensure that maximum contracts get finalized early, because until you finalize contracts, you will not, be able to fill up the capability gaps that exist. Although to a great extent, in the recent past, we have tried to fill most of these capability voids that existed.
Right. Mr. Singh, my final question would be on the fallout of the Pahalgam attack. What's your reading of the situation at present, and how will India now prepare itself to deal with this situation, Pakistan-sponsored terror in the long term?
I think the Honorable Prime Minister has spoken for the nation on this. I don't have anything further to add. In any case, these are not things that we'll discuss in advance. But yes, our job is to ensure that our services are capable and equipped to take care of any eventualities, and we are intent on ensuring that.
All right. Mr. Singh, thank you so much for giving us a complete picture of India's defense acquisition process and the speed at which things are going, and the importance of Rafale marine aircraft and the entire government-to-government contract in the scheme of things as well. We're going to take a short break at this point, but don't go anywhere. We shift the spotlight on the counter-terror operations underway across Jammu and Kashmir. A discussion with Army veteran Major General Yash Moore on the other side. Welcome back. It's been a week since the terror attack in Jammu and Kashmir's Pahalgam claimed the lives of 26 civilians. Geopolitical tensions between India and Pakistan have been on the rise. Pakistan has violated ceasefire along the line of control in Jammu and Kashmir. For the fifth straight day, the Indian Army responded in a measured and effective manner to the provocation near Kupwara and Baramulla districts. Sources tell CNBC-TV18 that intense counter-terror operations are underway in Jammu and Kashmir in the aftermath of the attack. The army and the police continue their hunt for terrorists. Remember, preliminary investigation had identified two of the attackers as Pakistani nationals. Meanwhile, the Indian Air Force and Navy have continued with the exercises to improve preparedness. Meanwhile, India has called out Pakistan as a rogue state, fueling global terror at the UN. This after Pakistani Defence Minister Khwaja Asif admitted in a television interview that the country trained and funded terror organizations. In a separate interview, Asif claimed that a military incursion by India appeared imminent. Prime Minister Narendra Modi will chair a crucial meeting of the Cabinet Committee on Security tomorrow to review the security preparations. This will be the second such meeting since the attack. We're now joined by General Yash Moore. General Moore, thank you very much for joining us on the program. How would you describe the government's strategy at this point? Of course, this is a decision, and how they respond, it's up to a very few set of people in the government, and that's how it should be. But if you had to explain what's happening currently in terms of the military exercises that are underway, our attempts to isolate Pakistan diplomatically and economically, how would you sum this up for our viewer in terms of India's response?
Parikshit, first of all, thank you for inviting me. It's after a long time that I have come on your channel. First of all, what happened, really the anguish, the trauma of the entire nation, something like this, I have not seen happening for a long time. Last time something like that happened was when Bill Clinton was here, when 36 Sikhs were massacred in Chatti Singhpura. So, the reaction had to be, at the national level. So whatever the Prime Minister and the Cabinet Committee on Security took, I think these are really big measures, especially suspension of the Indus Water Treaty, cancelling of the visas, and other measures that have been taken diplomatically. As you said, we have to isolate Pakistan diplomatically. And these are all strategic measures taken to put Pakistan in a spot and tell the world community at large about the rogue state that Pakistan is, and the Pakistan military, that the kind of work they have been doing. So we have created ground. We have created, in spite of the watered down UN Security Council resolution on Pahalgam. At least the resolution was there. But getting all the all the ambassadors here, world leaders talking to Prime Minister Modi, all P5 speaking in unison against this attack. So we have created a ground to isolate Pakistan and pin this entire thing on Pakistan. Now, the second meeting, which is going to take place, as you said, probably tomorrow, where we have seen the series of meetings taking place, CDS with the service chiefs, CDS with then the Raksha Mantri briefing the Pradhan Mantri, and now probably the CCS will meet again, review the effect of the actions they have taken, and plan for further action. This time, the best part is there is no knee-jerk reaction. India is taking very solid, calculated decisions. And I'm sure the best part is the entire nation is with the government of India, including the people of Kashmir, which is a big change in this particular incident. Rakshit.
Right. If we were to also ask you, sir, about any response that India comes up with in a military fashion. Now, the expectation is, and the Prime Minister has given a very strong speech in Bihar, where it was clear that India will come up with a response. And we've seen that in Uri, we've seen that after Pulwama with the Balakot airstrikes, that there is all possibility of a limited, calibrated response from the Indian forces. What are the pros and cons of such an exercise? And how do you make sure that it is effective and has a deterrent effect?
See, I think this time it is going to be whole of a nation approach. Not only all the three services are going to be working in unison. We have a CDS now, and so that system is working very well. And I'm sure with the Home Ministry, the intelligence agencies, the targeting of various launch pads, targeting of terrorist camps, and the effort will be, at least what I feel, will be how can we target this terror-making machinery which operates under the ISI, which operates directly under the Pakistan military. See, I've been telling one thing throughout, whatever I'm reading or understanding I have Pakistan, is somehow we must take measures to isolate the Pakistan army from its people. It's a rogue army. And all this, whether it is Asim Munir or many other chiefs, the kind of venom, the kind of, hysteria they try to create with this Hindu-Muslim narrative and try to bring religion. No service personnel I've seen do this kind of, playing to the galleries. So the aim, I think, this time of the government will be economically strangle Pakistan, diplomatically isolate Pakistan, and then hit them at targets which are genuine targets, which we can convince the world that these are the targets from where this terror factory works, and hit them hard, and plan for the escalatory part also. That is what is the challenge, because the moment there'll be many options, the military is the best to take those calls, not for me to say how they will do, whether we'll fire from our own territory or we will cross the international border and then take them on. But this time it's going to be more short actions. Let's wait and watch with the meeting taking place tomorrow. And this time, the time, place, and the punishment that we want to give is of our choosing. So there's no reaction that is going to come in an haphazard manner.
Right. Do you feel, sir, that for the long term, if we have to be successful, we will have to come up with a strong roadmap to economically isolate Pakistan, be it with the Indus Waters Treaty, making sure that we build those dams, that infrastructure that cuts out the water lifeline. We use other measures to make sure that trade with Pakistan becomes difficult. The airspace, the Indian airspace remains inaccessible for Pakistani airliners. What more can we do to ensure that there is a long-term deterrent effect?
See, Parikshit, I've been saying that all these measures we have tried earlier, trying to, choke Pakistan economically, stop trade with Pakistan. There is big brother, China is always there to support Pakistan. They say that higher than mountains, deeper than ocean, and sweeter than honey is their relationship. So China is the guy, the big guy in this entire thing, which always bails out Pakistan. What we have to try and convince, now our relations with China are improving. This is something really very good that it started sometimes in October, and now disengagement, de-escalation, and maybe de-induction takes place in this summer. So with what we have to try and convince is, we must pin this entire thing on the Pakistani establishment, the Pakistani state. Somehow we must ensure that the kind of hold the Pakistani generals have on their public, on their polity, on decision making in that country, that is what has to be hit. And for that, India must do whatever it can do. But at the same time, it must make friends. I've been always advocating talking to Taliban, or we are talking to Taliban. Iran is a very important player. They are also suffering from whatever is happening on the Iran-Pakistan border, you're aware. So Afghanistan, Pakistan, Iran on one side, convince China that finally your commercial interests in Pakistan are best safeguarded under the Pakistan political leadership and not necessarily under the military. So we have to find reasons and causes and take actions how to weaken the Pakistan military. Our target should be the Pakistan military, the ISI, and this entire system, which we call as the epicenter of terrorism. That is where the challenge is, and I'm sure our authorities must be looking at those solutions.
All right. Thank you, Major General Yash Moore, for joining us. With that, it's a wrap on this edition of News Center. More news and updates continue right here.
The whole world has heard Pakistan's Defense Minister Khwaja Asif admitting and confessing Pakistan's history of supporting, training, and funding terrorist organizations in a recent television interview. This open confession surprises no one and exposes Pakistan as a rogue state fueling global terrorism and destabilizing the region. The world can no longer turn a blind eye. The Pahalgam terrorist attack represents the largest number of civilian casualties since the horrific 26/11 Mumbai attacks in 2008. Having been a victim of cross-border terrorism for decades, India fully understands the long-lasting impact such acts have on victims, their families, and society.
Ladies and gentlemen, it's wonderful to be here in Mumbai in conversation with the Honorable Chief Minister, Mr. Devendra Fadnavis. I've always had conversations with him that have elicited headlines, so I'm hoping that we will be able to do the same. I had the good fortune of being at the G20 summit in New Delhi, which is where the idea of the India-Middle East European corridor was first announced in the presence of the Honorable Prime Minister, Shri Narendra Modi. A lot has changed since the G20 summit. We are currently in a state of flux and volatility globally, where there is a global reset that is currently underway. But the hope is, and the belief is, that what is being touted as a game-changing idea will be a reality, with all parties on board, with all stakeholders on board, ensuring that it does in fact fructify. But to talk about Maharashtra's aspirations of being the gateway to the India-Middle East European corridor, let me address that question with you, Mr. Fadnavis. You have grand plans of positioning Maharashtra as an infrastructure hub. It's been called the gateway to India, but as part of the IMEC, how do you position yourself? What are you factoring in as some of the things that you could potentially do to your current plans to envisage a future that includes the IMEC?
Yeah, thank you. First of all, let me welcome everybody to this beautiful city of Mumbai, which is financial, commercial, and entertainment capital of India. And I think Mumbai and Maharashtra has to play a pivotal role in the IMEC corridor, because I think we will be creating an ecosystem which will support this entire idea. And when we talk about our plans to become a $1 trillion economy, I think we are working in several ways. If you can look at our infra push, which we have given in last few years, I think you have seen change Mumbai, and also the entire Maharashtra feels connected now. And I think when we look at the opportunities through IMEC, I think we have a great opportunity to become the logistics capital. We can move a lot of logistics from Mumbai. We actually we are looking at advanced manufacturing. We are looking at agri-tech. We are looking at fintech. Of course, Mumbai is a fintech capital. So I think the clean energy push, the green manufacturing, all these areas I think are very important for us, because they will not only play a major role in making us a $1 trillion economy, but they will be also the drivers of the IMEC corridor.
Well, speaking of the drivers for growth and urbanization, infrastructure development, connectivity, as you outlined, are some of the key areas that the government is focusing on. For the benefit of our audience here in the room, as well as for those who are watching on TV and online, Mr. Fadnavis, what is the aspiration in terms of infrastructure development? Is there a number that you're working with that over the next 5 years, this is potentially what you would like to invest as far as infrastructure is concerned, to ensure that you can realize the many dreams that you've spoken of?
Absolutely. You see, between 2014 and 2019, we invested somewhere around $30 billion in creating infrastructure. You can see the coastal road, you can see the Atal Setu, you can also see the Samruddhi Highway. There are many iconic projects, the new Mumbai airport, many iconic projects which we built during this tenure. Now we want to do more. So recently, we have tied up with Indian financial institutions to raise a sum of around $50 billion. And in next 3 to 4 months, we'll be tying up with foreign investors to invest into $50 billion more. So there will be a huge push on infrastructure side. We are building a lot of access control roads, airports, ports. Now, you know that the new Mumbai airport will be ready very soon. Now we are building a new airport in Pune. We are also building one more airport in Vadhavan, which will be the third airport of Mumbai. We are actually building a new airport terminal in Shirdi. We are building a brownfield airport in Nagpur. So across Maharashtra, we are building airports. We are building roads. We have already built Samruddhi Highway. Likewise, now we are building one more highway, which is Shaktipit Highway. This will connect Nagpur. It will be from Nagpur to Goa, and it will actually connect the entire, that area of Maharashtra, which is up till now a little backward, to all the major centers of business. And this will actually transform our economy. And we are also actually building a lot of river connectivity projects. So actually, if you look at Marathwada area, which is water stressed, in that area, now we are building a river linkage project by which we'll be bringing 50 TMC water, the water which flows from west flowing rivers, which directly flows into the sea. That entire water will be brought to Marathwada and will make Marathwada drought free. Again, one more project which we are doing is more about urban floods. So we usually every year we have a lot of floods in the area of Kolhapur and Sangli. This entire water we are bringing through diversion canals to Ujni and to Marathwada. So there are huge projects around water, there are huge projects around infrastructure, roads, ports, airports. Again, you know that we are building Vadvan, which is, Vadvan is a game changer port. And you see, today, the biggest port of India is the JNPT port. It accounts for 60 to 65% of the container traffic. And this Vadvan port is 3 times bigger than JNPT. And actually, on its day one, it will be amongst first 10 ports of world. So this port is going to change, the entire way we conduct the business. And we are also integrating entire Maharashtra with this port, because with the Samruddhi Highway, we have actually brought 15 our districts connected to the JNPT port. So the port-led development is now actually expanding beyond Mumbai, Pune or Nasik to 15 new destinations. And now from Samruddhi, we are creating an access control road, which is just 100 kilometers to this new Vadvan port. So from Nasik to Vadvan, a new road will be created, and that will actually connect at least 17 districts to Vadvan port. And that will make, this port-led development expand to 17 districts of Maharashtra. So see that we are actually getting us ready for this corridor, so that, once all the signatory countries, they work together and they create this corridor, Maharashtra will be the future-ready state. It will be ready to use this corridor.
Well, future-ready as and when the IMEC does come together. But, if I could just continue on what you talked about, the port-led development, which, of course, is going to be a big part of this reality as and when it does take shape, Mr. Fadnavis. One of the challenges when we talk about doing business in India is the ease of doing business. The other is, of course, the cost of doing business. What will this mean? Logistics cost is a big cost as far as the cost of doing business is concerned. In your view, with the measures that you've outlined, if you can leave us with timelines by when you believe the measures that you've just spoken about will in fact be a reality, what could it mean in terms of the cost of doing business?
Yep, you're absolutely right, because EODB and CODB are two things which actually keeps you ahead. And we have been working on it for a long time. I mean, if you look at, ease of doing business initiatives taken by the state of Maharashtra during my first tenure, I think even the World Bank has recognized it, and the government of Singapore, which published one of its publication around ease of doing business in India, and they have put Maharashtra at number 1 in 2019. So I think that has always been our focus of achieving seamless business in entire business arena. Now we have also created a legislation around that. Our Maitri portal, which is one-stop shop for all businesses, to do the business seamlessly. So we actually have created a single window system by which anybody can access it, and this real single window, because I always say that many times there is a single window. When you enter, there are several doors which you have to knock. This is not like that. This is a real single window whereby actually end to end all things are connected, and we give the services totally from scratch to everything we are giving under this Maitri portal. Having said that, I think you're absolutely right that cost of logistics is something which is bothering businesses a lot, and that is why we are creating infrastructure and seamless movement of goods. See, now if you look at the movement of goods, or if you look at the JNPT port, from, let's say, Nagpur, it used to take 7 to 8 days for goods to reach JNPT port. Now it takes 8 hours. So with this, our connectivity push, once the Vadhavan is ready, and as per timelines, I think in next 3 to 4 years, we'll start the operations of Vadhavan. And once Vadhavan is ready, I think that will have huge impact on logistics, because today JNPT port is so jammed because it's the only big port which is handling on this side. And turnaround time, although it's a very efficient port, but still turnaround time is high. But once Vadhavan is there, then I think the turnaround time will be very less, and that will actually lessen the logistics cost. I think around that, if you look at the Pune airport, which we are actually creating, this is not just an airport, but it's also, we are creating a huge cargo handling facility at Pune, because Pune is our manufacturing hub.
Yes.
And the entire manufacturing is done in and around Pune. So we are actually doing a cargo hub there. Our cargo hub will also be, one cargo hub will be created in Nagpur. We are already, actually we are doing it. And our new business magnet is now Sambhajinagar, where, the entire EV revolution has translated into action in Sambhajinagar. So you name it and they are there in EV. And they are also actually the connectivity to the Vadhavan port and the connectivity to the JNPT port is just 7 to 8 hours because of Samruddhi and because of the new corridor which we are creating. So I think a lot of things which we are doing will be adding up to, lowering the logistics cost. And when we started creating this Vadhavan port, I actually appealed to Honorable Prime Minister, and I requested him that we are creating a port. We are actually doing, a lot of reclamation there. So around the world, most of the efficient airports are reclaimed airports. So why shouldn't we build a new airport at Vadhavan? And he immediately agreed. And we are now also building one airport. So you see, a port and an airport together, that will create a huge ecosystem for businesses, and especially those who are into import and export, all those manufacturing which required a lot of export or a lot of import of the components. They will have an entire ecosystem created there for the manufacturing.
The market is always looking forward, so it's true that there has been some economic weakness, but if we look forward, I think we will see acceleration, because the things that caused that weakness last year are behind us, and inflation is back down to very reasonable levels, so we can look forward to at least 2 more rate cuts. And the main thing is that the dollar is still overvalued, and our view is it will weaken over the next 12 months. It's probably about 10 to 15% overvalued, believe it or not, based on our real effective exchange rate model. Now, I don't know if it's going to go down another 10% because it already is down 10%, but if it continues to weaken, of course, that is good news for the Indian market as well, because it would attract foreign flows. Cyclical recession, and generally what you see in that kind of environment is people trying to find other places to invest in the rest of the world. And India's economy, among the major emerging markets, is about as decoupled from
I just want to recap some of the big takeaways that have come in from the Chief Minister already. Almost $100 billion in terms of financing is what the Maharashtra government is hoping to do to aid infrastructure development. You've given us a timeline of the new port, operational hopefully in the next 3 to 4 years, along with the airport that's going to be coming up there. Third, Mumbai, which of course is your plan as far as creating the new engine of growth as far as the state of Maharashtra is concerned. What's the status check on that? How soon can we expect that to be a reality?
Yeah, of course, I think that's soon going to be a reality. You see, due to, our infrastructure deficit between 2000 and 2014, we lost a lot of IT revolution to cities like Bangalore, cities like Hyderabad, because, Mumbai being an island city, there is huge land constraint and the rentals went shoot up. They went up so high that it was unaffordable for tech companies to locate themselves in Mumbai. But now with our infrastructure push, actually we have connected the new Mumbai to Mumbai with Atal Setu, 22 kilometers sea bridge, and the entire hinterland which we have connected. Now we are creating a third Mumbai between, this Atal Setu, JNPT port and the new airport. And this will be 3 times bigger than the existing Mumbai. And it will be a sort of thematic city where we are actually building an Edu city. In the Edu city, we will be having 10 foreign universities located themselves, out of which 5 are in active dialogue with us. Actually, 5 have already applied. Since we have a non-disclosure agreement, I cannot disclose the names, but they've already...
Are they US-based, Europe-based?
Yes, US-based, Europe-based, yes, absolutely. I would say that these 5 universities are actually amongst first 100 universities of world. So we are creating a Edu city, we are creating a health city, we are creating a innovation city. Now this innovation city is a concept where we want to bring entire innovation ecosystem at one place. It's actually 300-acre city where entire innovation will be hosted. And Mr. N. Chandrasekharan of Tata Sons, he has actually volunteered to create a framework around this city. And now we are actually actively talking to many stakeholders. And the moment I announced it, who's who from, global community has contacted me and they have shown interest that they want to locate themselves in this city. So we are creating innovation city there. You see, New Mumbai and this third Mumbai is already the data center capital of India, because around 60% of our data center capacity is created in this New Mumbai. So I think that it will be a very exciting city where you'll see a lot of technology. And of course, the biggest benefit to this city is that, the rentals or the cost of, property is at least, 50% less than Mumbai. So it is affordable city. We lost all this IT revolution because of the rentals. Now, the entire real estate which is getting created there is affordable. And also we are creating a huge, ecosystem for GCCs at this third city. And having said that, we are not stopping at the third Mumbai. Now we will be building fourth Mumbai around Vadhavan, because, Vadhavan is one area where we are creating port, we are creating airport. The bullet train also stops at Vadhavan, and our coastal road, which now, Bandra Versova we are creating, Versova to Bhayandar we are creating, Bhayandar to Uttan we are creating, from Uttan to Virar. So this entire western coast will be joined by the coastal road. So see the ecosystem which we are creating, that at one point there is a port, there is an airport, there is a bullet train station, and there is a road which is connected. And all this, the bullet train and this road, will bring you to Mumbai. Bullet train will bring you to BKC in 20-25 minutes, and this road will bring you to Mumbai in 40-45 minutes.
The question is, when will it bring us to BKC in 45 minutes?
See, that is also not very far, because, you see, unfortunately, sometimes politics is very cruel, and between 2020 and 2022, when there was some other government in Maharashtra, they actually literally scrapped the bullet train. But once we took over again, we started it afresh. And today I can tell you that every bit of work of bullet train is being taken up, and it's happening at a great pace. So let's say that by 2028, we'll be able to travel in the bullet train.
By 2028?
Yes, yes.
Is that a commitment and a guarantee?
Yeah. You see, from the Gujarat side, they are ahead of us because there was a single government in Gujarat. There was, double engine government. So it never stopped. So Gujarat, they are quite ahead of us. We are lagging behind, but I think now we have actually taken the pace and we'll be able to do it by 2028.
By 2028, we should see the bulletin being operationalized. That's a commitment here coming in from the Maharashtra Chief Minister, and that's going to be a big headline as well, Mr. Fadnavis. But you talked about losing out on the IT revolution because the land was not affordable, rentals were not affordable. Let me ask you this in the context of what we're seeing happen as far as other states are concerned. Your colleagues in the state of Andhra Pradesh are virtually giving away land for free. 99 paise, is what the deal has been done with TCS. Are you worried about things like that? Do you see those things as an opportunity?
No, I'm not worried because Andhra Pradesh can have anything, but they cannot have Mumbai and Pune. You see, ultimately you need to have Mumbai. Mumbai is Mumbai. You cannot compete with Mumbai.
You can't compete with Mumbai. But, in order for all of this to be a reality, I think sustainability is also going to have to be key to the aspirations of growing the city, whether it's into 3 or 4 new cities as well. So from that perspective, Mr. Fadnavis, what will the state government be prioritizing to ensure that growth is sustainable?
Yeah, I think that's absolutely right because, when we grow, the biggest concern is energy because, one of the indicators of growth is how much energy do you consume. And today we are somewhere around, the installed capacity in Maharashtra is somewhere around 46 gigawatt. And by 2030, it will be around 82 gigawatt. So almost double. We have already started working on that. But I must tell you that in this capacity addition, the addition will be mostly the green energy. See, today our entire energy mix in Maharashtra is just 21% renewable, and rest all is from fossils. But by 2030, our 52% energy will come from renewables. So there's a huge push on renewable. By next year, by the end of 2026, by December 2026, our entire agriculture demand, which is around 16 gigawatt, will come from solar. We have already started, it is India's biggest distributed solar scheme, which we have started, Mukhyamantri Saur Krishi Vahini, where around 3,000 feeders are being solarized, and already we have finished around 4,000 megawatt, and by end of 2026, it will be 16,000 megawatt. So we are giving huge push to solar, to wind, to also PSP, because of the Western Ghat, we have a huge opportunity into pump storage. So we are doing pump storage. We are doing now. We are working around green hydrogen. So I think on sustainability, especially when you look at power, we are doing a good work. And along with that, the second biggest polluter is public transport. So now we are actually transforming entire our public transport into green. We are using CNG, we are using EV. The biggest order of EV to all the EV manufacturers has gone from the state of Maharashtra. Actually, right now we have a huge requirement, but the manufacturers are not able to provide our requirement. So we are actually totally transiting our entire public transport. And again, because of the EV revolution which is happening in our country, I think that by 2030, even the private cars and the two-wheelers will be mostly EV, because now a lot of push is being given to EV, and the costs are also coming down. So I think on sustainability, it is our focal area, and we are doing it.
Well, you're talking about the EV revolution, Mr. Fadnavis. So let me ask you, is Maharashtra going to be part of Elon Musk's plan for India?
That only Elon Musk can tell, but I hope we should be, and we'll always try, we'll always compete, we'll always be, at forefront to welcome them.
But, you talked about supply chain diversification. You talked about the manufacturing opportunities that also present themselves today. In light of that, electronic manufacturing, for instance, I mean, big potential area for India. We've already seen exports go up exponentially in the last 2 years. What role do you believe Maharashtra could potentially play in new areas like this, linking it back to the IMEC as well?
Yeah, you see, of course, if you look at the investments which have come into Maharashtra, whether it is Toyota, whether it is JSW, whether it is Ather, all the Mahindra, all those are into EV have actually come to Maharashtra. In fact, Maharashtra has become the EV capital, and basically with EV ecosystem and with our port capacity which we are creating, and with the entire seamless logistics plan which we have created, I think IMEC will be a game changer for us, for our EV plans, for our to become. Today we aspire to become the EV champions of India, but tomorrow we can aspire to become EV champions of this entire region, and that's what we are aiming at.
So what would you prioritize as far as the next steps are concerned? Many of the game-changing opportunities that you just spoke of, but in order of priority, what would the top 3 be?
No, I think, as I've already told you, that the priority will be, of course, advanced manufacturing is priority, EV is our priority, agri-tech is our priority. So I think there's a huge business opportunity which I can see because of, this connected world, because of this connectivity. And all of us know that India once was very prosperous because of this route. I mean, this is an old route. It's not something which is reinvented. It's an old route. So I think that I am looking at the same prosperity. It's not just for India, but for all the participating countries. But India can be at the forefront. So in that endeavor, we want to be part of it. We want to lead it in India.
Well, Mr. Fadnavis, it's been an absolute pleasure. Thank you very much for joining us here this morning.
Thank you so much.
Outlining for us the plans that you have for Maharashtra as being at the forefront of taking the IMEC future forward, and how you intend to be future ready for when IMEC is a reality. Ladies and gentlemen, the Chief Minister of Maharashtra, thank you very much for joining us here this morning.
I mean, there is the technology sector, but that is not the main driver of the economy. It's domestic consumption. So I think in a cyclical recession scenario.
Hello and welcome to Market Masters. Today we are in conversation with the top markets team at Nomura. It has been an incredible last few weeks. Massive, not exactly reciprocal tariffs, stock market selling off hard, bond markets throwing a big tantrum, a 90-day tariff pause, markets snapping back globally, with the exception of US assets, dollar US assets, which kept getting sold, and over the last few days, some repair and recovery in US assets as well. A complete roller coaster. What is the roadmap from here? Is there a roadmap to begin with? It's my pleasure to speak with the top team at Nomura. We have with us here Rob Subramanian, Head of Global Markets Macro Research at Nomura. Craig Chan is Head of Global Forex Strategy. Sonal Verma is Chief Economist, India and Asia, ex-Japan. Sayan Mukherjee is India Head of Equity Research. Sonal and gentlemen, thank you very much, all of you, for being here. It's been an absolute roller coaster ride, and I was joking, saying that I'm getting up earlier and earlier every day and getting to office later and later. so much overnight news to digest, right?
Yeah, it feels like what's happened in the last 3 months usually takes 3 years or longer to happen.
Yeah, I mean, and you think of it, it's what, only 10%, not even 10%, 5% Trump's term, 4-year term?
Yeah.
I mean, if you calculate number of days. So we're just in the beginning. These trade deals now, I think, is what markets are focused on, Rob. What's your sense? Are they going to get done quickly? Because markets are swinging between optimism to despondency. What is your sense?
I don't think they'll be done quickly. I think trade deals take a very long time to do. I think the Trump administration will try to dress up some quick wins with some close allies and hopefully try to get some tariffs down. But you know, our view is that once tariffs go up a lot, and they have gone up a lot, we think the effective rate's 21%. They don't tend to come down that quickly. And so our baseline is tariffs are going to stay up pretty high. I think China has quite a bit of leverage over the US, and that trade tension will continue. And ultimately, Trump wants tariffs for revenue as well. So, you know, tariffs are going to have a big macro effect on the US economy, and economies everywhere this year is our bottom line.
So with China, what we've been hearing over the last 48 hours, should we read this as a bit sort of conciliatory, tempering things down a little bit? Or is that reading into too much? I mean, things could change. We could hear something different over the coming days. What's your sense?
Well, look, right now, US tariff on China of 145%. I mean, essentially for a lot of trade between US and China, it's essentially stopped.
Correct.
So there will probably be some coming down. But the point I'd make is...
So between 10 and 145, there's
a big range, right? So
and Trump was, before election, said 60%. So will we get down to 60? What, I mean,
we could get down to 60. And that has been our kind of a longer-term baseline, around 60. But the point we'd make is that's still extremely high. And that is going to lead to a lot of, I think particularly for the US, a lot of inflationary effects. And it's going to hurt growth. Rest of the world, it's a different impact. It's more of a demand shock for the rest of the world, lower growth and less inflation. So there's going to be also a disconnect between central bank responses. We think the Fed is not going to be cutting rates quickly because of the inflation. We have the first cut in December. But for other central banks around the world, there's a lot of room for cutting rates. We've just added another 2 cuts for the ECB this week to our forecast. Many central banks we have essentially cutting while the Fed's on hold.
Got that. And do you expect a recession in the US? Or you think we won't get it? I think your house view is that you escape it, but you get pretty close to it, but don't actually see it.
That's where we are right now. So it's very close. So if you look at our growth forecast for Q2, Q3, Q4, it's 0.1% quarter on quarter. So not much margin of error for negative growth numbers there. So very close to recession. We'd put it around a 40% chance.
What happens on the 4th of July? You said no deals. 4th of July is when the 90-day sort of tariff pause expires. So we get another extension and then these negotiations.
I mean, I think between now and then there could be some deals. But what I'm saying is I don't think all the reciprocal tariffs are gone. I think that some will be coming back.
Okay. I mean, what is, Craig, welcome to the program and great speaking with you. What is your sense in terms of how, I mean, bond markets threw a tantrum and it looks like there is a bond put but no put for equities. Is that the way to look at it? Because as Rob is saying, this is a long drawn-out process, and the big deals are with EU and China, and what really matters for global growth, etc. And if they take a long time, I mean, growth may suffer and markets may swing as well. But have you seen the worst in that sense, dollar assets?
No, I don't think we have. I mean, I just say that what we have seen so far is actually just evidence of some outflow. Right? It's definitely not been broad-based. It looks like it's mainly on the bond side, where there has been some selling from the Japanese investors, from Taiwanese, to some extent Korea as well. But it hasn't been really excessive. There hasn't been much kind of equity-related selling. Overall, in terms of looking at kind of the value of assets in the US, still exceptionally high. You know, we're talking about the last numbers we have. They're quite old, but I mean, it's like 33 trillion US dollars of foreign investment value in bonds and equities. I mean, it's just surged in the past few years. I think we're starting to see some signs of that unfold.
You're saying that foreigners, and especially central banks, are selling US bonds. I mean, that has been happening, Japanese especially.
So we haven't seen it in terms of central banks.
Okay.
The data is actually
so maybe investors,
mixed. It's actually quite mixed. But you know, you have on one hand the treasury data, which shows you there's some direct selling from Europe. There's some direct selling that's coming from, let's say, China, Asia, ex-Japan as well. But then you have the safe haven, or the tax haven, should I say, places where you have seen actually buying. So it's a bit of offset. There's no consistency really about it on the central bank space. But certainly on the private side, it looks like something is happening there on the actual asset unwind. But I just say quickly, beyond the asset unwind, there's also another element around it, and that is there's a lot of investors that put money into the US that actually haven't hedged out the FX risk. Japanese life insurance companies have low FX hedge ratios. Taiwanese life insurance companies have low FX hedge ratios. So that's another risk. They could start selling more dollars to hedge out the FX risk.
I think that's the interesting thing. I think the central banks around the world have been diversifying away from US dollars, their reserves, for a long time. The new interesting thing is the private sector. Private institutional investors, big lifers, pension funds around the world, are they starting to diversify away from the US?
And the reaction, what we saw was interesting, right? Usually when stocks go down, I mean, bonds go up. But here you had a situation recently when everything was getting sold.
Yeah, long end US treasuries, equities, it was basically almost get out of the US.
So that phrase US exceptionalism, are we at the end of it? What's your sense?
I mean, I wouldn't push it that far away at the end. I would certainly be saying that it's fading, right? That the evidence we're seeing is that it's fading. But at the end is still quite, you know, I think of a push. It's a push to say that.
Because even if, Rob, everything goes back and they say, well, we've made deals, etc. I mean, it's an issue of trust, right? Suddenly you've thrown everything up in, you know, it's kind of, isn't that is the heart of the issue here. When we say US exceptionalism, I mean, the exceptionalism was about the trust in the systems and the institutions, etc.
I think US exceptionalism means different things to different people. Yeah. I was going to ask you what you mean by that, because
to some people it just means tech exceptionalism.
It's true, right? Exactly. And then for others it means the economy. And US is facing stagflationary effects, which is bad. But then the worst case of US exceptionalism is what I think you touched on, Prashant, is foreigners losing trust in the US dollar as the global reserve currency. And as Craig said, I don't think that's clear yet. But in terms of the US economy starting to wobble and less scope for policy support for it, I think that's quite a valued concern right now.
There's been so many different angles, right? It's been from the DeepSeek fears and the impact on AI. Then it moved to tariff policies, non-tariff policies. Then there's concerns about, you know, am I going to get taxed on, you know, if I'm holding US treasuries? It's just a lot of policy, as you mentioned, policy uncertainty for investors. And that is going to reduce the effective overweight that we've seen in US assets for many years. And that's what's happening now.
Fair enough. Sonal, let's come to India. It seems like we're first in line to get a deal. Would you agree?
Hopefully. I think we definitely have a head start. We started the negotiations ahead. The terms of reference have been finalized. India is a strategic ally. Now, you know, deals take time. Agriculture is a politically sensitive subject for us, but there are other aspects of the agreement on the industrial tariff, parts of the non-tariff barrier, you know, buying more of US products, which can easily be done. So I think if we can get the 26% reciprocal tariff down before the deadline, and our tariffs are lower than our competitors, then really in this world, what you're looking for is a relative